Hello, good morning. You've tuned into Power Breakfast on CNBC-TV18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. A lot's that happened in our domestic market last evening. We've seen a lot of updates that are coming in there. US market, the sell-off has continued because of the AI and AI related shares. That sell-off has continued. So Asian markets today are indicating a red start for the Indian markets as well. Look at the Asian markets, opened up with cuts of 0.1%. That's Taiwan index. Hang Seng has opened with cuts of 0.6% as well. We have the Japanese index Nikkei that's seen a sharper cut of almost 1%. Shanghai too is trading with very sharp cuts. Other than that, we have ASX 200. That's the Australian index that has also opened with cuts of almost 0.3%. Looking at the South Korean index, that's the Kospi, that's down also 1.3% in opening trade. The small cap Kostak is also down 0.64%. This is the South Korean indices that we're talking about. So overall, we're seeing red on the screen for the Asian markets. Now let's pull up the Nifty implied open. What's the indication coming in there? That's also indicating a bit of a red start for the Indian markets. As of now, 26-point decline, and seems like yesterday and the last few days where we have seen red on the screen, that is expected to continue. At least that's the indication that's coming from the Nifty implied open. So we'll watch out for that. But that's the Asian markets for you all. A lot that's happened overnight, like I said as well. How is all this going to be impacting our Indian markets? We have a team of research joining us to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, let's go across to Gaurav now, who is joining us to tell us the important market cues that we are keeping an eye out on today. Good morning, Gaurav.
Well, good morning. If you look at Nifty, we are seeing a shade of red every day for the last 3 days consecutively. So today, if we look at the levels, yesterday we saw Nifty was able to hold that 25,800 level. 25,800 now becomes a key level to watch out for. The resistance is somewhere between 25,000. The support level is between 25,750 to 25,800. So that is a key thing to watch out for in Nifty. While on the upside, 26,000 seems to be a resistance level. So that is also something that we should be watching out for. If there is any up move, if it sustains about 26,000, we can see some bullish move going ahead. Other than that, yesterday, if we look at the indices specific to the sectors, Nifty PSU Bank, that was the biggest gainer, that gained almost by 1.3%. With some of the candidates like Canara Bank, PNB, Bank of India taking the lead. So let's see if this rally continues even today. On the flip side, we saw Nifty Realty that slipped almost by 1.7%. So let's watch out for realty stocks for the day. Other than that, stock specific, if you look at the action, yesterday we saw Shriram Finance that gained almost by 2%, and this is because of the board meeting that they have tomorrow, and also because of the speculation that MUFG is interested in buying. Let's see if the rally sustains even today, because the valuation that reports suggest is still higher than the current market value. On the flip side, we saw Max Healthcare, Polycab, Dixon actually losing in trade, lost almost more than 2% in the day yesterday. So let's see if there is any sustainable move that we can see in these stocks. Specifically, let's also focus on Ola Electric, because this is at their all-time low level, and promoters sold yet another 4.2 crore shares in open market yesterday. Lastly, from the IPO market, we are getting KSH International, whose last day is there for subscription. Remember, if you look at the subscription data, it is not so strong, but we tend to see a strong subscription data on the last day. So let's see if it sustains. From the global markets, we will be watching out for US CPI and jobless claims, and ECB, which is European Bank. They will also come up with their interest rate decision. So let's see if anything significant is there to read. And lastly, let's also not forget about Bank of Japan. They are also holding their monetary policy meeting. Remember, the decision is going to come tomorrow. Street is expecting 25 basis point of increase, which will be highest in the last 30 years. And that is the reason why we will be closely watching out of this event, because this can actually reverse the carry trade between US and Japan. So let's see how it impacts not just Japanese market, but the global market as well.
Okay, thank you so much for that, Gaurav. But let's now go across to Ria, who's here to tell us which are the important stocks that we should be keeping on our radar today. Good morning, Ria.
Well, good morning. First up is Ola Electric. The founder, Bhavish Agarwal, has sold roughly 4.2 crore shares, and this is after selling 2.6 crore shares on Tuesday. On Tuesday, the company had said that this transaction was being executed to fully repay a loan of roughly 260 crores. Until now, both of these transactions come out to be roughly 234 crores. And with this, it is important to know that all of the previously pledged 3.93% shares of the company will be released, which will remove a critical overhang for the company. Moving on, Cyient Limited will also be in focus, and Cyient Semiconductors, which is a wholly owned subsidiary of the company, is going to acquire more than 65% stake in Kaynes Technologies, which is a global leader in power management, high-performance analog, as well as mixed signal ICs. This will be for an amount of roughly $93 million, and the transaction is expected to close by April of next year. Ugro Capital is going to issue NCDs worth up to rupees 200 crores with the option to retain oversubscription up to rupees 500 crores. GMR Power has also approved a fundraise worth 1,200 crores via preferential share issues as well as warrants. Titagarh Rail will also be in focus today. They have received an LOA worth roughly 273 crores from the Indian Railways to design, manufacture and supply rail-borne maintenance vehicles, which are RBMVs, and these are to be delivered within a period of 48 months. HCL Tech will also be in focus today. They have signed a multi-year contract with ASN Bank, which is the fourth largest retail bank in the Netherlands, and this is going to be done to accelerate digital performance as well as enhance customer experience. Geo Financial has appointed Venkata Peri as the group COO with effect from the 22nd of December, so keep your eye on that as well. KP Energy has signed an MOU with the government of Botswana to collaborate on developing large-scale renewable energy and power infra development, and this is going to require an investment of roughly $4 billion, which comes out to rupees 36,000 crores, and these projects are expected to help increase Botswana's renewable energy capacity to nearly 5 gigawatts.
Okay, thank you so much for that, Riya. And in the final update for FNO, what are we keeping an eye out on? We have Mangalam joining in with us from the FNO desk. Good morning, Mangalam.
Good morning. So, yesterday the market had all the reasons to perhaps see some sort of recovery. That's rupee strengthened itself, but that did not happen. We had the Nifty Bank, the mid-cap index not do particularly well. Second day in a row, we had more declines than advances, and the decliners were to the tune of 2,000 stocks, and the advances were just around 885. The Nifty, however, managed to close above that 25,800 mark, and in that got support from the 50-day moving average as well. So that is something that will give bulls some sort of relief. The INR strengthened versus the dollar, and that was reflective in the kind of cash market flows as well. The FI has bought about 1,200 crores, the DI has bought about 800 crores. A large part of that was also on account of the large trade from AkzoNobel, so we'll keep that into account. But despite the mild purchase that we saw in cash market, there was selling across in stock futures and index futures. Both of them put together, they sold about 2,400 crores. And with this, the FII exposure in index futures now stands at just 8% on the long side. In just the last 3 sessions, the FII shorts have increased by nearly 17,000 contracts, so the net contracts near 1.65 lakh on the negative side. If you look at a couple of these active options, that tells you that 26,000 is an important resistance. 25,900 call very active, premium of 100 rupees. But bulls are hoping for 25,700 to 25,750 play out as an important support, and that's why we are seeing writing in the 25,800 put as well. 26,000 call writers still believe that around 26,000 to 2650 there would be a fair amount of resistance. And why do I say that? Because if you look at the 20-day moving average on the Nifty, 26,018, we have to cross that. And for the Nifty Bank, crossing past that 59,300 mark, which is the 20-day moving average, will be crucial. Just one stock I will keep my radar on, or on my radar, will be Polycab. Was down 4% yesterday. A lot of short positions built on that stock.
Okay, thank you so much for that, Mangalam. In the world of FNO, we'll keep an eye out on Polycab, especially as well. But on that note, let's cut across to the US President Donald Trump, who's addressing to the nation.
But not anymore. Companies know that if they build in America, there are no tariffs, and that's why they're coming home to the USA in record numbers. They're building factories and plants at levels we haven't seen, AI, automobiles. We're doing what nobody thought was even possible, not even remotely possible. There has never, frankly, been anything like it. 1 year ago, our country was dead. We were absolutely dead. Our country was ready to fail, totally failed. Now, we're the hottest country anywhere in the world. And that's said by every single leader that I've spoken to over the last 5 months. Next year, you will also see the results of the largest tax cuts in American history that were really accomplished through our great, big, beautiful bill, perhaps the most sweeping legislation ever passed in Congress. We wrapped 12 different bills up into one beautiful bill. That includes no tax on tips, no tax on overtime, and no tax on Social Security for our great seniors. Under these cuts, many families will be saving between $11,000 and $20,000 a year, and next spring is projected to be the largest tax refund season of all time. Because of tariffs, along with the just passed One Big Beautiful Bill, tonight I am also proud to announce that more than 1,450,000, think of this, 1,450,000 military service members will receive a special, we call Warrior Dividend before Christmas, a Warrior Dividend. In honor of our nation's founding in 1776, we are sending every soldier $1,776. Think of that. And the checks are already on the way. Nobody understood that one until about 30 minutes ago. We made a lot more money than anybody thought because of tariffs, and the bill helped us along. Nobody deserves it more than our military, and I say congratulations to everybody. And by the way, we now have record enlistment in our military, and last year we had among the worst recruitment numbers in our military's history. What a difference a year makes. In addition, I'm doing what no politician of either party has ever done, standing up to the special interests to dramatically reduce the price of prescription drugs. I negotiated directly with the drug companies and foreign nations, which were taking advantage of our country for many decades, to slash prices on drugs and pharmaceuticals by as much as 400, 500, and even 600%. In other words, your drug costs will be plummeting downward, and I used the threat of tariffs to get foreign countries who would never have done it to pay the cost of this giant dollar reduction. They stopped ripping us off, and it began as of 4 days ago. There has never been anything like this in the history of our country. Drugs have only gone up, but now they'll be going down by numbers never conceived possible. It's called Most Favored Nation, and no president has ever had the courage or ability to get this done until now. The first of these unprecedented price reductions will be available starting in January through a new website, TrumpRx.gov. And these big price cuts will greatly reduce the cost of health care. I'm also taking on the gigantic health insurance companies that have gotten rich on billions of dollars of money that should go directly to the people. The money should go to the people. That's you. So they can buy their own health insurance, which will give far better benefits at much lower cost. It will be far better health insurance. The current Unaffordable Care Act was created to make insurance companies rich. It was bad health care at much too high a cost. And you see that now in the steep increase in premiums being demanded by the Democrats, and they are demanding those increases, and it's their fault. It is not the Republicans' fault. It's the Democrats' fault. It's the Unaffordable Care Act, and everybody knew it. Again, I want the money to go directly to the people so you can buy your own health care. You'll get much better health care at a much lower price. The only losers will be insurance companies that have gotten rich, and the Democrat Party, which is totally controlled by those same insurance companies. They will not be happy, but that's okay with me because you, the people, are finally going to be getting great health care at a lower cost. Another major focus is the cost of energy. For years, the radical left Democrats exploited the green energy scam as an excuse to funnel many billions of dollars into their own massive slush funds as their energy restrictions drastically drove up prices, and they drove them up at record levels. Electricity costs surged 30 to 100% under Biden, and the typical family lost $5,000 to $10,000 in higher energy costs. Think of that, $5,000 to $10,000 you lost. On day one, I declared a national energy emergency. Gasoline is now under $2.50 a gallon in much of the country. In some states, it, by the way, just hit $1.99 a gallon. And within the next 12 months, we will have opened 1,600 new electrical generating plants, a record, and it's a record that won't be beaten by practically, I would say, by anybody. or certainly not very soon, prices on electricity and everything else will fall dramatically. The Democrat inflation disaster, again, the worst in the history of our country, also robbed millions of Americans of home ownership and indeed the American dream. The yearly cost of a typical new mortgage increased by $15,000 under Democrat rule. In 11 months, we've already gotten that annual cost down by $3,000, and it's coming down a lot lower. Wait till you see. The numbers are going to be shocking. And I'll soon announce our next chairman of the Federal Reserve, someone who believes in lower interest rates by a lot, and mortgage payments will be coming down even further. Early the new year.
Welcome back to Power Breakfast on CNBC TV18. Now let's talk about the biggest news that came in last evening. SEBI has approved the changes to the mutual fund expense norms, thus reducing the headline expense ratio after deciding to exclude statutory levies from the expense ratio calculation. Yash is here to give us more details on this one. Yash, over to you.
Well, we had reported on CNBC TV18 that market regulator SEBI's board is expected to take up the proposal of mutual fund total expense ratio, and the rates which it had proposed in the consultation paper are likely to remain at same levels except for certain minor changes. That's exactly what has happened. SEBI's board did approve the mutual fund expense limits, and the rates are largely similar to what had been proposed as far as the consultation paper itself is concerned. Now, interestingly, what has happened is that the concept of total expense ratio, market regulator SEBI has bifurcated that concept into two parts. BER, which is base expense ratio, and this rate would be excluding the external charges or external, statutory levies or duties like STT, CTT, GST, stamp duty, SEBI fees, exchange fees, so on and so forth. The rationale behind doing that is because these charges are not received by the mutual funds, but they go to external different parties. And also, these charges are not in the control of the mutual fund players itself. What is in their control is BER, which is the base expense ratio, and those ratios and the limits there have come exactly at the same levels as what was proposed in the consultation paper. Of course, these other charges over and above the BER, not in the control of mutual fund players, and hence have been bifurcated. Another important important relief that came for the mutual fund industry was in the form of the brokerage charges. SEBI in its board meeting has approved the brokerage charges, and the existing brokerage cap of 12 basis points, which includes these external levies, that has been reduced to 6 basis points. The fear somewhere was that it would be reduced to 2 basis points for equity transactions, but it has been kept at 6 basis points. For derivative transactions, from 5 basis points, it's been reduced to about 2 basis points. Here, the expectation and what had been proposed in the consultation paper was 1 basis point. So, of course, on both counts, equity transactions as well as derivative transactions, the brokerage charges have come as a relief. The limit which has been kept there has come as a relief for the mutual fund industry.
Absolutely, Yash. Thank you so much for that. We'll keep an eye out on those AMC stocks, the broker side stocks. So that is something we'll watch out for. But on that note, we're going to step into a very short break. Stay tuned in for more on the other side. Welcome back to Power Breakfast on CNBC TV18. A quick check in terms of what the US market did. Obviously, they ended in the red. Whether you look at the Dow, S&P 500, Nasdaq, all of them closed with gust in yesterday's trading session. S&P 500 futures right now are very muted, so that is what we'll keep an eye out on. We had just heard the commentary that came in from President Trump as well, so maybe we'll see some reaction to that in tomorrow's trading session for the US market. Even Indian markets, we'll keep an eye out on that as well. But Asian markets, that too, have opened up in the red, following suit with what the US markets are doing. As of now, Hang Seng Taiwan Index holding on to red, as well as Nifty implied open is indicating a red start for the Indian markets, down around 10 points now. So yes, a bit more muted. When we started the show, it was more than 20 points. Now 10 points decline is what we're keeping an eye out on. But that's all the time we have on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome. You're with us. This is Bazaar Morning Call and we're coming to you as always live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me is Nigel D'Souza. Rima is with us this morning. And guys, I don't know how many of you were listening. It was a very spirited Trump address. It was things still ongoing by the time we came into the studio.
Indeed, and some very strong comments coming in on bringing down drug pricing, which will be effective. Now, the question is, will it impact Indian pharma, or he's specifically talking about the branded patented drugs, which are expensive. And considering that Indian pharma is at least majority exports are the generic ones, maybe they're out of the ambit. But of course, right, like, you know, it's all guns blazing, all eyes on Washington and the Trump speech.
Well, that's right. We'll keep an eye out on what Trump has to say. It's difficult to keep him out of the action, but we have big central bank action as well that's due in the next 24 hours or so. So that's going to be top of mind, I think, from a global perspective.
It seems like Bank of Japan should be priced in, right? That's tomorrow.
That they'll be hiking.
They'll be hiking by 25 basis points.
What if they don't?
Then the Santa Claus rally comes.
True.
Okay, let's talk about this. And this is exactly, some of the cues that the markets are reacting to this morning. First of all, the headline is negative. The headline is negative from Wall Street and bulk of Asia as well, also, trading with cuts. And that's because of the same AI headache. Now, what contributed or what triggered the headache yesterday? It was Oracle. So that's, the indices are on your screens. The slide was between 0.5% to almost 2% on the Nasdaq. What triggered it yesterday was Oracle. There was a report in the Financial Times that indicated that one of Oracle's key investors is now pulling out or backing out of funding one of their big data center projects in Michigan. It's a $10 billion project. And one key investor is pulling out. That was enough to get people worried about the AI spends, about the interconnectedness of a lot of these recent AI deals. And what was a result was a broad-based sell-off in tech. A lot of the other chip stocks, Nvidia, something like AMD, Broadcom, all these stocks were down 3, 4, 5%. So that's pretty much, how the US market action played up. We have more data in focus today. There's the CPI number that will finally come out, the US CPI number for November after that prolonged shutdown. The expectation is that inflation at the consumer level in the US will show an increase of about 3.1% year on year. So that's something that the market is watching out for. And ahead of that data, yesterday we didn't have too much of action in the bond markets. Yields pretty much range bound. The 10-year around that 4.1% handle, US 10-year. The dollar managed to recover. The dollar had dropped quite a bit after the jobs report, but yesterday was a day of a big recovery. In fact, the dollar index, even as we speak, is holding on to a lot of those gains that it managed to plow back yesterday at that 98.50, just under 98.50, that handle. Now, where that leaves the rupee is anyone's guess, but at least we had some respite on the rupee front yesterday. But while the rupee gave us some sense of relief, the bad news this morning is coming in from crude oil. Crude oil prices overnight have moved up by about 1.5%. And what we're dealing with is this whole impact of the Venezuelan oil blockade that Mr. Trump has started. He is, blocking all oil tankers that are sanctioned. And some estimates here, market estimates, how much does Venezuela contribute? So they're daily giving to the market almost 750,000 barrels. And about half of these barrels are going to China. So there is some concern building up on how long this blockade is going to be and whether that, leads to any kind of a supply disruption or not. So oil is up. Now, for us, the Indian market has been locked in a very narrow 400, 450 point range. The downside of that range is about 28,700, and the upside is what's on your screen, 26,000 to 26,100, and there's no decisive breakout. So we continue playing in that range in all probability. A lot of capital market stocks are going to be in focus. So watch for brokers, watch for wealth managers, watch for AMC stocks, because that SEBI board meet finally happened. And they have done more or less what they had proposed. the TERs have been raging. The TER has been broken up. So the total expense ratio will include what is called the base expense ratio, then the brokerages, the brokerage fee that's being paid to brokers, and statutory levies as well as taxes. So that's how the breakup is. Most importantly for brokers, some relief that brokerage cap has not been brought down to 2 basis points, which was the big fear. It has been brought down to 6 basis points. So maybe at least for broker stocks, a sigh of relief, Nigel.
Well, that's right. Well, let's focus on, the F&O action, how trade is set up. In terms of institutional flows, well, yesterday was a positive number, both from the FIs as well as the DIIs. But the more interesting factors that are playing out are actually in the F&O market. And in yesterday's trade, as we've been seeing in the last few trading sessions, the FIs went ahead and they added some short positions. In yesterday's trade, we did see the short positioning getting added by close on 6,500 contracts odd. And now, in percentage terms, it's at around 92%. So you'll ask, when was the last time we had a market that was net short close to 92%? I just rewound a little bit, went back to October. In October, I think on October 14th, we should get that data point up for you on the screen. The short positioning was around similar levels. That was the extreme. And then, in fact, the markets were holding at around this 25,000 odd mark. In the next 10 trading sessions, actually, the short positioning came down drastically, and we had the markets that bounced up a fair bit. This time around as well, the short positioning is at similar levels. 10 sessions later, let's see whether or not getting into the new year, the bulls have enough ammunition to fight back and cause these short positions actually to cover out. So that's going to be very important. One, the FI is aggressively net short. The second technical factor that you look at is the PCR. That's gradually moving to the lower end of the range. Currently, it's around 0.77. Recent low we saw was around 0.63 odd. So it has some distance to go. But both these two are getting into that oversold or, that aggressive level in terms of the short side. So that's going to be important. In terms of stocks that, the strikes that were in focus, 26,000 call, 25,900 call, both of them were fairly active because the call writers now, they believe they have the upper levels covered. While on the downside, this 25,800 put as well did see some addition with a premium in that vicinity of close to around 100 rupees. So just plugging in this, you see that around that 25,700 will be important. And on a day-to-day basis, that support level is actually moving lower. But this 25,700 level is important. I think that range of around 25,500 to around 25,700, that's important on the downside. While otherwise, you're looking at the 50 DMA, the 20 DMA, that's the technical levels that you're looking at. So, that's going to be important to defend that range on the downside. The Nifty Bank as well. Well, yesterday did see some kind of weakness, but it's important that the recent low, the last week we went to this 58,500 odd mark, and we bounced a couple of times from there. So that's going to be important. 20 DMA becomes a bit of a resistance zone. The stock that we'll be looking at will be, Bandhan Bank. That one's still in the F&O ban, but it's giving you that, if you go by the data points, in all probability, it could possibly be out of the F&O ban either today or tomorrow. Remember, central bank action is going to be top of mind for the next 24 hours. Will the Bank of Japan go the distance and hike rates? Or, do they have a pleasant surprise from a bullish perspective? So central bank action is something that we'll be tracking. A couple of indicators indicate that maybe, at least in the near term, we could see some bit of a relief either today, tomorrow, or the next couple of trading sessions because the PCR has moved to the lower end and the short positioning at the upper end.
Thank you very much for that. If Bank of Japan does raise the interest rates, it will stand at 0.75%, which is the highest in 3 decades. So after an extraordinary period of easing to combat deflation for the last 1.5 years, they've been trying to normalize it. The normalization started in January of 2024. From negative, it came back to neutral or zero. And very slowly, they've been hiking it. It stands at 0.5%. The expectation from economists is that it will further increase by 25 basis points to 0.75%. But that seems to be what's expected, so maybe is priced in, but that's the trigger. But Nigel, finally an FI buy figure.
Yeah.
I think it's the
don't know
first.
how long?
The first one in the whole of December. You have to go back 26th of November. So
It's a Christmas present.
Christmas present. It's a one-off, or we're going to get this, every day. But it's a good one.
Yeah, that's good.
It's a good one. But let's get to the equity calls then. Amish Shah of Bank of America says the consumer durable sector is now favorably positioned on both bottom-up and top-down factors. The sector is expected to see a normal summer in calendar year 2026 based on the early weather forecast. He says it is one of the few attractive pockets post the recent correction. He adds the risks are skewed to the upside. And in consumer durables, they prefer LG Electronics over Voltas and Havells India. All right, let's get back to the AI macro theme, which caused a wobble in the US markets overnight, and that's causing a bit of a cautious trade across Asia this morning. Arvind Sanga is now joining in. Arvind, before we get chatting about the Indian markets and AMCs, etc., the impact of the SEBI overhaul on TER, first, your thoughts on what's happening in the US markets, and will AI continue to be the dominant theme going into calendar year 2026? Surabhi was talking about Oracle, and Oracle is halved from its September high. That's quite a fall.
Yes, I think that AI is the dominant theme in the market because the AI capex has been one of the strongest drivers of the US economy in the last few months. So it will continue to remain important. I think clearly the bloom has come off the rose, and Oracle is obviously the poster child for that. But I think the story has many twists and turns. We think people got maybe too euphoric a few weeks, maybe even a month ago. And now maybe are getting a little too nervous. I mean, there was news after the close of the US market about Micron reporting extremely strong numbers, showing demand for memory chips and other things that are benefiting from the whole AI story. So I don't think it's as black and white. Either we've got to be a super bull or we've got to be super bear. I think where we are is kind of a more measured approach, and maybe the sell-off will create more interesting entry points.
Arvind, hi, good morning, or rather good evening your time. So just to conclude that AI point, we've seen some amount of rotation, right? Through the last 1.5 months, there's been some money rotating out of the AI trade, but it's going right back into US equities, I mean, other US stocks, or maybe other Asia, AI stocks or AI-related names. I don't think much of it is coming, it's, finding its way to India. So is that the kind of rotation that we should expect as we get into the new year?
Well, look, if AI remains the dominant theme for 26, which I am kind of doubtful, I think AI will come back to life, but it won't be the dominant theme in 26. If AI remains a dominant theme, then India is the odd man out in terms of not having really sizable AI plays compared to US or China, just to take the two big players. But I think to the extent that the themes broaden and AI, this whole debate about AI settles down and AI gets a more normal kind of outlook of growth, but not the dominant only news, then I think other growth stories like India start to emerge and start to stand on their own, and they don't have to have an AI angle to show the growth. So I think that 26, it's a long year ahead of us. We haven't even started. I suspect it'll be a more balanced year, and AI will not be the only dominant theme in the market in 25, as it was in 25, and that should be a benefit for India.
All right. Hi, Arvind. Good morning. Good to see you. And I think if you pull up a chart, of the Nasdaq and the Nifty IT index, the Nasdaq has been the big outperformer in 12 months. But as this AI trade is going a little off, you see the Nifty IT index actually that started outperforming for the last 2.5 months or thereabouts. The next 24 hours are going to be important from a central bank action perspective, Arvind. What's your expectation? Bank of Japan goes ahead, and they hike rates because that's what majority, I think, is factoring in as of now. And what kind of impact it could have on the equity markets, because there'll be that yen unwind that takes place, which could spook a lot of investors.
Well, to the extent that the market expectation is that BOJ is going to raise rates, then I don't think it should cause a major market unwind. If the BOJ were to do something even more hawkish or give a commentary which is much more hawkish than the market expects after raising rates, then that would cause, potential some unwinding of the carry trade. If, on the other hand, the BOJ surprises by a super dovish, then the carry trade gets a new leg of life. But I think that, yes, yen carry trade has been an important part of the equation in investment flows in the last few years. But I think that's been unwinding most of this year, and it hasn't really affected the ability of equity markets to outperform. So I do not see that as a key linchpin of what happens in Japan is driving global, market performance.
Arvind, and just to, close out this conversation, your view on India, what stands out for you? Any particular thoughts on AMC's brokerages on the back of what we've heard? And then your top picks going into 2026.
Well, I think that, India, obviously we'll be seeing what the fiscal third quarter numbers are reported in the coming month or so when we start getting numbers out of Indian equities. But my hope is that calendar 2026 will be in a period when we start to see earnings acceleration. We've seen great GDP numbers reported last quarter, but we haven't seen that in earnings growth from the Indian companies. We're still quite hopeful that some sectors of the Indian economy, will.
Okay, I think we've just lost that line with Arvind, but we'll get him back on in the days ahead. For now, let's quickly move on and tell you what's lined up on the show. So here's what's coming up over the next 2 odd hours. At 8:30, Sandeep Parekh of FinSec Law Advisors joins in. We'll discuss some of the measures announced by SEBI at the end of its board meeting yesterday. TER calculation and breakup has changed. There's some changes in the IPO rules as well. So we'll discuss that. At 9 a.m., Sandeep Agarwal of Solio Investment Managers joins in. We'll talk about Cyient's big deal. They've done an acquisition overnight. And of course, TCS had its investor day, and they've detailed some AI, very specific AI numbers for the first time ever. We'll discuss that with Sandeep. At 9:20, Anish Tawakle of ICICI Prudential AMC joins in. He's our market master of the day. At 9:30 a.m., we'll be in conversation with Kaynes Technologies. After that, we will focus on the review of the decade-old mutual fund and brokerage norms as announced by SEBI yesterday, including the change in the total expense ratio. Amisha Vora of PL Capital and Mr. DP Singh of SBI Mutual Fund will be with us. Towards the end of the show, in our segment, It's the Economy, Lata will be speaking with Siva Ramakrishnan of Gokuldas Exports and FIEO Director General Ajay Sahai on the weakness in the rupee, tariffs, and the overall export situation. Let's take a break on that note. Coming up, our list of top stocks to watch on the other side.
Welcome back. Yesterday was a bit of a sluggish session, but the Nifty managed to defend that 25,800 mark, a downtick of close to about 0.2%. But overnight, Wall Street has had a rough session with the Nasdaq down close to about 2% Asia is a bit muted. The GIFT Nifty is flat, but with a negative bias. What about stocks? What stocks should you have on your radar this Thursday morning? This is CNBC TV18's list of top stocks for the day. And the big one is the SEBI meet outcome. We were all awaiting that, Vinny. What are the key takeaways and the implications for the listed stocks?
Yes, so obviously that was the big event that happened yesterday, because the announcement that came in from SEBI, one, they've approved excluding all statutory levies that come in on the TER. Now they've given a new term, base expense ratio. So that is what we'll be keeping an eye out on. Expense ratio limit now will be called this base expense ratio. Base expense ratio excludes statutory levy, regulatory levies. They include which is including STT, CTT, GST, stamp duty. All of these are called statutory levies. Now that is going to be excluded from this base expense ratio. What is the other thing that has come in? Brokerage charges have been cut, but the reduction is lower than what was originally proposed. Originally proposed was much higher. That had happened somewhere in the end of October. That proposal had come in. So this final draft, which is indicating that these brokerage charges are lower than what one was expected to see in terms of the cuts. Now, what is the cut in base expense ratio? For close-ended equity schemes, it's at 1% versus previously it was 1.25%. For index funds, ETFs, liquid funds, now it's at 0.9%. Previously, it was 1%. Other than that, for mutual funds, the cut in terms of brokerage cap that has come in, that is going to be at 6 basis points. Do not forget that there's a I would like to highlight this, that this amended reduction, previously we were talking about 12 basis point, bringing it down to 2 basis point. But do not forget that 12 basis point was actually including all those levies. So on a like-to-like basis, if you compare versus the past basis point, that would be 8.59 basis point versus now it is going to be 6 basis point. This is for the cash market transactions that we are talking about. There are other cuts that has come in for in terms of limit into what the brokerage paid to the AMCs by the AMCs would be also be at 6 basis point. For cash transaction derivative will be 2 basis point. Jeffrey said that this announcement actually is more of a balancing act that has come in. It's a slight bit of a relief versus what the proposal was. So proposal was much worse. We've seen those stocks see a sharp fall during that time, and since then we've seen a bit of a correction in the range of 5 to 15% for AMC stocks, brokerage stocks, and that is why today maybe this is at least better than what was anticipated in terms of the impact. So we could maybe see some bit of a green here today.
Okay, all right, got that. Thanks for the details there, Vinny. But Rima, TCS putting out some numbers on AI finally, and then we'll talk about Cyient, but let's start with the TCS.
Well, the first headline is that the company reiterated that they want to become the world's largest AI-led technology services company. So largest AI tech services company. This was said in October when they came out with their Q2 numbers. They reiterated that. But as Surbhi said, I think the big thing is finally the company has come out and quantified AI. Up until now, whenever we used to ask them, they used to say that AI is embedded in every layer of what we do, in our own services and what we provide to the client. And hence, it's very difficult for us to actually quantify what could be the revenue. But what they've said is that we've executed 5,000 engagements. AI-related services have generated $1.5 billion in revenues on an annualized basis. This is about 5% of the company's overall revenue. The only other IT company which has quantified AI was HCL Tech. And for them, it was about 3%. The company said AI is actually growing faster than the overall company revenue growth. And if you add the new age services, which is not only AI services, but cybersecurity and others, then the overall revenue contribution is about $11 billion. Also, a marked shift, what we've seen from TCS is the aggression in building and acquisitions. Remember, they spoke about the data center. The data center plan, TPGs, investing, etc. The company highlighted their readiness to both build, so maybe go more on the data center, and even acquire. Because in the last 3 months, the company has made 2 tuck-in acquisitions related to capabilities. They said their investable surplus is $6.3 billion. The aspirational margin band remains 26 to 28%, but they're committed to making all those investments, focusing on growth. while preserving their profitability. But I think the big takeaway is that AI-related services is 5% of the overall revenue and growing faster than the company average. Cyient is the other one because Cyient's wholly owned subsidiary, which is linked to semiconductor, has made an acquisition of Kaynes Technologies. They will be acquiring a stake in excess of 65% for $93 million. The acquired company's top line last year was about $41 million. Analysts say this should add about 5 to 6% to their overall revenues. There is a conference call at 8:30, so we will listen in to try and get more details on what they have to say and share.
Okay, all right. So Cyient and TCS both will be in focus. Let's go to Ria. Ria, morning. You're watching out for a bunch of other stocks as well. Tell us more.
Well, good morning. Let's start off with Ola Electric, which is expected to open in the red after the founder Bhavish Agarwal has sold an additional 4.2 crore shares. And this is after selling roughly 2.6 crore shares on Tuesday as well. Now, on Tuesday, the company had said that this transaction was being executed to fully repay a promoter level loan of 260 crore rupees. And the company had also said that this share sale was a one-time limited monetization of the founder's personal stake. Now, up until now, these two transactions have been valued at roughly rupees 234 crores, and more selling is expected going forward. But it is also important to note that with this, all of the previously pledged 3.93% shares of the company will be released, which will remove a critical overhang for the company. But nonetheless, the stock is expected to open in the red because the substantial promoter selling will be negative for the company overall. Now, moving on to GMR Power, though, this stock expected to open in the green today after the board has approved a fundraise of worth roughly rupees 1,200 crores via the issue of preferential share issues as well as warrants. And this includes up to 6.6 crore equity shares, which will amount to roughly rupees 800 crores, and 3.3 crore convertible warrants as well, which will amount to 400 crores. And the issue price here is rupees 120.8. HCL Tech will also be in focus today. They have signed a multi-year contract with ASN Bank, which is the fourth largest retail bank in the Netherlands. And this is being done to accelerate digital transformation as well as to enhance customer experience. The last stock that we're watching out for is Antony Waste Handling. Positive news flow for this one as well. The company's subsidiary called AG Enviro Infra Projects has received 2 orders cumulatively worth rupees 1,330 crores for a period of 7 years from the BMC for the collection and transportation of municipal solid waste. And these contracts have been awarded to a JV of which AG Enviro holds roughly 51%.
All right, Ria, thanks a lot for that. Well, let's do a quick recap of all the top stocks that we're covering, with the ones with positive news flow. Nuvama Wealth, JM Financial, Motilal Oswal Financial, IFL, TCS, you have Cyient, GMR Power, HCL Tech, and Antony Waste Handling. All of them will be reacting to positive news flow. On the flip side, Ola Electric is the lone stock that will be reacting to negative news flow. That's about the equity markets. But let's hop across to the commodity markets. Manisha Gupta joins us to run us through what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we've seen a percentage point of gain in the overnight market. And with that, in the last couple of sessions, the crude oil prices have rebounded from the 5-year low that we saw in the previous week there. But U.S. has ordered a full shutdown of maritime traffic with sanctioned Venezuela oil tankers, and that has taken the sentiment slightly supportive. The U.S. also is pushing for tougher sanctions on Russia's energy sector. And then the markets are also reacting to the U.S. crude inventories, which have declined for a second straight week. And the previous week, the decline was to the tune of 1.2 million barrels, clearly supporting the crude prices to where they are. But having said that, for the year, the crude is still down by 21%. So we are heading for a bearish 2025 in that sense. What has seen support, though, has been the precious metal prices. So when you look at gold, we are trading very close to all-time highs, holding above that 43.30. Silver prices also gained 4% yesterday and trading above $66 even now in the markets there. We also have seen very strong surge come in for platinum. That gained by 4% and is trading at an 18-year highs right now. Support also coming in for palladium, copper, zinc as well. All of these metals saw stronger gains coming in the overnight space.
All right, Manisha, thanks a lot for that. Well, for the time being, we slip into a short break. Up next, we'll have Sandeep Parekh of FinSec Law Advisors, who's joining in to discuss the outcome of the SEBI board meeting, where the regulator has tweaked the MF expenses. You don't want to miss this.
Welcome back. So let's address the big news that came in post-market hours yesterday. SEBI did have that board meeting, and it has finally come out with revised mutual fund regulations. This is after 3 decades. I mean, the original regulations go back to 1996, and now we have a new set coming in. Now, for the market and for investors, it seems SEBI has managed to find some kind of a nice middle ground, because there is a change in the way the total expense ratio is going to be calculated. There is also a change in the amount of brokerage that mutual funds can pay brokers. But like I said, I think SEBI's tried for a middle ground. Let's discuss this and more with Sandeep Parekh, Managing Partner at FinSec Law Advisors. Sandeep, morning. Thanks so much for joining us early on. But, I was discussing this with a mutual fund practitioner before the board meeting just yesterday. And I was saying maybe SEBI will do something in the middle. And they also run they're a financial group that also has a brokerage. So the gentleman said that, no, but middle is not good. We would have wanted the brokerage fee to stay where it is. But what do you think? This was the big one, right? The big fear that 12 basis points will go down to 2 basis points. And SEBI also clarified yesterday that net of all the statutory fees and charges, it's basically 8.59 basis points going down to 6 basis points. You think they've managed to keep everyone happy?
No, I don't think they managed to give anyone happy. No, because if you look at it as a percentage, it's a big number, right? It's 25%, 30% reduction of. See, before I kind of comment on the specific, I think broadly, my view has been that, the regulator should not be getting into price fixation, right? It should do that only if competitive forces are not working. Let's say there's a monopoly, if there's an oligopoly. So, from first principles, I'm not a big fan of setting caps on any products, not just financial products. Having said that, I think they've tried to do a couple of good things as well, which is, the unbundling of the regulatory expenses. They've tried to unbundle brokerage, which I think it's kind of a mixed bag, really. It's good in terms of clarity, but it will have second order impacts. For instance, the smaller funds will not be able to afford the research reports which came bundled till now. So I think there will be several consequences. Again, the direct consequence, of course, who doesn't like low prices, right? So it sounds like a great thing, but there's always a cost attached.
Yeah. Okay, so let's take it step by step. I'll go back to the brokerage issue in just a bit, but let's look at the TER itself. And for the benefit of our viewers, basically a total expense ratio of a mutual fund will now have several components. It'll have the base expense ratio, which is the only thing that the AMC itself can sort of set, and that also has limits. Then there are the regulatory and statutory fees, including taxes. And then there is the brokerage that is being paid. Now, Sandeep, on the base expense ratio, again, obviously, a lot of these limits have been revised lower to account for the fact that statutory levies are now out of the BER, as it's being called. But again, it's not as harsh, because the October proposal was looking to reduce this expense ratio by almost 15 basis points. For most funds which have over 2,000 crores of AUM, final regulation is reducing the BER by about 10 bips across all the slabs. So, do you think this sounds like a fair calculation now that the other fees and the taxes are out of the TER?
Yes, I think it's more fair. I mean, going back to my principle that why should SEBI set fees, fee caps? But yeah, I mean, it's not too bad in terms of what they've done was what they've proposed. The industry has certainly grown, so I think, if you look at it from that principle, certainly it's a good thing. But it will favor the large funds and disfavor the smaller funds, and also it will favor the kind of the tier 1 cities where these are pretty reasonable numbers, versus going into tier 3 towns where I think people don't want to be paid 20 rupees or 100 rupees as commission. So it will disincentivize distribution at the bottom of the pyramid, really. So I mean, there will be second order impacts, but again, SEBI's already decided this, so I guess there's not much we can do about it.
Yeah, I mean, these are the new expense ratios, and that's how they'll go out. From an investor perspective, the only good thing is that I'm very clear about now what is the fund charging versus what is the taxation. and what is the brokerage. The breakup is very clear to me as an investor.
That's quite good, I think. That's quite
Yeah. So that now coming to this whole brokerage issue, and I think over the course of the last 3 months, most mutual fund practitioners that I spoke with, or CEOs I spoke with as well, were saying this, that many of the smaller fund houses do not have the wherewithal to set up their own research teams, their own large sort of research outfits. Now, with this 6 basis points cap, what happens to institutional research? I mean, what do you see ahead in the coming weeks and months?
No, I think it will adversely impact both the funds and the brokers as well. And again, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You have people who spend their entire lives just looking at infrastructure or just looking at transport industries. If mutual funds start hiring those kind of specialists, they'll have a research team of 100 people. So clearly, there are efficiencies in a brokerage hiring a transport expert and then distributing that research to 45 or 50 mutual fund and many other institutional clients. It's much more efficient. It's more cost effective versus having 45 different transport experts in 45 different mutual funds. So I think it will certainly have a negative impact on the quality of fund management itself. And again, I don't think SEBI has looked at that. And it's not there in either the consultation paper or on the press release which came yesterday. What is the rationale for doing this unbundling? Unbundling sounds pretty good, and I think it's good when you look at regulatory and non-regulatory expenses. But here, unbundling is actually going to reduce the quality of information which a fund will have when they're making investment decisions.
Okay, and finally, Sandeep, anything that you picked out in terms of IPOs? There were some measures announced there as well, ease of doing business, more disclosures, etc. Anything important we should be aware of with respect to the
I
IPO
think they're marginally important. And I think they've rewritten stockbroker rules and stuff like that. So I think that's a good thing. Again, those regulations are not out yet, but based on what SEBI has said, they've drastically simplified the regulations, removed the anomalies, made the compliance cost lower. So I think seems to be a good thing, and I believe they're doing it for multiple other regulations as we speak.
Okay, all right. Thank you very much for your quick take, quite helpful as we understand these new regulations that are going to be governing mutual funds and, of course, the IPO regulations as well. Thanks for joining in. You have a good day. That's a view from Sandeep Parekh coming in. We have Deepan Mehta from Elixir Equities now. Let's carry the conversation forward, particularly on the capital market stocks. Then we'll get to the rest of the market. Deepan, morning. So I was asking Sandeep just this. Have they managed to keep everyone happy or no? And Sandeep was saying not really, because of brokers, ultimately you'll get less from mutual funds. But at least it's not as bad as that much feared 2 basis points, right? What would you expect? AMC stocks, wealth management, broking stocks. Do you think there'll be some sort of a relief rally today? And then, I mean, are you buying anything or holding anything in this space?
Good morning, Subhi, and thank you for having me on your show. Yeah, I think that it is going to be mildly negative, but much better than what the street was expecting. But, end of the day, the mutual fund companies, the AMC listed ones, their play is more in terms of how much fresh AUM they are able to raise from new customers and how the SIP sustains. And of course, as a mutual fund, you always get the benefit of the appreciation in your portfolio or the AUM, which comes naturally year after year. So the cut in TER is not going to be that much of an effect, and it will get neutralized or marginalized over the next 2-3 quarters or so. Cut in brokerage doesn't affect them at all, and I don't think any institutional broker listed. So from that point of view, you don't have to have any concerns over there. But end of the day, I think it's a great industry, the AMC industry, and it's a nice annuity-based business, and especially the top 2-3 mutual funds. They have got very strong position in the market, and they keeping on raising their market share, like we saw in case of ICICI Pru AMC also. So very positive on the business per se, and it's nice steady cash flow business. So, and I don't think these developments are going to impact too much the prospects of this particular industry group.
Okay, so not very disruptive, manageable, especially for the large AMCs, and many of them are also moving more towards advisory, rather than the pure commission, which also helps with the profitability. But maybe some of the smaller brokerages will feel the pressure. Dipan, quick comment. TCS, were you, anyone in your team, part of the analyst day? And are you happy? I mean, how do you feel that they finally come out and said $1.5 billion of AI revenue? I mean, is that number adequate? Is that something that you had in mind? 5% of the overall revenues coming for TCS coming in from AI. Was your own expectation higher? But it's a start in terms of disclosures.
Yeah, Rima, first of all, we have stopped tracking TCS so closely for a long time. And, unless these large cap technology companies can demonstrate significantly higher growth rates on a sustainable basis, I don't think that, a lot of funds, or at least we are going to track it that closely. There could be a strong trading rally in IT stocks. I completely, figure that may happen because of rupee depreciation, because of base effect. And also, I think that some amount of revenue flows will start coming through from all the contracts that they have won. But end of the day, I think in my 30 years, I haven't seen such a major technology trend hardly having any effect on the revenues and profits of the IT services industry. So that's a bit disappointing. I would say valuations are reasonable, but then growth rates also have come off. So at this point of time, my assessment is that to remain invested in the software services companies and wait for a nice bounce, which may take place maybe this quarter, next quarter or so. But I don't think that these are great long-term growth stories which can create a lot of wealth from these levels. At best, they can protect your wealth or give you market returns also.
All right, Deepan, we've got plenty of more questions for you. Request you to stay with us. For the time being, we take a short break. You come back. We'll continue our conversation on the fundamental side. We'll also get in our technical experts. Don't go anywhere. Welcome back. You're tuned in to Bazaar Morning Call. Well, it's that part of the show when Hormuz joins in to tell us all those stocks that are moving around and some that were backed with delivery. Hey, Hormuz, morning.
Morning, Nigel, and can't not talk about Meesho and the kind of move that the stock saw yesterday. It's only been, 6 days of trading. The stock has almost doubled from its IPO price, locked in a 20% upper circuit yesterday after a positive brokerage note. The second best day that the stock saw in its trading history so far. Almost 18 crore shares were traded. Almost 3 crore shares were marked for delivery out of that as well. The trading volumes were well over 50% of its free float market cap as well. So shares with almost 4,000 crores were traded yesterday on Meesho, and the market cap nearing 1 lakh crore rupees as well. So keep an eye out on Meesho. IGL, and of course all of these CT gas players were in the news yesterday. IGL had its best single day gain in 6 months. Wednesday's volumes were the highest since the start of the year, which is in January. Close to 3.5 crore shares were traded, 20-day average of close to 21 lakh shares, and out of those only 44 lakh shares were marked for delivery, the 20-day average of just around 10 lakh shares. But the stock has trying to recover from those 52-week lows, still down around 16% from the 52-week high of close to 230. And Roto Pumps was one name that made a move in the broader markets yesterday. The stock saw its biggest single-day gain since July of last year. Volumes the highest on record. The volumes are yesterday's volumes put together of almost close to 300 previous sessions, and over 7 crore shares were traded yesterday on Roto Pumps. The 20-day average of around 3.5 lakh, and out of those 7 crore shares, only 45 lakh shares were marked for delivery compared to a 20-day average of 1.5 lakh. And yesterday's turnover of close to 500 crore rupees is well above its free float market cap.
Thank you, Harmis, for spotlighting these stocks. Nigel, one theme that we've heard commonly from many of the experts is that it appears the CV cycle is now turning and could be at an inflection point. And I think today, Harmis, even BofA has written on Tata Motors CV, and they too believe that India's CV market is set for a re-rating.
Indeed, and both BofA and JP Morgan have initiated on the commercial vehicles business of Tata Motors. Both have come out with a buy/overweight rating. Both have a price target of 475, projecting a upside of around 23% from current levels. Now, what BofA is saying is that Tata Motors CV is a proxy play on the India and European Union truck cycle, which is close to bottoming out and poised for a rebound going forward. And it is expecting a 15% EBITDA CAGR over FY26 to 28. Now, why is it expecting a re-rating to happen for Tata Motors CV? The steady market share, a margin discipline, a 35% plus return on capital employed or rose through a trough cycle as well, and lower regulatory risk because of the less exposure to electric vehicles is what is likely to lead to a re-rating. They also said that the Iveco deal will likely yield the positive equity value accretion, and the balance sheet deleveraging will also be beneficial for the stock going forward. Now, what JP Morgan has written is that their positive stance is driven by an expectation of a modest recovery in the CV business after 3 years of practically no growth whatsoever. The pricing discipline by large players, which has aided the margin and the ROS expansion, similar to what BofA highlighted in a down cycle. The Iveco acquisition, they are expecting that to be margin accretive, and the EU truck cycle, as you were mentioning, is closer to making a bottom. They are expecting an EBITDA/EBIT CAGR of 13 to 16% over the next 3 years, and that will be leading to a free cash flow generation of $162 million, and that will also be positive for the stock going forward.
Thank you very much for that. I was just revisiting the November sales numbers for these CV makers. For Ashok Leyland, November sales went up by 29%, ahead of estimates of 17% growth. For Tata Motors CV, again better than estimates, with total sales increase of 29% versus expectations of mid-teens kind of a revenue growth. Dipan, are you looking to play the CV cycle? Is there a recovery afoot? Because these recoveries generally last for a few years, the cycle. Are we at the beginning of it? And which would be the best way to play it, if at all?
Rima, I think these are great cyclical businesses, and the fact that CV industry is doing well, you can then assume that basically industry manufacturing also is doing well, and so is infra. And our preference would be for Ashok Leyland, which has been steadily able to increase market share, and they have a great export potential as well. And in terms of new launches also, I think they are perhaps ahead of the curve, reasonable valuations as well. So I think within the auto industry, this is one segment that one should remain overweight in. Least amount of threat in terms of electrification or even fresh competition coming in from overseas players who are starting businesses over here, which is the case in the passenger vehicle industry. And on the whole, I think lower financing, lower interest costs will certainly benefit the cycle even more because you will have more and more replacement of old vehicles. So very positive on the CV industry. And I think one can be overweight on both companies, Tata CV as well as Ashok Leyland, but just Ashok Leyland is a better preference because of good track record.
Correct. All right. Hi, Deepan. Morning. And good to see you in. Deepan, I wanted to ask you, what about Ola? There was a lot of excitement on the stock. Stock went dancing away, actually. And now it's at a 52-week low. And last couple of trading sessions, promoters selling stake. What's your view at 32 rupees?
Yeah, I think it's been the biggest disappointment in the IPO market. And we've always been negative on Ola at various points of time, but I don't know, that they don't seem to be getting the market share which we thought and the street thought they would be able to get. In fact, traditional players like TVS, Bajaj Auto, they're able to get higher market share than Ola, despite being, a standalone, dedicated EV producer of two-wheelers. And on the whole, what has also happened is that because of these GST cuts, the incentive for owning an two-wheeler EV, that price gap has reduced. So that's affected the demand as well. So I would just pass Ola Electric at this point of time. Let us wait and watch and see how they're able to regain the market share and then maybe look at the stock in fresh light. But right now, I think even at these levels, there's no point bottom fishing, that's for sure. But if you're already holding the stock, I think the time to sell is gone. You just remain invested for a longer period of time and see how the company shapes up, or then look for exit opportunities.
Okay, so wary of Ola Electric, got that. Deepan, Misho, I don't even know what to ask you. 111 to 200 something in a matter of, I think, 5-6 trading sessions since the listing. There's Zepto coming next week. And in the midst of all of this, we've seen the actual, the big listed boys, Eternal particularly, it's lost a fair amount of ground in the last couple of weeks. What is your advice on this whole space?
No, Surbi. Misho is very different from Eternal and all these Septo and all of these companies. Misho is more like Amazon and Flipkart. And because these two companies are unlisted, I think investors have flocked to Misho, which of course is the largest online marketplace as well. And I was very positive on the IPO, but I did not expect.
Okay, I think we've just lost that line. We'll try and get Deepan back a little bit. But this whole new age company space, he was making the point of course, they're very, very different business models, Misho and Eternal, very different outlook as well. But in general, this whole space of consumer technology companies, it's just seen a hectic amount of action. I think Deepan, just complete that point. And I was not drawing exact comparable in terms of the business models. I just meant to say this whole consumer tech space. And the e-commerce space, that's just seeing so much of action. But yeah, you were telling us about Misho, and then now what to do with this kind of a rally. If someone got in anywhere between 100 and 140, should they be selling now? Because UBS yesterday put out a price target 220. The stock is almost already there. So should you cash in? Should you buy more? Should you wait for a dip? What do you do?
I think Surbi, you remain invested, and there could be a correction, because this is initial listing. There's a lot of pop and a lot of frenzy around new listings, but it's a great long-term story, and I wouldn't want to sell off just because the price is rallied like this.
Okay, stay on. We need to slip into a very short break. We'll come back and get you the pre-opening rates. We'll also be joined by Sandeep Agarwal of Sovilo Investment Managers to discuss about the key developments in the IT sector. Cyient Concall. Key takeaways are also flashing for you on your screen, where the company says that from year 2 onwards, the acquisition of Kinetic will be EPS accretive for Cyient Semiconductor, and the company says they have a clear line of sight for revenue and margin expansion. Get into a break and come back.
Well, as you could see at the top of the screen, we're winding down to get the pre-open rates. In a short while from now, we'll have more concrete rates, and we'll also have, the official rates after the next 15 minutes or so. So it's a good time, actually, to get in Sudarshan Sukhani of Technical Trends, as well as Siddharth Rai Mangala of Stock Box Technologies, who joins in. Hi, Sudarshan and Sid. Good morning. Good to see you all in. Sudarshan, what are you making of the recent price action on the Nifty first? The F5 short positions are at around 92%. The PCR has come down to around 0.77. Do you think the markets still have some way down to go, or would you gradually start building some long positions?
Good morning. See, the Nifty is now standing at a very significant support zone of between 25,700 and 25,800. Now, I can't predict what the markets will do. Usually, this is a very good time to buy the dip and wait for a Christmas rally. But this time, it seems to be different. So the correct approach to this market is to wait patiently and see if this support zone holds. It's better to buy 50 points higher than to buy now and see the market go down. There is no question of short selling at this point of time, because at a support zone, we do not short sell. We just wait to see if the support is holding or not. So the trade is, if the 700, 800 support zone holds, look to buy maybe at 25,900, 25,950, when there will be an affirmation of strength again.
Got it. All right. Sudarshan, Sid, coming across to you. What's your take?
Hi, Rajal. Good morning, and thanks for having me on the show, first of all. See, Rajal, if we talk about Nifty, I do think that the last 3-4 sessions, the movement in the last 3-4 sessions has been quite discouraging for the bulls, at least because we started seeing the index making lower highs consistently for the past 3-4 sessions. On Tuesday, 26,000 started acting as the resistance, and yesterday, 25,900 became a resistance for the index. And in fact, even now, I do think that it's not a very good idea to be going contrarian on the index even now, because if we spend some time below 25,800 now, this fall can quickly extend towards 25,650 and even towards 25,550. So at least as long as we are below or around 25,800, we should not be looking at going long in the index. We should be looking at the level of 25,900. If the index manages to somehow go back about 25,900, we can then definitely start looking for making some fresh long positions. But till then, it won't be a very good idea to go long on the index, because the structure looks, weak as of now.
Got it. All right, Siddharth, let's get to some stocks then. Sudarshan, your view first. Which are the stocks on your radar?
Well, it's Bharti Airtel, which is a buying opportunity with a stop under 2,070. State Bank, which is a buy with a stop under 960. And Titagarh, which is a buying opportunity with a stop under 760. So I have 3 buys. And one intraday short is HCL Tech, where a short selling trade can be taken with a stop above 1690.
What a wealth creator Bharti has been, 30% this year. In the last 3 years, 150%. And in the last 5 years, it's been a 300% rally coming through on Bharti Airtel. And yesterday, when Morgan Stanley came out with their bullish overweight call, they put the target price above 2,400. And that tariff hike has still not come through this year.
Yeah.
So next year, that will be the trigger to watch.
Absolutely. It's been a star performance. It's been that kind of a year, right? You've got stocks up 50% on the Nifty and down 50% on the Nifty itself. It's just been extremely polarized. Gentlemen, just to complete the calls, Siddharth, what stocks will you go with today?
Yeah, sure. So we see, I think it would be a much better idea to go to have a balanced approach right now. So 2 stocks, one of these we have to buy, the other one will go short. The first one which we have to buy is APL Apollo Tubes. See, there was a very strong up move from its supports in yesterday's session, and I do think that the fresh momentum has begun in this counter. So this can be bought right now. The spot was trading around 1765 last time I saw. We can buy it here. The stop loss will be at 1749, and our targets being the first target 1795 and the second target 1810. The second stock, this one we have to short. The stock, the name is CAMS, Computer Age Management Systems. We saw a breakdown below a very important support zone yesterday. So a negative momentum has started in this counter, and weakness can definitely extend in the upcoming sessions. So we'll look at the December futures. If we find it around in the 735, 740 region, we can sell it in that range. The stop loss will be at 755, and the targets being the first target 715 and the second target being 705.
Thank you very much for that. Cyient should be a stock on your radar. The company's wholly owned subsidiary, which is focused on semiconductors, not the digital engineering business, has made an acquisition. They will be acquiring Kinetic Technologies for a stake exceeding 65% for $93 million. That is the headline. The acquired company had a top line of $41 million for this year, calendar year 2025. What the company has said is that the semiconductor business will have a revenue of about $50 million by FY27. So basically, this acquisition practically doubles the semiconductor business. The company in the Q2 conference call had also said that the semiconductor business is currently loss-making, but we will be making it EBIT neutral by FY27. In the conference call today, Cyient said the acquired acquisition will be EBIT accretive in this next year, FY26, and by FY27, year 2, it will be EPS accretive. The only thing is, JP Morgan says $93 million appears to be slightly more on the expensive side because the company will be paying an EV to revenue of 3.5 times, which is higher than the 1.92 times they had paid for the prior few acquisitions. And also, the company in the conference call has said that this funding will require some amount of debt. So part cash, but I think they went on to say that they will explore all forms of funding options, including debt for this acquisition. So that's Cyient for you. Stock is up close to about 2%. Sandeep Agarwal of Sovilo Investment Managers is now joining in. Sandeep, I know you've liked many of these engineering R&D sort of companies. Now, in the semiconductor business, you've got Cyient as a play. So first, share your thoughts on Cyient, what it's been doing, because it's been struggling if you look at the stock price, and then what this acquisition brings on the table.
Yeah, hi, good morning, and thanks for having me on the show. So, yeah, you see, it is not only about Cyient, but broadly, all the companies have gone through massive correction in that space because the growth rate has come down a little bit and the multiples were very, very high. Now, if you see the space, I firmly believe that, the R&D space is bound to grow at 2.5 times of the IT services space, primarily because in the R&D space, the penetration levels are 1/3 or 1/4 of the IT services space. So this space is bound to grow. And the skill set which is required in this space is even scarcer than the skill set which is available in the IT services. So obviously, this space has a much stronger moat and much stronger competitiveness for a longer time period than IT services, and hence this space will do phenomenally well in the next 10 years. But having said so, the multiples of this space have been very, very high. The PEG ratios, if you see, they run between 3 to 4 times. I believe that, the PEG ratio has to come down a little bit, and we have seen that there are a lot of acquisitions happening in the space, whether it is Cyient, whether any other company, even the IT services firms are doing a lot of acquisition to add skill sets, to add, to fill in the gaps which are there. In the space which Cyient has done an acquisition, I think that space has been doing quite good and it is a strategic step going forward. But as rightly mentioned by one of the analysts, note that, this acquisition is quite expensive if you see on the revenue basis. And also remember that the expectation of it breaking even on EBIT level next FY27 is also an expectation, and generally in large size acquisitions which we have seen in the past also, it generally takes more time, and also it is very difficult to comment because we don't know what are the exit clauses after the final payouts are made and all those things, and they have haunted Indian IT companies in the past very badly because what has happened after acquisition, a lot of key people have left. So all those things has to be seen, but yes, utilizing cash for adding skill set and filling the gaps is a very good strategy in my view. The price could be 10-15% higher or lower. No one can, know that in detail.
Before we get to TCS, Sandeep, very quickly, top 3 questions if we get the management of Cyient Semiconductor on this.
I think the most important question for us will be whether this is a skill set acquisition, this is a customer acquisition, kind of, acquiring for getting steps on the customers, or it is a geographical acquisition. That is the most important question because that will give a lot of clarity on how this company will change, go through strategy in next 3 to 5 years. I think that is the most relevant and most important question, and it will also give you an idea what will be the margin profile in next 3 to 5 years. I believe that this space is a space where margin profile will always remain much lower than the IT services and the R&D space. So In long term, I think from a margin perspective, it could be dilutive. So that question only the management can answer, and I think that is the most relevant question.
Okay, got that. Sandeep, now let's get to TCS. We've asked, and I'm sure you have, about quantifying, making AI as a standalone revenue line item. And we've always said that, we embed AI in every contract, whether it's cost takeout, in our productivity, internal productivity, or outcome-based contracts. But, the Investor Day, were you attending it to begin with? And what were your key takeaways? $1.5 billion in terms of AI revenue.
No, so I have not attended, but I have gone through the highlights, all the notes which have come through, and I have gone through those notes, and I understand that, management for the first time has given a separate revenue for not only the AI, but also the next generation business, which they are saying is at $11 billion on an annualized basis. So, this is a very good disclosure, and it gives a lot of clarity to the analyst community and the investor community on projecting the future of the company, on the financials of the company. The only thing which I would like to highlight is that, the base at which the 1.5 billion is, that base is much, much bigger. And while I am very, very confident that our Indian IT services companies always will outperform the global IT services firm by 3 to 4% at least, because of the cost arbitrage and because of the mass scale capabilities we have to execute. But the only challenge which I always face in this space for last 2 years I'm struggling with is that this space, the penetration level has gone up substantially, and all the new technologies which are coming, they are coming for a very short duration and very short execution period. So what is happening that the advantage which large caps used to have 5 years back, that, all the contracts were very big size, and by default, their balance sheet always qualified very few number of players for every tender, every bid, every deal. That moat has gone away post-COVID post-COVID and digital, because the sizes have gone so small that now everyone is qualified to participate in those deals. And because of that, you're seeing that for last 5 years, if you see the data, the mid and small cap have outperformed in terms of revenue growth, the large cap. And this will continue in my view, because sizes will keep on shrinking, and also the execution timeline will keep on shrinking. So the balance sheet numbers which were required to participate in a deal, that is no more a requirement in my view. And that is the reason large companies will always have a revenue growth challenge.
Yes, you've been making that point, and stocks have underperformed. Very quickly, Sandeep, do you think some experts are saying that maybe there is a tactical rally which will take place in technology names? So do you have an opinion for the next 6 months? Will IT do well?
So in my view, what has happened is that most of the people, because of underperformance and all, generally people run towards performers. So everyone has cut down position in a significant way, including us. We have cut down our position 18 months back, and also the way rupee is behaving, and there is a lot of uncertainty. So there could be a hiding place which is there in IT. And remember, this is a space where the cash flow yields are very good, managements are very good, the disclosure levels are superb. So people always find a lot of comfort here. So I believe that this sector will always be a portion of the core portfolio for long-term investor, because it gives them all the benefits. It can also be treated as quasi cash or defensive, whatever you call. So I think at a price, people will come and buy, and the way rupee is behaving, I will not be surprised if there is some kind of move in the sector.
Okay, all right. Thank you very much for that, Sandeep. Good to get that perspective. Great conversation as always. And by the way, in case we don't speak again till the new year, wish you a very, very happy new year. But who knows, with IT, maybe there's more news. Maybe we'll need to call on you again. So thank you. Thank you so much for joining in.
Happy New Year to everyone, yeah.
Thank you. Thank you very much. Okay, very quickly, let's just check where the pre-open has settled. About 53 points on the downside on the Nifty. Mid-cap index is totally flat. Bank Nifty is down by about 0.3%. Quickly getting to our technical experts for the final call. Sudarshan, which stock?
It's Titagarh. Buy Titagarh with the stop under 760.
Okay, got it. Thank you very much. Over to Hormaz then. He's picked out a couple of interesting stocks based on brokerage reports that look, interesting today. Hormaz, which ones?
A couple of them, upgrade and a downgrade. Firstly, BofA's upgrade on Voltas. In fact, it's a double upgrade to a buy from an earlier rating of underperformed. Target raised to 1555 from 1250 earlier. Now, the biggest beneficiary among the consumer durables names is what BofA says. In case there's a likely normal summer in 2026, the pent-up demand, low base and cost tailwinds will also be beneficial potential for the stock. Of course, they expect Q3 to be subdued due to seasonality, but they're expecting a sharp 44% earnings CAGR over FY26 to 28 due to a low base. On the flip side, Jefferies has downgraded Hero MotoCorp to an underperform rating from its earlier rating of hold, also cut its target to 49.50 from 55.50 earlier, expecting a 15% downside. Although they remain positive on the two-wheeler demand outlook, but they say that the GST cut-driven demand boost that these two-wheelers had received has waned out for Hero in particular in November and December. The registration market share has also dropped, and at 20 times FY27 PE, it finds the stock expensive, hence the downgrade.
Okay, all right, Hormaz, thank you very much for the updates. We'll keep those stocks on the radar as well. We're just getting set for the countdown. I'm quickly looking at some of these AMC stocks. So they're in the pre-open, they're all responding to that relief rally because the base expense ratios, which have been tweaked, there also the reduction is not as onerous as what was being proposed in October. The broad cut is about, for funds which are more than 2,000 crores in AUM, the broad cut is about 10 basis points. Earlier, SEBI was proposing a expense ratio, so it's better than expected. And even for brokers, it's a sigh of relief. The brokerage fee cap is at least not as low as 2 basis points, which was the earlier proposal. Here we go. So let's see how it's playing out. 1 point down on the Nifty, now 10 points, 30 points, 34 points lower. It is a lower start. It's becoming quite clear, but it's not sort of a washout by any stretch. Tata Motors about 1%. Eternal is slightly lower. The Bank Nifty is absolutely flat. The mid-cap index is totally flat. Actually, before we talk about other stocks, let's just look at some of these names. HDFC, AMC, Nippon Life India, Aditya Birla Sun Life. All the AMC stocks are up between 2, 3, 4, 5% because, as I just explained, the unbundling of the total expense ratio is something which was on expected lines, and the reduction in the base expense ratio is not as big as what SEBI was proposing in October. So that's a relief. Quick check on the broker stocks. Let's see what Novama and Motilal Oswal, etc. are doing, IIFL. All these stocks are also flat because the brokerage fee cap is about 6 basis points now. So that's how we begin. But yeah, guys, 50 lower on the Nifty for now.
Well, that's right. A few stocks, though, actually from the broader markets are reacting. I think we had some positive news flow on Anthony Waste, so that one, in fact, has opened up with a sharp uptick in today's trading session. Let's get that one up for you on the screen. They've got a 1,330 crore municipal solid waste contract from the BMC, so explains why that stock is doing well. IOC, I think, is seeing a bit of a gash, so let's pull that stock as well up for our viewers on the screen. IOC is a little bit lower. We'll just keep an eye out on that name. What else is moving around? EPAC Durable, well, that's seen some profit taking. Remember, for the week, it's up more than 15%. Misho is flying away as we speak. Equus is up close to 2.5% and volumes are quite large. Grow, that's higher today. Volumes quite large on that particular one as well. So big uptick is what we're seeing. Tata Motors PV is under pressure. We have a Patel Engineering as well, a little bit lower. But I think we should get Ola Electric as well because the founder out there, Bhavesh Agarwal, he's gone ahead and sold another 4 crore shares odd. We're waiting by. Hopefully, Bhavesh joins us here on CNBC-TV18 to clarify what's the intent. Is he done? Is there more to sell? And what's the outlook with regard to the business? GMR Power, the board has approved a fundraise worth around 1,200 crores via the preferential share issue and warrants. So I think we should get GMR Power as well up for you on the screen. HCL Tech, well, they've signed a multi-year contract with a bank. I think, I'm not sure whether or not, the stock is up close to around 0.5%. KPI Green, some positive news flow. That stock is well up and about in today's trading session. Large volumes on that one.
Well, Tata Motors CV is having a good start to trade. That's up close to about 2%. The stock is approaching 400 rupees. Today, BofA and JP Morgan have initiated coverage with a bullish call, and their target price is at 475, which means more than a 20% upside from current levels. But outside of Tata Motors CV, sectorally, it's autos which is the biggest drag today, with a fall of close to about 1%, 0.9% lower on the Nifty Auto Index. So Tata Motors passenger vehicles, Bajaj Auto, M&M, all down in excess of 1%. Eicher Motors, Maruti also reeling with some minor cuts. So sectorally, autos is subdued, the top loser, but Tata Motors CV is doing well. HDFC Bank has been a bit of an underperformer. Now, it's open lower, but this week, HDFC Bank has a cut of close to about, I think, 2 odd %, which has underperformed the Nifty, which is down 1%. So HDFC Bank has been a bit of a drag, and Shriram Finance continues to see buying. Yesterday, stock paired some of the gains, but that board meeting is tomorrow where they will consider a fundraise. And Shriram Finance ahead of that is up nearly 0.5%. And IT is having a good day. Maybe we should get the rupee rate. Yesterday, after crossing the 91 mark against the dollar, making a new record, towards the end there was a sharp rebound. And I think the Nifty rupee closed at 90.38. Well, it's advanced another 4 paise. So it's 90.34 against the dollar rupee. So steady compared to yesterday's level. So IT is having a good day. Infi, Wipro, HCL Tech all up 0.5 to 1%. Tech Mahindra also on the buying list. Cyient, we should get that up. But the fact that I think India, it doesn't have that AI trade is working in our advantage today. Just pull up the Asian market picture. You've got a cut of, I think, more than 2% coming through on the Korean market. Kospi is down 2%. Nikkei is down 1.25%. Hang Seng, the Chinese markets, Taiwanese markets, all lower. So they're falling in sympathy with the cuts seen in NASDAQ, what happened with Oracle. But India today is, insulated in that sense. So it's a flattish, sluggish open, but no deep cuts visible right now.
Yeah. And
Just one correction on IOC. It's gone ex-dividend. So that's why the stock is down. Adjusted for that, actually, the stock will be more or less flattish.
Oh, okay. So that's where we are, right close to the lower end of that trading range. Remember, in the last, 2 odd weeks, the market has traded exactly in this band, 25,700 on the lower side and 26,100 on the upper side. Where does the market go from here? Well, let's put that question to Anish Tawakle, co-CIO equity at ICICI Prudential AMC. Anish, thank you so much for joining in. Your business is actually the most interesting one, right? So much is going on. Of course, you folks yourself are coming to the public markets and investors are eagerly awaiting it. Phenomenal response to the anchor book as well and the overall issue. But really, capital market as a play, now, as we saw yesterday as well, but regulation is forever changing. But it is, the financialization story is also very, very real. So within this entire space of financialization, beyond the banks and the non-banks, beyond the lenders, how are you looking at the rest of the financial services space? And there's a lot of interest as well, investor interest. We've seen what's happened with a lot of these tier 2 banks and foreign investors wanting to come in. So let's start right there. Your view on investing in Indian financial services in 2026.
Yeah, Surbhi, thanks for having me. So the way I see it, look, while there is a long-term story of capital markets growth, one also has to be conscious that we are probably at a cyclical high, right? And one should be careful when invest, even if there is a structural story, while we're at a cyclical high, you need to be slightly careful. We like banks, particularly the larger banks. So on the banking side, the way I see it, banking is an industry that's driven by scale. So, and you can see in any country in the world, there are not more than 4 or 5 national banks. So when playing banks, I prefer larger scale banks. I'm not of the view that capital will help solve some of the problems of the smaller banks, because capital has never been the problem. The problem has been distribution and customer franchise. So in banks, I would stick with the larger banks. In the capital market side, one has to be conscious of cyclicality also. And as we've been seeing, some of the smaller cap stocks have not been doing well. And that will create some pressures in the brokerage side of the business, which I think is very, very transaction driven. Because transaction activity is probably at the peaks, at a cyclical peak.
Okay. Anisha, hi, morning. You want to comment on AMCs? I know you're a part of one and yours is coming to the market, but as an industry on AMCs, because the big risk, even when your IPO was open, was more on the TER front. I know the impact is softened. It's a lot less compared to what was feared in October, but as an industry on AMC, what is your view now?
So given that we are in an IPO, there are constraints on what I can say. What I would highlight though is that, regulation, particularly when it reduces expenses, has over the longer term helped grow the industry because the product becomes better for the consumer, and that always helps the industry growth. Both transparency and cost reduction have always helped the industry. I think the one other point I'd make is I think AMCs are less cyclical than brokers because the asset base is steady. And the AMC industry is less capital intensive than, say, other parts of the financial services industry like banks or insurance. So what ends up happening is that the AMC industry is able to pay out a higher proportion of its earnings than some of the other capital-intensive parts of the business.
Speaking of capital, Anish, and you said, capital is not the real issue for banks. I want to ask you that same question about insurance. Whether capital is the real issue for insurance or not. In fact, I wrote a piece on this. We'll probably put it up today. So, yes, there's 100% FDI now. But does that move the needle, really? Is that the real issue? Behind 1% penetration of health insurance in this country and 2.8% penetration of life insurance in this country, at a time when the mutual fund industry seems to have done a lot better. What's your take on the bill and overall insurance as a space to invest in?
Oh, we like insurance, but I like life insurance more than general and health insurance. I think the way I see it, life insurance, particularly if you look at LIC, which has been the historical player, actually has been has actually done a reasonably good job of reaching out to various segments of customers. Now, the problem with health insurance, particularly in my view, is that health insurance is less about delivering healthcare than about managing fraud. And that is always very challenging, right? You have to manage fraud from the hospitals, fraud from the patients, fraud from the doctors. So health insurance is actually very, very difficult industry to manage. And I'm not sure we've had models that have demonstrated sustainable performance in that industry yet. So I'm not confident of how the health insurance industry will play out. Life continues to do well, but I don't think the issue is capital there. There's actually cross businesses, right? Given the state of the capital markets, capital has not been a problem for anybody with a good business.
Anish, to move to a very different subject, and this is not really about a particular stock or a particular IPO, but I wanted to get your sense on what's happening in the market. And I'm only taking Meesho as an example. An issue comes in at 100 rupees and the stock doubles in 7 trading sessions. So is what we are seeing, did the iBankers get it wrong? Or has the market become very, very short-sighted in terms of the whole price discovery mechanism and then discounting the future? What is really going on with some of these new IPOs? And they do have a layer of tech. And since we don't have deep tech or AI, I don't know if that's what's causing the excitement. But as someone who's managing a large sum of money, how do you look at some of these consumer tech issues and what's happening to the price?
So look, when I manage funds, my criteria is I want to have a demonstrated track record of profitability before investing. And that has helped me. And while IPOs do very well in the initial spurt many times, you can also see if you look at the 5-year performance of IPOs, that's not so great. Because when an IPO, one has to remember it's the promoter is effectively diluting, he's effectively selling. And therefore you have to be careful about, how, and at that time, obviously performance is probably at a very peak level. So you need to be careful about how you extrapolate that. And I think that has worked well for me. Look, in general, in the markets, I would say, when you're seeing a lot of promoter selling, a lot of private equity selling, you have to be careful. And that is what has been happening in the small and mid-cap space, right? And if you look at that overall space, it's kind of weakening. Because, I distinguish, I say there are 3 types of companies. There are hardware companies, there are software companies, and vaporware companies. Vaporware companies being ones where the narrative is way in excess of the reality. And I think those narratives are being exposed. And I expect that to continue. So small and mid caps, I would still be careful. Large caps, I think, are offering a reasonable risk-return trade-off over a 3-year view.
Anish, what else do you like going into 2026? What are the big themes that will dominate investment?
So our view is that the economy will regain momentum, right? So we think we are positive on the economic outlook. And as a consequence, we like basically sectors that do well when the domestic economy does well. So that's stuff like financials, it's stuff like industrial and capital goods, automobiles, and also cement. In financials, the one area where we are concerned is the unsecured consumer lending space, which we would avoid even at this stage.
Okay. All right. Anish, final question before we let you go. What about the EMS space? That's a space that has a long runway. India is growing at more than 30%, the EMS industry. China, obviously, much larger than us. That's growing at around 10%, while the globe is growing at around 5%. Any view on this EMS theme? Because the space appears, it has a long runway, but valuations got a little too frothy. Your take post the recent correction?
Look, I have avoided EMS companies. I'm not sure of the competitive advantage these guys have built. I think the market is making a mistake by giving a multiple to PLI earnings. PLI earnings are reported as part of normal profits, and the market is giving a multiple on that. That is not correct because those are non-recurring earnings. So if you exclude, the way you should look at PLI earnings is exclude the EMS spaces. You should exclude the PLI income from the profits and value it. And you know what absurdity has been happening as a consequence of this? A company gets a PLI of 1,000 crores. Its market cap goes up by 10,000, 15,000 crores. Now, what does this mean, right? It means that there was an opportunity for a company or a business to write off 1,000 crores and create 10,000 crores of value. You didn't need the government's money to write it off, right? Your investors could have done it in any way. So when I see that happening, right, when I see a company getting 1,000 crore PLI and its market cap going up by 15,000 crores, I say, look, what are we saying about ourselves in the financial markets? That here was this great opportunity, which we, as with all the leading mutual funds, venture capitalists, private equity investors sitting here, were not willing to fund. But now that the government has funded it by 1,000 crores, we are willing to back it. So I find this whole EMS, which is backed by PLI valuation, completely I can't understand.
That's an interesting point you make over there, and one that we will definitely keep in mind. Anish, finally, just coming back to that whole issue of tech and the lack of deep tech and AI themes here in India, which also kind of circles me back to a lot of these consumer companies which have a layer of technology built into their operations. Now, it could be it could be an e-commerce player, it could be a lens cart. But the fact is that, they all project a layer of smart technology. Now, in 2026, how should investors think of technology, both in the traditional sense, IT services? TCS just yesterday kind of gave us some glimpse of what the AI revenue is looking like for the company. So how should one look at IT services? Would you like anything there? And how would you look at new age, so-called new age technology in the marketplace?
So, our sector views are best reflected in our business cycle fund. And if you look at the published portfolio, we are running IT 0 in that. But I'll distinguish between the sort of mature software services businesses and the new age tech businesses. See, I'm avoiding the mature software services business because my view is that the US economy will probably cyclically weaken from here. Right? I think US economy has been cyclically very strong, and I expect that to weaken. So I'm avoiding the IT services space. On the new age tech, look, the way I see it, I'm not sure of what the real market size is, right? Because when you're operating with losses, obviously you can sell a lot. I always say that, if you go to, in a gurudwara, the langar is always full. You're giving away food free. It will always be full. When you try to convert it into a restaurant, that you cannot expect the same market size. So I am careful of companies that are, losing money and growing, because the true market size may actually turn out to be smaller when they actually aim to make a profit. So I'm quite careful in this new age tech. I think the problem scale might not solve the problem. In fact, you might find that the companies have to shrink to improve profitability rather than scale up to improve profitability.
Okay, all right, Anish, appreciate you joining in and giving us that view. I'm not sure whether we'll talk for the remainder of this year, but all the best towards the end of the year and see you in 2026 on Personal Note.
Thanks.
Thank you. Well, let's move on to the EMS space then. Kaynes Technology, that's a stock in focus. Remember, it's down more than 40% in 2025 so far. The company, though, has signed deal strategic partnerships with Ola Electronics as well as Mitsui. Now, the deal aims to strengthen its upcoming semiconductor manufacturing operations in India. To discuss this, smart metering business as well, and what's the outlook, we're joined by Mr. Jairam Sampath, the CFO at Kaynes. Hi, Mr. Sampath. Good morning, and thanks a lot for joining in. Just a quick question. Yesterday, I read a couple of sales notes that mentioned that the two partnerships, Ola Electronics as well as Mitsui, Japan, both of them, were announced actually earlier as well, September 2024. So what's new in this announcement?
This is final conclusion of the sign-off with the partnerships. And as you know, AOI finally has deployed resources to collaborate with us in the OSAT space. So they are supposed to give us technology and also training, etc., the area of advanced packaging. This is part of our earlier foray into semiconductors, and where we had secured earlier clients in the what we call the legacy technologies, which is the wire bonding and all that. And then, of course, our main aim at the end of the project is to also have significant presence in the advanced packaging, which adds, of course, the technological leadership, plus also it adds profitability to the entire enterprise. So it's very much part of the earlier plan. AOI is one of the collaborators that we had mentioned in our DPR also to the Indian Semiconductor Mission. And this has been concluded yesterday in terms of sign-off.
Got it.
Otherwise, we've been having a lot of discussions and also a lot of exchanges, etc., in the past. As far as the Mitsui is concerned, Mitsui is one of those conglomerates which spans both. They've got two parts. One is, of course, the entire supply side. They can help us strategically in terms of chemicals and all other raw materials, which is crucial for semiconductors. Plus, they also have an arm to introduce us to other clients within Japan. And so, as a partner, Mitsui will bring in a lot of value in addition to bringing technological raw materials and all that. It'll also give us some good market access within Japan.
Okay. All right. Just to touch upon the OSAT facility, could you tell us what is the current status? Is it going according to plans? What is the capex you're lined up, as well as the revenue potential? How much of it basically is getting tied up?
Yeah. So as far as capacity tie-up is concerned, already we have 3 large clients. And if we so desire, we can probably tie up the entire capacity, because these are very large clients like Alpha Omega Semiconductor, there's Infineon, there's also the L&T, which has acquired a business of Fujitsu General. So, of course, we would like to be more cautious about our portfolio, and we are also adding some more advanced packaging. So, from the point of view of customer traction, I think this is as best as it can get at this point in time. We've completed our what is called the pilot plant, and it has shipped out the first set of semiconductor assembled in India, and it is under evaluation. We should hear from the customer anytime for approvals. And then, of course, we'll take up the other 2 customers' clients too, wherein we have got specific RFQs for different types of semiconductor assemblies. And maybe by the next fiscal, we probably would tie up at least 25-30% of the total, let's say, capacity for this in terms of revenues for the entire semiconductor project as it stands today.
Mr. Sampath, there's been just moving on to the smart metering business, because there has been a lot of scrutiny regarding the disclosure inconsistency, governance, working capital stress, etc. Now, you have guided to bring down the contribution of the smart meter business revenue. I believe it was about 30% to your overall revenues in H1.
Yeah. So we have not said we will bring down the contribution. It's just that it will be a run rate business, which will hover between 800 to 1,000 crores a year. And as the other segments grow up, the relative composition of smart metering business will come down in the overall, let's say, revenue profile. Okay. This year, about 4,000 plus crores of revenues are expected. So smart meter is going to remain sub 1,000. So it will come down to about 25% for the year. The way to look at our business is it's an order-based business. And so as we disclosed last September, we had an order book of about 8,100 crores. And a smaller portion of that is smart meters, approximately about 1,300 odd crores is smart meters. Remaining are businesses which are already there in the 6 verticals that we serve. So the reality is that in every year, a different business becomes a little larger than when we onboard the new clients, etc. It becomes a little larger than its eventual size. And then when other businesses come in, then it kind of settles into a proper composition.
Mr. Sampath, of course, you and the rest of the management team did go to great lengths in that whole episode to explain. I think detailed investor calls were also held where you clarified some of these points. My question is basically, I mean, the stock is down 50% from the peak. Right now, are you thinking of any other ways of, rewarding shareholders or maybe shoring up a little bit of confidence? I don't know, a special dividend of any sort. I'm not sure if promoters are thinking of maybe buying a bit of stake back from the market. Anything on the cards?
Yeah, of course, in the coming year, of course, I still need the board approval, recommendation, etc. But this is not outside the consideration set. Basically, maybe the next coming board meeting at the end of the year, we may recommend going down the path of starting a small amount of dividends. And I think confidence-building measure, the ultimate confidence-building measure would be to perform as per expectations and promises, which is what we are preparing to do. And we are quite clear that all the strategic initiatives and all the tactical moves that we have taken is bearing fruit, and it's pretty much on schedule. So sometimes it does happen that markets get spooked because of various reasons. The trigger is something else, and something else takes the momentum. But from our perspective, I think we are well poised to kind of deliver on the numbers that we had promised. And also the strategic actions are in place, because we're not only talking about this year, we are talking about FY28, $1 billion, and then thereafter quickly reaching to a 2 billion number.
Right.
So all of those actions are being taken now. Yes, there are some small
Mr. Sampath?
quarterly troubles that happen sometimes on working capital, sometimes on some cash flows.
Yeah, So, Mr. Sampath, on the working capital, which is where the issue was, which is where Kotak raised that issue, can you tell us, as of today, when we're speaking, what are your net working capital days looking like? What is the plan of bringing it down? Just give us a roadmap.
Sure. So the analysts actually did not talk about these things. He talked about a lot of factual, let's say, quote-unquote inconsistencies, which were later on proved that there was only one little error. Be as it may, we are looking at about 85 days and less by the end of the year in terms of net working capital. And we also are committed to show operating cash flows, significant operating cash flows, positive cash flows by the end of the year.
Okay.
And I think towards that, we are making good progress. So you will see probably when we meet again sometime during April or early May, these numbers would have been achieved.
Okay, positive cash flow by the end of the year. Just a quick word. You said FY26 revenues of 4,000 crore?
Yeah, plus.
4,000
There
crore.
are lots of moving parts here. We had earlier estimated some small revenues for semiconductor also. Now we are thinking that we'll get approvals for semiconductors so that next year's entire revenues are secured. And since our business completely depends on how well we perform, and there are no PLI and those kinds of things, except for the PC board, there is a PLI available, which we'll probably deal with it next year. Otherwise, our EMS and OSAT businesses are dependent on completely firing up the entire capacity and then let's say, delivering to all the customer requirements.
Yeah, got that. Thank you for explaining. The reason we asked is because after Q2, you said for this year, you will deliver a 60% revenue growth, which would have put your top line at 4,500 crore. And now you're saying it will be 4,000 crore plus.
4,000 is the EMS portion of the business. There are overseas subsidiaries and so on and so forth.
So 4,500 crore stays as a guidance.
Yeah. So we've been saying it will be around 4,2 kind of number. Let's see where it gets to.
Sure. All right. Thank you. Out of time. Thank you, Mr. Sampath, for joining in. Moving on now, Cyient is the next management. This is after the company's semiconductor arm bought a majority stake in Kaynes Tech for $93 million. To discuss more, we have with us Suman Narayan, CEO at Cyient Semiconductor. Thank you very much for joining in. So first, if you could tell us what is Cyient Semiconductor's current revenue base, and post this acquisition, what will the number look like in terms of a top line and the margins of the acquired company?
Yeah, so Cyient, we're a wholly owned subsidiary of Cyient Limited, and we're acquiring 65% stake in over 65% stake in Kinetic Technology. So basically, with this acquisition, we will double our revenue. Our margins will be positive, and we will be accretive in year 2 from an EPS perspective.
So you double your revenue, you mean you will hit $100 million because you had guided for $50 million by end of FY27. So by FY27 end, it will now stand at $100 million?
Yeah, today, if you look at where Kinetic is about a $40 million business today. They will end this year, at least the current FCY, they will end the year around $40 to $41 million.
Correct. And no, for Cyient Semiconductor, by the end of FY27, the revenue number will be?
We don't forecast that far in the future, but yeah, we will be moving fast and growing really fast, and by FY27 with this acquisition and our internal ASIC business as well.
Okay, so you will double the semiconductor business by the end of FY27. We can take that. On margins, you had earlier guided for EBIT neutrality by FY27. What are the margins of Kinetic Tech?
Yeah, so the margins right now are in the mid 40s right now. And as it's a product-based business, it's very different from the traditional services business. So over time, we expect the margins to continue to improve, with basically improvement on the COGS side, on the cost side of the business.
Okay, so 40% is the margins of Kinetic Tech, and that will overall
45% is what they'll end up with.
Okay. You've also said that the acquisition will be EBIT accretive from year 1 and EPS accretive from year 2.
Yeah, year 2.
What are the key operating levers other than the margin expansion, other than the fact that the acquired company has higher margins?
Well, the operating levers for us it's primarily, the growth in the business. They're going to be driving, significant growth year on year for the business. So that will definitely help us as we move into next year.
All right. Hi, Suman. Morning, and congratulations on this acquisition. Quick question. Why 65%? Is there a roadmap ahead to go ahead and acquire the remaining of this?
Well, it's greater than 65% is what we said. Yes, over time, there is definitely potential in acquiring the full business.
At what valuations? Is there a predetermined, are there some benchmarks that have laid out?
What we're looking at right now, what we paid, I think you all know, I think the industry average is 5x. We are much lower than that right now at 2.9x is what we ended up paying for the business as well. We paid $93 million, as you know, for the business.
Okay, all right. It's a little more expensive than your previous acquisitions, but you're saying in comparison to industry standards, it's a relatively cheaper compared to... So you believe you've got a good deal at around 3 times. Got that. What about funding of this, if you could split it up for us?
Yeah, I think we will have a mix of cash and debt to fund the business.
What's the
You want to break that up for us?
I think, we have an exact breakout of the cash and fund, but, we're moving in that direction for the cash and the breakout of what we're funding it.
What's the cash in the books right now?
I'm not sure what the Cyient Semiconductor cash is on the books at this point.
You said one of the big operating levers will be the growth seen in Kinetic Technology. We know this year's top line is $41 million. What is the growth rate anticipated for Kinetic Tech?
I think we will be in, 20-25% is definitely possible in this business. As these guys are really focused around edge AI solutions on power conversion. So and we see the growth significantly on the edge AI portion of the market for us.
Got that. These are helpful numbers. So Kinetic Tech is growing at 20-25% with margins of 45%, and this will double your overall semiconductor, business, and it will be funded with a mix of cash and you're, exploring other avenues. What is the key rationale for making this acquisition? Is it capability? Is it the people? Is it geographical expansion? Is it clients?
See, they're really, if you look at it, what excites me about this comes down to 4 reasons. First is the acquisition doubles our addressable market now in power. Power is a large market in semiconductors. It's like a $40 billion market. Now it gets us access to about $8.5 billion of the TAM in power, especially in power conversion. Second is Kinetic brings about 250 ASSP products and 100 plus product patents. And now we can cross leverage that across both our ASSP strategy and our traditional business on custom ASICs. So we believe that the future revenue growth will continue to be nonlinear. And third is that, Kinetic has a strong customer relationship, especially, pretty deep. Many customers have been with them 10 plus years. It's reflecting just strong product conviction, higher switching costs, and the enduring value of their IP. And fourth, I'd say, obviously it's going to be financially accretive as we talked about, and it helps us double the revenue and also the addressable market. In summary, it accelerates our power strategy by years and expands our market opportunity. It strengthens our IP moat and improves our financial profile, making it a critical step for us to build a high margin power business for India and for the world.
Okay. All right, Suman, we'll leave it on that note. Thank you very much for joining in, and good luck with that acquisition and the business for the rest of the year, and have a fantastic end to 2025 as well. Wish you season's greetings. Thanks for joining in.
Thank you for having me.
Well, we'll take a break on that note, come back on the other side. By the way, the market slipped a little more. Again, getting closer to the trading range. Now we're closer to 28,700 than where we were about less than an hour back. We'll take this up, and we will again put the spotlight on mutual funds and stockbrokers, as SEBI has overhauled the mutual fund regulations after 3 decades. Welcome back. So mutual fund stocks are up and about this morning. You'd wonder why. This is at a time when the regulator has overhauled the mutual fund regulations. It has decided to unbundle the total expense ratio. As we've been telling you right from the morning, now that total expense ratio will have a base expense ratio. It'll have the statutory fees and taxes, and then it'll have the brokerage fee. And all of this has to be transparently shared with the end investor. So what does this mean for the mutual fund industry? What does it mean for brokers? Because the brokerage cap has been lowered. It's not been lowered as much as what SEBI was proposing, but it's still come down to 6 basis points. So what does it mean for market participants and for investors? Well, to take this forward, we have with us Amisha Vora, Chairperson and Managing Director at PL Capital, and Mr. DP Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund. Thank you very much for joining in, Amisha and Mr. Singh. Let me start with you, DP sir. So all mutual fund stocks are excited Because, and I checked the fine print as well, in October, they were going to reduce this base expense ratio by as much as 15 basis points, which would have been, hurting a lot of the big funds. But finally, they've reduced it by only 10 basis points. What is your take on the regulations announced yesterday?
No, I think they have started with 15 basis point, and this after the second and third grade, they have made it 10 basis point. That is generally so when we all discussed, and when we said that the levies are not 15 basis point, but 9 to 10 basis point. And I'll give all the credit to the regulator to understand the math, and they did it the way it should have been, and that's a very good thing. We are thankful to the regulator for that.
But Mr. Singh, this 5 basis points that was being levied in lieu of exit loads, that also goes away. So won't profitability, overall mutual fund profitability, won't it be impacted?
It will be impacted, but I think the volumes will make up for this. This will be impacted. 5 basis point on 40 lakh crore market is almost 2,000 crore. I mean, it's a big amount. But thing is overall dispersed among the various fund houses. But I think the market moving up and the volumes will make up for that. That's a minor thing. But why you are saying these stocks are up? Because there was a fear that it will be much more bad. But a lot of transparency has been brought in, and I think the impact is minimal. Impact is not very high.
Okay. All right. So you don't expect too much of an impact on profitability. Saying maybe volumes will make up for the few basis points that have been shaved off. Got that point. Now let's dive into that contentious broking fee debate, right? Amisha, let me come to you. See, earlier, up until now, if Mr. Singh was, paying brokerage fee or basically fee for research, it could be excluding the statutory levies and taxes, it could have been 8.59 basis points. Now it can only be as much as 6 basis points. How big a hit is this for brokers?
See, I'm so happy that Mr. Singh is here on this dais. And I would request the largest mutual fund and then all the other mutual funds that when SEBI has approved at least 6 basis points, they should pay 6 basis points.
So what were they paying overall, Amisha? In principle, what was the brokerage fee that was being given? Earlier, the headline cap was 12 basis points, including taxes. But what was the industry practice? You tell us, the inside numbers.
So sir is also here. And some of these large mutual funds, I guess, were paying between 4 and 5 bips. But the rest of the people used to still pay 9 bips, 10 bips. So if everybody pays 6 bips, then I think the institutional broking industry will not be very badly impacted. And one of the reasons SEBI considered this, and I believe, and took it out from base expense ratio and kept brokerage, is also because they understand the need for extra coverage that the broking industry need to put up. As so many new IPOs are coming, if you see the number of not only large cap increasing, but mid and small cap increasing, and how really coverage brings volumes for these stocks, I think that there are many aspects even the mutual fund industry should consider. And we are the takers as of now in the markets. But if they stick to this 6 basis points because it is outside BER, then I think industry will not be at such a big loss.
But that's going to be a tall ask, Amisha, no? Because if the large fund houses were anyway paying 4-5 basis points, I don't see how they'll increase that to 6. And their argument, I'm sure Mr. Singh's argument is going to be on volumes. Because he's giving a lot of business to any broker. So therefore, lower fee.
No, my point is, how does it save for them? Because it is outside of BER. So even if they save on this 1 bips or 2 bips, how is it going to increase their profitability? If maybe my knowledge is not complete, but this is my question.
Mr. Singh, on to you. Let's hear from you on this whole brokerage fee issue.
No, Amisha, I appreciate your point of view, but we understand that the way our economy is going, the way our industry is going, we all are working for the unit holders. Neither for ourselves, nor for the brokers, nor for the distributors. We are here for the unit holders.
So we have to create value for unit holders, and we have to stay afloat. And we all are not charitable organizations. We have to make money also. But I think the point well taken. And I think the whole both on the mutual fund side and both on the brokerage side, the impact is there. But impact is, yes, we welcome the thought process of the regulator, and the unit holders have to actually take benefit out of it, the whole process, and they stand benefited. And I think with the more volume, the more we are at a sweet spot, more and more volumes will come, and we all will stay afloat. We are not going to down. That's my call.
Sir, DP sir, the issue here is what is the direction that the regulator is taking? Now, brokerage has been brought down from 8.5 basis points to, let's say, 6. Now, we don't know what it is going to be tomorrow. So, directionally, will the larger mutual fund houses start thinking of setting up bigger, say, in-house research teams? Is that the direction that we are going in? Because at the end of the day, I mean, good research is the lifeblood of active fund management, whether you do it in-house or whether you get it done through a broker. So which direction are we heading in?
So for me, it's very, very essential. The research team in any case is the essential part of it. It's not that we are outsourcing everything. We have a very strong research team. We'll further strengthen it. But talking about the regulator, the thought process is very clear. They wanted to bring in more transparency. They wanted to bring in that everybody should know levies are not static, whereas the expense ratios are static. So today the GST is one percentage, tomorrow it could be different. So it has to remain outside, both on the brokerage side as well as on this side. It's a very right thought process. So we know what we are charging base rate and what are the brokerage rates. I think that this will make up over the period of time. And as I said, I'm repeating, the way markets are, the way our economy is, the way capital markets are growing, I think we'll always stay afloat and with the profitable numbers.
Wonderful to have that optimism. Amisha, let me get the last word in from you. For the broking industry, this has been a year filled with twists and turns, right? And we still haven't heard the last on the whole options and what is happening, one product per week or two or one per fortnight. So on the F&O side, I think we're still all holding our breath in terms of what is the finality. And then obviously you have this lower brokerage fee from mutual funds. Now it's a reality. So for the broking business, what will 2026 bring in store? And I mean, as someone running the business, what will you have to do to ensure that profitability remains on track?
So, of course, each individual broking house will make their own strategies to gain market share, because when the yields come down, market share gain is one strategy which everybody will try to work on. But I feel that the need to cover more stocks, the need to cover more IPOs is not going to reduce. And it will take about a year or two for the broking industry to, particularly if I say institutional broking industry, to adjust to this brokerage rates and still continue to invest in the business, because the investments in terms of compliance, technology, and more coverage is increasing by the day. So definitely it will have some impact, and it will take little time before we really neutralize this impact.
Okay, all right. Thank you very much for sharing those candid views. Both Mr. Singh and Amisha, thank you for joining in. And in case we don't speak till the end of the year, wish both of you a very, very happy 2026. Thank you for being with us this morning.
Thank you so much.
Thanks a lot.
Okay, all right. We'll take a break on that note. Come back on the other side. We'll have Manisha Gupta join in with the latest from the commodity markets.
Fly Emirates, fly better.
All right, shifting focus now to the commodity markets. Manisha is now joining in and putting the spotlight on the precious metals.
Well, I am, because I can't get enough of that. The kind of run-up that we've seen in all of these precious metals in 2025, it clearly can be called the year of precious metals. Not only have they outperformed various other asset classes, including equities and bonds and real estate in some matter as well, but it also has been the best year in many, many years for many of these. So take a look at the gold prices. We're up by 65% in this year. Outperformance coming in from silver at 130%. So that clearly has outperformed not just the precious metals, but overall all commodities as well. Take a look at platinum, 120% of gains onto that one as well. It's a pity that you can't really invest in platinum as an underlying commodity in the Indian markets there. Same goes for palladium, 93% of gains coming in for this one. So this is where the sparkle clearly is. So when you look at this year, you have record highs coming in from gold and silver. It's an 18-year highs in where we are trading when it comes to platinum, and it's a 34-month highs for palladium as well. So we seem to be making record of sorts when it comes to all of these precious metals there. And I want to break it down for each one of them now. So when you look at the gold prices, well, it is headed for the best annual gain since 1979. But this year is different because there's just so much that has been happening in 2025 that from the starting or the beginning of this year, you saw a lot of interest coming in. The central banks have been buyers for last 3 years, and 2025 continues to be a fourth year where you could be looking at 800 to 1,000 tons of buying coming in from central banks. And then there has been support from geopolitics, tariffs, growing global debt. All of that has led to safe haven buying come in for gold, including the US rate cuts as well, with an expectation that that cycle perhaps would continue in the next year. Currency debasement has been yet another factor. The markets are talking about QE yet again. So the gold support perhaps would just continue to be. The markets also have seen silver headed for a best annual gain since 1979. So everything that gold has had, silver also has had in sense of supportive fundamentals. In addition to that, you have supply deficit to continue in the sixth year in 2026. It also is about very strong industrial demand and a record investment demand that we saw in this year for silver. India perhaps could end up importing 7,000 tons of silver this year, majorly purely on back of strong investment demand there. Take a look at platinum and this is where investors move to as in sense of alternate assets. In the international markets, platinum buying has been very, very on the stronger side. There also have been supply concerns that we have seen come in from South Africa, and 2025, by the way, is a third year of deficit when it comes to platinum. There also is a report from World Platinum Investment Council which says that for the year 2025, we are looking at a supply deficit of 69,000 ounces. They do believe that you could be looking at a marginal surplus in the next year, but with the way the geopolitics, etc. are, you could be looking at further support for this too. Palladium is the last on my list, and we've seen stronger gains onto that one too. There is potential disruptions that we've seen from Russia and South Africa absolutely supporting markets there. So apart from investment demand, it also is about automotive industry demand that has supported palladium, industrial applications, global economic conditions, all of that has been quite supportive. And before we call curtains for 2025, it still is about Bank of Japan, Bank of England and ECB monetary policy meetings. All of that in this week, that would tell you on where we actually end this year for all of these precious metals.
Thank you very much for that. Get into a break. On the other side, it's our special segment. It's the economy. Lata speaks to Siva Ramakrishnan of Gokuldas Exports and the FIO Director General Ajay Sahai on the weaker rupee, tariffs and India's exports.
You want to talk business? Meet me in the On-Board Lounge.
Welcome to It's the Economy. The November trade data showed a 19% jump in exports year on year and a near 11% jump even month on month, that is November over October. Separately, the rupee has depreciated 2.5% in the past month and 6% this year. Has this made life easier for exporters? Can our exporters manage to grow despite high US tariffs, because exports to the US have also risen very sharply? To discuss these issues, I have with me Mr. Sivaramakrishnan Ganapathy, the Vice Chairman and Managing Director of Gokaldas Exports, and Dr. Ajay Sahai, Director General of the FIO, that is the Federation of Indian Exporters Organizations. Gentlemen, thank you very much for your time. Mr. Sivaramakrishnan, to start with you, specifically textile exports were up 8% year on year in the month of November and 8% up month on month as well, November over October. Is generally, not just US, but textile demand reasonable at this time?
Well, textile demand is reasonable, but the fear is not near term, but fear is 2026. The tariff has remained high at 50% from United States, and that's a very large market. If you look at apparel, about 5.3 billion goes into United States out of our 16 billion of exports. So more than a third goes into that particular market. And US continues to remain a single large country which buys. China is another large market, but China makes for China, so it's not really a market for us. And Europe is fragmented; it's growing and a large market, but it's well served from India for now, and it's better served from some of our competing countries which have duty-free access to Europe. So a loss of US market has not really hit the export numbers for now, and one of the reasons is because of the momentum. Because of the fact that Indian exporters, particularly in sectors which are hit by the tariff, like apparels, textiles, etc., where we have also shared the tariff burden with our customers. So for now, it's in a holding pattern, but I worry for 2026. And unless the tariff goes away or some resolution is found to the penal tariff of 25%, we may find that the demand going forward may slow down, as today both the brands and the suppliers are bearing the extra cost. And in some ways, you could call it a lose-lose deal. So it should really, it's waiting for a turnaround from that perspective.
Okay, you mean that your principals or your counterparties are ready to share up to a point, but what did you say, mid of next year, they may want to change their mind and look for other suppliers, you say, if the burden of 30% penal tariffs don't go away?
That is correct. So ours is 50%, whereas rest of Asia, which is all our neighboring competing countries, are at 20%. So we have a 30% delta vis-a-vis other competing countries. Remember that electronics manufacturing and some other sectors don't seem to have this issue because they have a tariff exemption. But the sectors which have been impacted with the penal tariff would see some atrophying of business, particularly from United States, as there are other neighboring countries which could be far more competitive.
Okay. Well, that's true, because at the moment, textile itself is doing well year on year and month on month. Dr. Sahai, let me quote the US numbers again to you. India's exports to the US are up 22.6% for November. They are up 10% month on month, November over October. And they are up 11% if you take the full 8 months, April to November, 25 over 24. Textiles we have got a view, but more widespread, other exporters, what are they telling you? Are they able to find rival destinations? How come the exports to the US are so good?
In fact, if you look into the US, roughly 55% of India's exports is impacted by tariff, 45% is either in the exempt category or under Section 230, where we are having a level playing field. In 55% of the exports, as told by the previous speaker, most of the exporters are taking the heavy hit, and they're continuing with the buyers because they feel that if buyer moves to some other geography, even when we have the BTA, probably it may not be possible us to bring back the buyers. Though the disaggregated number for US is not available, we feel that it is largely because of the export of the smartphone, probably which is growing very rapidly. We have to see the other components also. I'm not sure whether in apparel and textile, now we are growing or not growing, because it's not that all exporters are taking the hit and continuing with the business. Those who are supplying to the brands, and probably brands have deep pocket, they have large margins also, and they are managing it. So it will be a mixed picture in the US. Of course, 22% growth is very, very encouraging, but once the disaggregated numbers are available, we will be able to respond it better on that.
Okay, we've got some disaggregated numbers. Electronic goods, not to the US, but generally, overall, electronic goods have grown 39% year on year and 14% month on month for November. So you're right that electronics has perhaps made up for negatives in other areas. But, Dr. Sahai, the overall picture, November exports are up 19% as a whole compared to November of 24, and they are up 11% over October. Even if you took October to November, April to November, those 8 months, the growth year on year is fairly decent, like some 6% in total exports. So is it that generally the other areas are demanding well, or Indian exporters to the US have been able to find rival destinations, like we hear about marine, the shrimp farms apparently are being bought by China and Japan?
In fact, I will say that at this point of time, I personally feel that this is not an aberration. Probably this is depicting a trend which will continue to show the resilience of the industry. They have diversified into, we have moved into the value-added segment also. In some of the geographies, we are doing it very well. When you are looking into the region, probably in West Asia, Africa, Latin America, and even in ASEAN, we are doing very well. In some of the sectors, we are doing exceptionally well. For example, if you are looking into the engineering sector, it is showing growth because many of the emerging economies are investing in infrastructure, leading to the demand for engineering goods. In some of the engineering sector, particularly in electrical machinery and capital goods, we have become very competitive. If you're looking into the pharma and all, probably global companies are looking for an alternative supply chain where India is emerging. In petroleum sector, the refining margins have improved, and that is showing good result in petroleum exports also. In agri and food sector, Rupee has definitely provided some competitiveness, and since the logistics costs have also been softened, this is helping us. Okay. So both in the geographies and in the product, we are doing very well, and that's why we are now firmly assured that probably the US tariff is not going to hit India. We will be able to recover those losses in the rest of the geographies, though of course this will be a medium to long-term strategy, which will help us to move into that direction.
What's your sense, Mr. Sivaramakrishnan? To what extent can you diversify? Can apparels generally diversify away like the shrimp guys have done?
So diversification is the mantra because, we are living in a super volatile world. So we don't know, even if, let's say, the penal tariff goes away, what stops it from coming back? So it's always good to diversify, and all the companies, should take the diversification strategy, and we are doing too. The only problem is that there are no very large markets like United States and large retailers or large concentration of buyers, which US has. So the diversification itself takes time. And unlike shrimp, etc., where, they could find a China market, for manufactured goods, China is not the destination because China is very good at it. So we will have to find other markets. And, there are not many other large markets like US. So it's not easily replaceable. It takes 2 to 3 years.
Okay. At time permitting, I'll come back to this. But first, I wanted to ask about rupee depreciation, Mr. Sivaramakrishnan. Did that make life easy for you? About 6% this year and 2.5–3% just in a month.
So it's a salve. It's a balm on a deep wound. So it has not cured the wound, but it's soothing a bit.
Okay. Yeah, I know 6% for a 50% tariff and 30% penal. 6 will be only a salve, as you say. What about your thoughts, Dr. Sahai? Do you think this rupee depreciation is a bit of a help for your committee of organizations?
In fact, rupee deflation is definitely supporting export, but on a selective basis. In the labor-intensive sectors, where we have very less import intensity, like apparel, textiles, footwear, carpet, toys, gems, toys, and sports goods, agriculture products, it is helping us a lot because not only the Indian rupee has depreciated, probably we have depreciated significantly, and some of our competitors' currency has appreciated also. So that margins have definitely come to us. But it is more on margin stabilization rather than triggering volume. So it is not that it is giving us additional business, but we have become competitive. And it is related to the sector. Probably if you are looking into petroleum, gems and jewelry and electronic sector, we may not be that much advantageous position, but of course in the labor intensive sector, it is providing some relief to the industry.
Yeah, I take your point. Electronics, gems and jewelry are hugely dependent on imports, which they value add and export. But incidentally, gems and jewelry, it's a 28% jump year on year and 27% jump month on month as well. So something's going right, at least in November, for gems and jewelry. But Mr. Sivaramakrishnan, just a final question. What about domestic demand? I mean, we've seen this K-shaped recovery. We've seen an 8% growth in the first half. Will you be able to, diversify to India itself, to some extent at least?
That's clearly a possibility, right? But at the moment, people who are exporting find export markets more lucrative or more meaningful for them because their manufacturing is oriented to a certain quality standards, etc., for exports. So then when we start catering to Indian markets, our realizations drop. And, that's really a second best option from our standpoint. So our hope and aim is that we retain the US and, the rest of the world market. And Indian market then becomes a secondary option as a plan B or plan C, perhaps.
Okay. Last word from you, Mr. Sahai. What is your sense about the overall export scene? If the trade deal is delayed, are we going to see unemployment? Are any of your organizations telling you that they may have to close down or at least become smaller?
In fact, some of the industries will definitely be impacted because it is not possible in every sector you diversify into the domestic market. For example, if you are looking into carpet sector, over 60% of India's carpet export is to the US, and probably that segment may not be able to sell in the domestic market in that large volumes also. So for some industry, definitely it will be very challenging time. But the way India is diversifying, I'm pretty sure that it will not hit the export number. Okay. But at the same time, they're also hopeful that maybe by March or before that, we will have US BTA in place. The rest of the things have been taken care, probably a political...
Out of time, sir. Out of time, Dr. Sahai. One sentence from you, Mr. Sivaramakrishnan. When before we see job cuts in textiles, you think? How long can you all hold on?
I think another 3 to 6 months would be the outer limit. And after that, I think it would start seriously impacting the business. I'm hoping that by then some solution, either we diversify or some relief comes in terms of tariff.
Okay, that really is the big takeaway, that by 3 to 6 months, we should get something done. Else, there are job losses possibility. That's a big social cost to pay. Thank you very much, Dr. Sahai and Mr. Sivaramakrishnan, for filling us in on what's going right and what yet needs to go right in the exports, especially on the tariff issue. That's it on this edition of It's the Economy. Thanks for watching. After a break, Chartbusters.
Sun Pharma, that's the top loser on the Nifty, down 2% after the company's Basca facility receives an OAI from the US FDA.
Stocks of capital market players rally as SEBI revises the expense ratio for mutual funds. All statutory levies are excluded from the base expense ratio, which has been cut across schemes. Limits on brokerage for derivative and cash trades by EMCs also capped at 2 basis points and 6 basis points respectively.
Shares of Anthony Waste Management rally over 18% as the company's joint venture wins a 7-year order worth about 1,300 crore rupees.
Ola Electric slumps close to 4% as the promoter, Bhavish Agarwal, sells stake for a second straight day. 4.2 crore shares sold today after a sale of around 2.6 crore shares yesterday.
Shares of Crompton, they rally as Motilal Oswal initiates buy rating on the stock with a target of 350 rupees, expecting compounded profit growth of 21% till FY28.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets have recovered from the lows of the day. Earlier today, we were pointing out that the FI net short positioning had moved to around 92%, which normally is getting a little bit excessive, and the PCR as well was coming to the lower end of the range. And after starting off in the red, from the lows, we've seen a bit of a bounce. Let's see whether or not it's sustainable, Mangalam, but we're counting down to the end of the year.
Counting down to the end of the year, let's see whether Santa visits the Bulls this year or visits the Bears this year. But importantly, even as the market has recovered from the lows, the broader markets, they continue to be in a bit of a tizzy right now. The mid-cap index, while off lows at an index level, if you look at the broader, the crisscross lines, they've neither crissed nor crossed. Over the last 2 trading sessions, we saw nearly 2,000 stocks declining for about 700-800 which are advancing. Right now as well as we speak, about 1,800 stocks which are in the red, for 900 which are in the green. So let's see how that turns and whether that turns to in the favor of bulls at some point or not. Bunch of stocks doing well. We did speak about the kinds that were moving on the back of news, but we have a few of these pharmaceutical stocks as well which are buzzing around. Biocon, Divis Labs. There is some traction on a lot of these mid-cap IT names as well. Good time to welcome Sachidanand Uttekar of Trade Bulls for a quick technical check on the market. Sachi, we've recovered from the lows today, managing above the 50-day moving average of the Nifty for the last few trading sessions as well. Do you think this is an important base formation and we move higher from here, or this is just a flash in the pan?
Good morning, Mangalam. I think it's a very significant level. The 50-day exponential moving average, which is placed at 25,740, has again acted as a very good support zone. Now, we've already seen a strong rebound, which may get carried forward throughout the day. But it is very important for the Nifty to decisively give a closing above that 25,880 mark. On the higher side, still, I think there are multiple hurdles, still 25,930. So these are the key resistance levels that we are watching out for. But on the lower side, I think the decline has been very gradual for the last 4 trading sessions, though there is a low top, low bottom sequence on the 60-minute scale. But if things have to change, I think this particular support should be maintained on closing basis. So I think it's a very significant level, 25,740 on the lower side. And on the higher side, we need a decisive closing above that 25,880, 930 kind of a cluster. And once that particular level is crossed, then we may see a good, strong revival in trend. As of now, I think the data is suggesting a range-bound movement. So we may see oscillation within this particular band itself throughout the day, 25,740 on the lower side and 25,880 on the higher side.
Got it. Okay. All right, Sachi. So you're saying a bit of a range in the near term. But individual stocks are providing opportunities, right? What's your view?
Good morning, Nigel. Absolutely. I think there are relative outperformers which are still doing well, pretty well. In fact, if you look at stocks like SRF, something that we have also recommended to our clients. Now, this particular stock is still continuing its higher top, higher bottom sequence. On the 60-minute scale, we have seen a fresh breakout from a bullish pennant formation. The pattern itself is indicating a target somewhere close to around 3130. So even here right now, in case if we see any dips, the ideal level to accumulate would be somewhere close to around 3020, 3030 band. The stop loss for the trade should be placed at 3,005 on closing basis, and positions can be reviewed at around 3130. The other stock which has seen a significant short covering is Divi's Lab. Now, if you look at the overall structure, the stock was struggling to maintain its bullish stance. But if you look at the past 15 trading sessions, it was seeing meaningful support base at around 6,300. If we wanted to see a closing about that 6,400 mark, but if you look at yesterday's price action, we saw a inverse hammer formation, again reconfirming the support at 6,300, and the high of that particular pattern has been breached right now. So we are expecting that there could be a significant short covering move unfolding in this particular counter, and hence we are recommending building fresh long positions in Divi's. The stop loss for the trade can be placed at around 63.80 on closing basis. First target would be around 6,500, but initially, I think we may see this particular rally getting extended towards 66.30 as well. So buy call on Divi's Lab and a buy call on SRF. All right,
Buy call on Divi's and buy on SRF. Wonder if you've looked at a couple of these, pharma names as well. Midcap pharma doing extremely well. We have Biocon, which has seen a bit of a spike. This, was consolidating for a bit. Now it's up around 2%. From the front line, we have Divi's, which too is fairly high right now, at the high point. Is there any pick from this segment?
Mangalam, Divi's Lab is something that I've recommended right now. And I think you mentioned Biocon. Even here, the data is very important. Now, we have seen a kind of consolidation near its 50-day exponential moving average support at around 385. And the significant part is that there has been a positive crossover on its daily RSI, which is a good sign of improving strength. So I think one can also consider Biocon on the long side, but the stop loss should be kept at around 388 itself on closing basis. On the higher side, in case if the stock sustains above that 400 mark, then there could be a significant rally towards 415, 420 zone. So for the day, at least 400 can be a decisive target, but on the lower side, 388 should be your stop loss.
All right, take that point. Thank you so much for joining in, Sachi. With that, let's get you some more ideas for profit. In fact, our colleagues from Money Control Pro are standing by. Sachin Pal joins in with the stock. Sachin.
Yeah, thanks. The stock that we have chosen today in our ideas for profit is Dixon Technologies, which is a contract manufacturer operating primarily in the consumer space. The stock has been under pressure in recent months, primarily due to multiple concerns surrounding the business as well as the industry. Firstly, the stock in Q2 had revenues of almost 28% year-on-year, which was a moderation from the earlier levels of almost 80 to 100% the company has been witnessing for the past several quarters. Secondly, concerns around the expiry of the PLI scheme is likely to have a substantial impact on the overall business profitability, and that should have some bearing in terms of the near-term performance of the company going into FY27. Thirdly, the stock EMS business space has also been under pressure, and also there have been news flow around the delays in approval with the Vivo JV with the company has been pursuing for the last 12 months. Nonetheless, the business is backward integrating into many modules on the mobile space. The display modules as well as the camera modules and the battery manufacturer. Battery modules should have give a lot of fill up in terms of the overall wallet share from 15% in the mobile to almost 40% in the next 2 to 3 fiscal years. Overall, earnings remain on a very strong footing, and the EBITDA of the company is likely to double from current levels in the next 3 to 4 years. The stock has also seen a correction of almost 25% from its all-time highs that currently trades around 20 times FY28 estimated EV by EBITDA, which we believe is very reasonable for accumulation from a long-term standpoint.
Okay, all right. Thanks a lot for that. Well, time to slip into a short break. You come back. We'll continue to focus on markets, and we'll focus on the stocks that are moving around. Don't go anywhere.
There is need for growing protection through insurance in this country. We need to have insurance more accessible.
A long wait of 4 years for the Indian insurance sector comes to an end with the Insurance Amendment Bill finally being tabled in Parliament.
When it comes to inviting 100% of the capital for the insurance sector, this will go a long way.
The investment guidelines have been
made a lot easier is very good. I'm particularly excited about the fact that we can now invest in private limited companies.
Always expected that an agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The mid-cap index has turned. It's now moved into the green from just mild red when we started the show, and a couple of these real estate stocks doing well. Oberoi Realty, for one, comes up for you, currently at the high point of trade. We're also seeing some traction build in Vodafone Idea. Now, the stock has recovered about 5% from the lows. Obviously, it's a smaller denomination stock, so 5% of lows would just mean a few paise, but there has been a recovery nevertheless, and even the number of stocks that were advancing have moved from 880 to over 1,000 in just the last 10 odd minutes or so. But amidst all of this, one stock is under pressure. The top loser on the Nifty is Sun Pharma, following some regulatory action coming in from the US FDA for their Bazaar facility. Ekta joins in.
Well, yes, Sun Pharma is in focus in today's trading session on the back of negative news with regards to their Bazaar facility, which has been classified by the US FDA as an official action indicated status, which basically means that there are compliance issues in that particular facility. Now, the plant was inspected from the 8th to the 19th of September 2025. The company has said that they continue to manufacture and supply approved products from this facility to the US as of now. Now, analysts say that Bazaar facility is probably one of the most important facilities for Sun when it comes to their new complex generics, and hence the probability to deliver a potential positive surprise in the generic business might be lower for Sun Pharma as of now, but the official action indicated status as of now does not change the forecast, because analysts are not really pegging in a lot of complex generics in their forecast when it comes to approvals and sales from that particular segment. And hence, however, going forward, the approval timelines could change because of the compliance issues at the Pasca facility. Now, remember that there are other facilities which are under the US FDA scanner, which Sun has. For example, the Halol facility, which has had an import alert since June 2022 and was classified as an official action indicated status post a June 2025 inspection. And they have the Mohali plant, which also has a consent decree or was sent a non-compliance letter in 2023. So yes, negative news for Sun Pharma, but how they basically respond to any kind of compliance issues will be critical to see in terms of what the complex generic pipeline could look like for the company going forward.
Well, thanks, Ekta, for that. Appreciate you joining and giving us an update on Sun Pharma. But the big sector that's moving today is some of those capital market plays. You have Surbhi, who's joining in to tell us about SEBI overhauling some of the MF regulations. Surbhi, over to you.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduced the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or their cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
Take that point, Surbhi. Thanks a lot for that. So all the fact that, there has been considerable middle ground which has been achieved by the SEBI has the street relieved, and we've seen a big spike in a lot of these capital market plays as well. Take a short break, come back, get you more of the markets, and a lot of buzzing stocks on the other side.
Fly Emirates, fly better.
Welcome back. Well, just keep an eye out on a few stocks that are moving around. Walchand Nagar is one stock that spiked up in the last minute, so I think we should get that one up for you on the screen. Remember, these are stocks that have seen a sharp pullback. You pull up Genesis as well. That one is up close to 10% the last time I checked. So big up move is what you're seeing. And some of these metal-related names, whether you're looking at Hindustan Copper, Vedanta, Nalco as well, they've recovered from the low point of the day. But another one is Hero MotoCorp. That's under pressure following a bearish note coming from Jefferies. Hormuz joins us to tell us more about that. Hormuz?
Yes, Nigel. It's a downgrade that has come in from Jefferies on Hero MotoCorp. They have downgraded their rating to underperform from their earlier rating of neutral from hold, and their price target has also been slashed to 49.50 from 55.50 earlier, which now implies around a 15% downside from current levels. Now they say that although they remain positive on the two-wheeler demand outlook, but they go on to add that the GST reform-led demand boost that Hero MotoCorp had received has waned out in the month of November and December, and the registration market share has also dropped in the month of December after that seasonality-led improvement in the month of November for Hero MotoCorp. The stock has done well this year. It's up around 40%, and that is also due to as a result of which the valuations have expanded as well. And at 20 times FY27 price to earnings, the brokerage finds the valuations to be expensive, and therefore the downgrade, the stock down in today's session.
All right, the stock down in today's trading session. Hormaz, just before we come to you for Voltas, keep an eye out on Meesho. Now the stock is corrected about 11% from highs. The market cap this morning crossed that 1 lakh crore mark. And remember, the first few days post-listing, there are exaggerated moves on either side, and that's largely because of a limited float which is available. And in Meesho's case, there are a lot of the anchor investors decided not to partake in the anchor book and perhaps would have bought post the listing as well. That would have caused a bigger spike in demand. Then there was a brokerage note that came by yesterday as well. But today, from the highs, the stock's seen a bit of a knock. Currently at the low point of trade, down about 4%, has corrected about 11% from the highs. But Voltas holds up in green, Hormaz.
Indeed, and that's of course a double upgrade that has come in from BofA, and they've double upgraded it to a buy. Their earlier rating was an underperform rating, and they've raised their target to 1555 from around 1250 rupees earlier. And they believe that Voltas is going to be the biggest beneficiary of potentially normal summer in calendar year 2026. And pent-up demand, low base, and cost tailwinds are some additional reasons why they have upgraded the stock. They expect the third quarter to remain subdued because of the seasonality factor, but then they go on to add that all of that is already priced in for the stock, and as it is, they expect a very sharp earnings rebound of a 44% CAGR over FY26 to 28. That is of course on a low base, but an upgrade coming in for Voltas. The stock gave up some of the early gains, but still holding on to some green.
Thanks a lot for that, Hormuz. Well, on that note though, we'll have to wrap up on this edition of Chartbusters. You stay tuned. The team of Trading Hour is waiting by.
morning. You're watching us here on Trading Hour on CNBC-TV18. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, as always, Hormas Patakia and Ritu Singh. The market's looking relatively better today than what it was yesterday. But then again, it's just the first couple of hours of trade. Let's see where we go from here. From the lows, we've seen a recovery on the Nifty bank maintaining its crucial levels. And the mid-cap index too has just about moved into the green. Hi, Hormas. Hi, Ritu.
Hi, Mangalam, and yeah, you mentioned, you're right, the fact that it's a very almost 100+ point recovery, right, from the lows of the day. The broader market's doing well for themselves as well, and also the rupee continues to remain in the spotlight as well. So we'll get talking about all of this. You see that recovery that you've seen in the broader markets, but Ritu, there are a lot of other movers in the broader markets as well.
Well, yes, there are, a lot of individual stock-specific action. Mangalam was talking about Meesho earlier, Ola on the back of that promoter selling. I mean, there's a lot of companies, SEBI's total expense ratio and, the AMC's on the back of that. So there'll be a lot of action to cover. But overall, despite that 3-day losing streak and a bit of a recovery that we're now seeing in the broader markets today, Bank, Nifty, mid-cap, all in the green, the market breadth still, a tad negative, 1:1.6. That's where the advanced decline ratio currently is at. But, Hormas, take it away in terms of the top movers in trade today.
Oh yes, a very interesting list of names that you are spotting today on the broader market list. Antony Waste Handling, it's not often that we talk about this name. It's a listing around 3-4 years ago. Today is up 16%. Of course, one of its subsidiaries announced some order wins yesterday. It's the biggest single-day gain that the stock has had since May of 2022. The stock has gained in 6 out of the last 8 trading sessions, and volumes in the first couple of hours of trade are already at the highest since September of 2021. Now, we've had over 80 lakh shares that have been traded on the stock. The 20-day average here is only 18,000 shares. Now, the kind of volumes which the stock has moved. The stock has also moved above its 50-day moving average for the first time in 5 months. But the underperformance that the stock has had is very evident from the fact that from its peak of 900 rupees in July of last year, the stock has almost halved from those levels. Bliss GVS Pharma is the other one. Third straight day of gains for the stock. The biggest single-day gain in 5 months. Another 15% up move in today's session. More than 65 lakh shares have been traded on the stock. The 20-day average of just around 5 lakh shares. The stock has moved above its 50 and its 100-day moving average of 156 and 158. And the stock is still down on a year-to-date basis, and that comes on the back of 2 positive years. And Roto Pumps, we've been speaking about this in closing, and we spoke on Bazaar as well. Another 8% in today's session. Is gained in 5 out of the last 6 days, up 30% during this 6-day stretch, and today's volumes are already higher than what they were in yesterday's trade. We've had more than 90 lakh shares that have been traded on Roto Pumps today. 20-day average, only 9,000 shares. The stock still down 20% on a year-to-date basis. Might just well be the first negative year in the last 5 years.
Take that point, the first negative here in the last 5 years. But let's get in some market view coming in from Anish Tawakle, who's the co-CIO equity at ICICI Prudential AMC. He says that he will remain cautious of the mid and small caps, at least in this environment. Listen in to his views.
In general, in the markets, I would say, when you're seeing a lot of promoter selling, a lot of private equity selling, you have to be careful. And that is what has been happening in the small and mid cap space, right? And if you look at that overall space, it's kind of weakening. Because, I distinguish, I say there are 3 types of companies. There are hardware companies, there are software companies, and vaporware companies. Vaporware companies being ones where the narrative is way in excess of the reality. And I think those narratives are being exposed. And I expect that to continue. So small and mid caps, I would still be careful. Large caps, I think, are offering a reasonable risk-return trade-off over a 3-year view. We are positive on the economic outlook. And as a consequence, we like basically sectors that do well when the domestic economy does well. So that's stuff like financials, it's stuff like industrial and capital goods, automobiles, and also cement. I have avoided EMS companies. I'm not sure of the competitive advantage these guys have built. I think the market is making a mistake by giving a multiple to PLI earnings.
Okay, interesting comments coming in there, but we have to take a short break. Don't go anywhere. We're back in just a moment, and we'll focus on the bond market with Manisha Gupta when we return.
You want to talk business? Meet me in the On-Board Lounge.
And India Bonds presents Bond Street.
Well, when it comes to bonds, it really is about the kind of quantum that the RBI really seems to be buying into the Indian markets right now to stabilize the space. Well, RBI really has a difficult task in front of it. On one side, trying to stabilize the rupee, and on the other side, trying to look at the bond markets as well. So we all do understand, as has been announced, that central bank will buy bonds to the tune of 5.5 billion in this week itself. Well, it has been interesting because India has been buying a record highs in sense of bonds there. So 3.16 trillion in sense of bond buying is what government has done in FY26, and this is only until 11th of December. What we are looking at in sense of 18th December, as I said, 5.5 billion is slated for this week, and out of that 0.5 trillion perhaps is slated for today, that is December 18th as well. Moving forward, the expectation is that this perhaps is not going to end in this calendar year. FY26 is looking at further bond purchases as well. Market participants and various reports anticipate that further OMOs up to the tune of 1 to 2 trillion could be bought in the months of Jan to Feb as well. Now, why is RBI on a buying spree onto this one? On one side, you have the surging yields, which the RBI perhaps is trying to calm down. The second most important is to infuse liquidity into the banking system. It also is going to help ensure that there is transmission of the recent rate cuts to the borrowers passed on as well. But there are various challenges that we've seen into the market, and the reason that RBI has to keep intervening into this market. One clearly is about high yields. Let me tell you that India is not an isolated market, and various moves that we see in the international markets seem to be impacting India as well. The other is the forex intervention, and the kind of liquidity infusion that the RBI has been doing also has been bothering. And there is strained systemic liquidity as well, which country is looking at. Apart from that, the ongoing foreign outflows that the street has seen. You also have high Brent crude prices trading at around 62 or 63 right now. The last couple of sessions have been on a firmer note. And then the higher US yields is yet another factor that seems to be challenging the overall exercise. Well, that's about Bond Street. But with that, let's go for a short break. We'll come back with more markets and stock specifics for you.
CNBC-TV18 and India Bonds presents Bond Street.
There is need for growing protection through insurance in this country. We need to have insurance more accessible.
A long wait of 4 years for the Indian insurance sector comes to an end with the Insurance Amendment Bill finally being tabled in Parliament.
When it comes to inviting 100% of the capital for the insurance sector, this will go a long way.
The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies.
Always expected that an agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're watching Trading Hour. You know, in the last few minutes, the markets have given up some of the gains. The Nifty is now trading with gains of just about 10 or 11 points, whereas the Sensex has slipped into red, down about 20 points as we speak. Bank Nifty still holding up about 170 points. You have, the likes of auto, energy, pharma, all, dragging down the markets, whereas Bank Nifty, metal, IT lending some support. But let's go across to Mangalam, who brings us the latest trends from the F&O space to take cues from. Mangalam?
Well, even as the Nifty has given up some of the gains right now, it's still off lows for the market right now. We have the Nifty Bank, the mid-cap index, all of them fairly off lows, even as the Sensex is marginally in the red. And the reason why we've moved off lows is the street believes that maybe a lot of the volatility is behind us. The markets put markers on both the levels, the upper level and the lower level, which is why the India VIX is fairly contained as well, sub 10, closer to 9.81 right now. The Nifty has been holding on. The Nifty Bank actually is facing some resistance at the 20-day moving average. So crossing past that would be an important marker for the bulls to track, even as it's recovered from the lows of today's trading session. So 59,285 or a closure above 59,300 is something that would give some hope to the bulls that maybe the rally is going to be on the way up in a breakout. But today's low on the Nifty, 25,726. And the recovery past this 50-day moving average of 25,804 tells you that over the last few trading sessions, the market's been fairly resilient at lower levels and the purchase to close above that 50-day moving average. So that's a positive. If the market sustains at higher levels, which isn't right now, there could be a case of severe short covering because the FII longs in index futures have been coming down drastically over the last three trading sessions, come down from 11% to 9%. And yesterday it was as low as 8%, telling you 92% of the FII positions are on the short side. The 25,800 put and 25,750 put, both of them have seen writing. So the bulls believe that maybe there is support at lows of today, where the 25,800 put has a premium of 76 rupees. Minus that from the 25,800 mark, you get today's low of 25,725 thereabouts. 25,750 put as well, a 50 rupee premium out there. So between 25,700 and 25,725, there is support. But on the way up, the bears haven't given up, their belief that the market is not running away despite the recovery. The 25,900 call, despite the market having recovered over 120 points from the lows, the premium on that is down, telling you that there is selling out there. So 26,000 thereabouts is still a level that bears believe they can defend, and there is a technical reason for that as well. The 20-day moving average on the Nifty is at 26,018, and the Nifty Bank itself has not crossed that. So obviously the Nifty itself will perhaps not cross it without the Nifty Bank crossing it. A lot of stocks, however, on our radar. HDFC AMC is seeing a lot of long positions being added. All the other capital market plays are seeing short covering. And the other one is Hitachi Energy, which is seeing a lot of shorting activity, unusual for this stock usually, down about 4% right now, with a lot of open interest backing it on the short side.
Hitachi Energy continues to see short positions. Mangalam, thank you for that update. And speaking of HDFC AMC, the other one that was initially outperforming at the first few minutes of trade was Nippon India. And that stock was up around 5.5%. It's still up 4%. So marginally off the highs of the day is Nippon India AMC. And there, as you can see, 900 rupees on the stock right now. And the other one, Motilal Oswal, started off on a flat note, but then has continued to build on to those gains now, 3% higher on the stock for Motilal Oswal as well at the highest point of the day. On the flip side, things not looking very good for the defense space. The defense stocks have continued to underperform, and over the last 1 month, the defense index itself is down 10%. MTR Tech is the top underperformer on the defense index today, down 3.5%, and this is after the company had disclosed an order win of over 300 crores just a few minutes ago. So at the lowest point of the day is MTR Tech. Garden Reach is down 3%. Zentech is down another 2%. BEL, BEML, all of them, and out of the 18 constituents of the defense index, 17 of them are currently trading with losses. Take a short break here on Trading Hour. Get talking technicals with Jay Thakkar on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Currently yo-yoing in a 50-point range is the index between 25,800 to 25,850. So some choppy moves seen currently on the Sensex weekly expiry. But the big talking point this morning has been the capital market regulator SEBI having revised expense ratios for mutual funds. Surbi is here with more details on this. Surbi.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled, and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduce the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was what was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or they're cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
And that middle ground has done well for a lot of these fund management stocks. HDFC AMC up around 5%. We're seeing some traction in Nippon Life as well, up around 4%. And the entire capital market ecosystem, so to say, is doing well right now. We also spoke with the managing partner at FinSec Law Advisors, Sandeep Parekh, to understand the impact of this outcome. Let's listen into what he had to say.
The regulator should not be getting into price fixation, right? It should do that only if competitive forces are not working. Let's say if there's a monopoly, if there's an oligopoly. So, from first principles, I'm not a big fan of setting caps on any products, not just financial products. The industry is certainly grown, so I think, if you look at it from that principle, certainly it's a good thing, but it will favor the large funds and disfavor the smaller funds. No, I think it will adversely impact both the funds and the brokers as well. And again, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You have people who spend their entire lives just looking at infrastructure or just looking at transport industries. If mutual funds start hiring those kind of specialists, they'll have a research team of 100 people. So clearly, there are efficiencies in a brokerage hiring a transport expert and then distributing that research to 45 or 50 mutual fund and many other institutional clients. It's much more efficient. It's more cost effective versus having 45 different transport experts in 45 different mutual funds.
Right, so that's about the entire issue of the SEBI board allowing, or rather, reaching middle ground when it comes to the expense ratios for mutual funds. But what has the market got in it chartically for the next 1 year as we wind down to 2025 and look forward to 2026? We've got this discussion lined up with Jay Thakkar of ICICI Securities. Jay, usually we speak about a quick call on the technicals of the market, but now you've come out with this look ahead sort of report, and in that, what stands out is that your Nifty bull case scenario is 29,000 thereabouts. I mean, is it just a chartical call or is it predicated on some sort of fundamental shift as well?
Good morning to you, Mangalam, and thanks for having me on this discussion for the yearly count outlook of ICICI Securities. And yes, we have come out for a target of 29,200 based on a couple of observations, Mangalam, and we have two scenarios basically that we have worked out. One is that the extreme bull case scenario would be 29,200 for the Nifty, and whereas conservatively we can see 27,500 as well. Now, in order to achieve 29,200, Mangalam, what we have seen is that, if at all FI money comes back into the India, then, if there are inflows going forward, then it's very likely that, Nifty will inch towards 29,200. And there are a couple of reasons for that, First is that if at all there is a trade resolution between US and India, then there is a very high chance of this happening. And we have seen, Mangalam, that those Asian economies or countries, those have actually finalized on the tariff issue with the US, has delivered phenomenal returns in last 6 months or the second half of this calendar year, may it be Taiwan, Korea, or Japan. I mean, we have seen these indices, in fact, inching up by almost 20 to 30% since the announcement of the tariff cuts. So if the same case happens with India, it would be quite positive going forward, and it would be beneficial in terms of FI inflows. We have seen around 1.4 lakh crores in outflow kind of FI from India. So that is likely to come back. Second reason would be the FPI's cyclicity. Now, Mangalam, second thing which we have also seen is that whenever there has been a rate cut in the US, generally we see the FI flows or the global liquidity coming back. Last year we did see that there was a QE tightening, or probably in this calendar year we have seen QE tightening and the rates were higher. But from here on, the kind of rate cut cycle that has started in the US as well, due to which I think the global liquidity is likely to be there, and India is likely to benefit out of that as well. Third observation is that dollar-related returns, if we see.
Sure, go ahead.
So,
well, Jay, you've spoken about the bull case, 29,200. Yeah, you've spoken about the bull case, but let me ask you about the twin engines or the floor also that you're talking about, 24,200. This twin engine you're talking about, the DII and the FII flows, if the, FPI flows, if that revival doesn't come in immediately on the back of, some of the trade deals and other triggers that you're talking about, what happens? Is the DII cushion strong enough to, sort of permanently floor at those kind of levels at 24,200? 24,200?
Absolutely. Yeah, good morning to you, Ritu, as well. And absolutely, that is the floor or a base which we are looking at, 24,200. And we don't think that, markets on Nifty going forward should be actually falling or slipping below those levels. And the reason for that is that generally we look at the statistical evidences for that. If you look at the mean of, that is the average of the Nifty of the last couple of years, recent average comes to around 24,200, and the target on the upside 29,200 is just 2.5 standard deviation from its mean. Now, why these levels are likely to hold on, Ritu, as you asked, is first is the DI cushion, definitely the kind of flow which we have been seeing, almost 30,000 crore of SIPs per month. That would sum up to almost 3.6 lakh crore that would be flowing in through DI route, and you see the kind of selling which we have already seen in FI has been clearly absorbed by the DIs. Otherwise, this kind of a fall generally, had it been a decade ago, we would have seen Nifty falling by more than 20%, right? So that is first thing. Second is we also looked at the internals of the market. So if you look at the NSE 200 stocks, within which FI has more than 10% kind of a holding, generally whenever you had this kind of FI sellings, Ritu, 48 to 50 stocks generally used to breach their VAR. That is, they used to fall more than expected, lines. This time around, due to FI DI money flowing into the market and with the tune of almost 25 to 30,000 crore, the number of stocks, in fact, breaching their VAR have reduced by half to almost 23 stocks only. And that clearly indicates that, the market is likely to fall less. Secondly, if you also look at the volatility, I mean, all of us have been talking about the India VIX trading at the lower end. Prior to the COVID, or at least until 2022, what we observed is that India VIX used to be trading with an average of around 16 to 18 levels. Now, with this kind of a flow by the DIs, we have seen the India VIX, in fact, sustaining or trading within a range of, say, 12 to 16 only. That clearly shows the comfort in the market. Otherwise, with this kind of a breadth in the market at the lifetime highs, despite FII selling and the market, most of the stocks being on the negative side, we still don't see India VIX going up. So that clearly shows that there is enough of DI cushion to prevent Nifty falling below the levels of 24,200, and that would be the base for market going ahead.
Very quickly, Jay, we're running out of time, but one stock among your picks is Bank of India. Stock near its 52-week high levels. You're still projecting the stock to go higher. If you could very quickly summarize why, what's prompting this thesis for you?
Definitely, Thomas. Bank of India is, from the PSU basket, if you see then, in the short term or, in the past couple of months, what we have seen is that the PSU index, banking index has definitely outperformed the Nifty private sector bank. Right. And that is also likely to, continue going forward as well. I mean, we have seen good amount of buying by the DIs, in the PSU bank. So we think that that would continue, and they have been, definitely dominating as well. As far as the levels of Bank of India are concerned, on the lower side, we believe that 115 is a very, very critical level, and we don't expect this level to, or this levels to be broken going forward, because since the PSU bank rally has started, it started from the levels of 115 on Bank of India. So that would be a critical support in the near term. And on the upside, we are expecting at least 30% kind of a target in CY26. That level comes to almost 180. So I think this would be one of the stock which could outperform the overall Bank Nifty.
All right, Jay, thank you so much for joining in and giving us a long-term view on the indices and your call on the markets for 2026. We'll obviously, catch up with you on a regular basis to get the here and now of the market as well. Take a short break, come back on the other side. Rohit Srivastava of India Charts joins in.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. It remains a volatile trading session, but we're seeing more green on the screen. The Nifty now up about 40 points. Sensex also trading up about 80 points as we speak. Markets making a recovery again, and the rupee also, we've seen some recovery in the last hour now at 91.6. That's where the rupee is at. But let's get in Rohit Srivastava, the founder of India Charts and Strike Money, for more on the market fundamentals. Rohit, welcome. Thanks for your time here. In the current scenario, how do you play the market? What are the sectors that look attractive? And this missing trigger that, we've been talking about, the reason for the FII outflows, the trade deal, how much of that has been factored in? How much is, how will you play the market? I mean, given the uncertainty that remains on that front.
So we've had the good part of, throughout the year, we've seen a balancing act as far as India is concerned. So even when tariffs happened, we had already cut taxes. We did the GST thing since it's taking time, and we've cut interest rates. So we've actually done a lot of balancing act, and fortunately, domestic flows have really not slowed down. So what that has meant overall is that while the market over the last one and a half year has gone through a corrective phase where, valuations have come off. In fact, most recently, we have seen a lot of selling in mid and small cap stocks, which, starting to make some of them look very attractive because, historically, some of these stocks used to be at P ratios of 80, 100 or more. The ones that are showing growth have managed to bring those valuations down to even the 30s or less in many cases. So that sort of brought you back to an interesting point where you start finding attractive, investment ideas when you look across the space. And when you look at large caps, because of the domestic flows and all the measures that we've really taken, the Nifty's held up its own each time. We feel a little scared that maybe this time it will also give up and join the broader market on the way down, but it's managed to hold on. And I think so far that's the positive thing, that if you've had the correction in the broad market already and the Nifty manages to hold on, then we may be ready to start another wave on the upside. Definitely the trade deal, which you mentioned, would have helped speed that up because trying to move 100 points a day is very, very slow for the Nifty, something we're not used to. And that is what is showing up in the VIX. If you had that kind of one of the biggest hurdles of the year taken away, then we could have seen some more speed in markets. But you are seeing selective buying, you are seeing selective sectors outperform, and I think that's where the focus needs to really be for the weeks and months ahead.
So what are those attractive investment themes that you are watching out for, Rohit, going into the new year?
So the easiest bet is interest rate sensitives and the commodity cycle. So we look at autos, we look at banks, financials. I think for the year have been one of the top performers, and I think they'll continue to be in the year ahead. So no change in terms of outlooks of financials making a comeback in the investment list for everybody. Metals has been an outlier. It's done well, and I think there is a case for it to do significantly better as the dollar continues to weaken and interest rates continue to drop both in the US and India. So I think there's a good case for metals to continue to outperform. So that's the second sector, I would say. And, within rate sensitives, you do want to include autos where a lot of the benefits also have come. And so auto sector has been outperforming itself, and I think will continue to do so. These end up being, I think, the top three easiest things to say. The others are harder because then you start doing what is known as more of a bottom-up analysis and looking for ideas where valuations have dropped, and there are a lot of places in the energy area where mid caps and small cap stocks that have seen a correction. Stocks have become relatively cheap and therefore looking attractive.
Just a final question before we let you go. What is it that one should avoid right now? What are the sectors that look unattractive despite the correction?
You may be surprised by this, by the answer, but it's actually precious metals. It's more an asset allocation call. I think PMs have done exceedingly well in 2025. Going into 2026, our strategy report, said equity is the new gold, which is basically saying that this is the year you need to shift away from precious metals back to equity. So that is the call that we are taking.
Interesting one there, Rohit. Shift away from gold and get back into equity. So that's the call for the next year on equities, as well as what to avoid, move away from gold. Take a short break, but not without pulling up, the PB FinTech chart. It opened lower, In fact, it's been low all through this week, but now there's been a wave of short covering on that counter. It's recovered a fair bit from the lows, moved to the high point of trade. Let's see where it ends the week at right now, down about 5.5% for this week. Take a short break, come back, more on the market on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Just before we move on, pull up Indigo. Remarks from the CEO saying that the worst is over for the airline, and the stock now has surged to the highest point of the day, 2.5% higher now, back above the mark of 5,000 as well. So good going for Indigo. There are a lot of stocks reacting to brokerage updates today. First one being Hero MotoCorp, and that is after a downgrade that has come in from Jefferies. The fact that they have downgraded their rating to underperform from their earlier rating of hold. They've also cut their their price target down to 49.50 from 55.50 earlier. So they are projecting around about a 15% downside from current levels. Now, what Jefferies is saying is that they do remain constructive on the two-wheeler demand, but this GST reform-led demand boost that Hero had received has now faded away in the month of November and December, and more so because the registration market share after that seasonal improvement in November has declined again in the month of December. So that's the reason why they are cautious on Hero MotoCorp. They also said that the stock has done fairly well so far this year. The stock is up for around 35-40 odd percent, and as a result of which the valuations have moved higher, and at 20 times FY27 PE, they find that expensive, and hence they have downgraded the stock. Down 2% in today's session is Hero MotoCorp. On the flip side, Tata Group company, Voltas, is getting a double upgrade from BofA. They've double upgraded the stock to a buy rating, and they had an earlier rating of underperform. The stock has now moved to the highest point of the day. BofA has raised its price target on Voltas to 1555 from just around 1250 odd rupees earlier, and here they are expecting around about a 13-14% upside as well. Now, what they say is that Voltas is likely to be a beneficiary or the biggest beneficiary in case there is a normal summer in calendar year 2026, and not just that, they will have a low base, they will have cost tailwinds, and they will also have pent-up demand as additional factors as to why BofA has turned positive on Voltas. They do expect this current quarter to remain subdued, but they say that all of that negativity is already in the price, and therefore on a very low base they are expecting a 44% earnings CAGR over FY26 to 28. So hence the double upgrade, a price target increase on Voltas, the stock at the highest point of the day compared to Hero, which is at the lowest point of the day.
Well, let's also address another stock that is now actually trading at an all-time low. Ola Electric pulled that up, down about 3.8% in trade today, more than 60% this year. The concern is that the promoter Bhavish Agarwal has sold stake for the second straight day now. Ria is joining us to tell us more about what's bothering the investors. Ria?
Well, yes, as you were saying, today the stock is down 4%, and this is after yesterday's fall of 4% as well. And this is the third consecutive day of losses for the stock. Now, this is because the founder of the company, Bhavish Agarwal, yesterday has sold about 4.2 crore additional shares. And this is after selling 2.6 crore shares on Tuesday as well, when the stock took a hit of nearly 8% on that day. Now, on Tuesday, the company had said that this transaction was being executed to fully repay a promoter level loan of 260 crore rupees, and they had also said that this share sale was a one-time limited monetization of the founder's personal stake. Now, up until now, these two transactions have been cumulatively valued at roughly rupees 234 crores, and more selling is expected going ahead. It is important to note, however, that with this, all of the previously pledged 3.93% shares will be released, and which will remove a critical overhang for the stock. But overall, the substantial selling by the promoter is negative for the stock, which is why it is taking such a big hit in trade today. And even since its listing in August of 2024, the stock is down roughly 60%.
Indeed, at a near record low for that stock, and at lower levels, the promoter selling even more causes further pressure on that stock. But what's resilient today are IT stocks. They're buzzing in trade today ahead of Accenture's first quarter results. We also had the TCS analyst meet yesterday. Reema joins in with the rationale and more.
Thanks so much for that. So for starters, all eyes will be on TCS. Kickstarts the earnings season in the US Q1 FY26 numbers. Will there be any change to their FY26 guidance of 2 to 5%, which was seen as muted? But I think what also got the street excited was TCS's Investor Day yesterday, where there seems to be a complete pivot towards AI. For the first time, the company quantify the AI revenue at $1.5 billion. That's about 5% of the overall revenues. If you include the new age services, it's about $11 billion. And the company also said that AI is growing much faster than the company average, about 16-17% on a quarter-on-quarter basis. And plus, this has been historically a very conservative company when it came to making acquisitions, spending the cash. They prefer to do buybacks and dividends. But now the company is, very comfortable with acquisitions. They did 2 in the last 3 months. And plus, they They've got the data center build out, and all this will happen without compromising on the financial metrics, whether it's the aspirational margin band of 26 to 28% or the free cash flow metrics. INR tailwind has been, INR depreciation has been a tailwind for the entire IT pack, so that helps. And year to date, the sector is still an underperformer. It's down 11% since the beginning of the year, though it has recovered about 14% from the October lows. Back to you.
Rima, thank you for that. And it is IT that is leading the index higher as well. Both Infosys and TCS contributing to around 35 points cumulatively on the index upside as we head towards the highest point of the day now. 25,870 is where the Nifty stands, and very ably supported by ICICI Bank. And that too now features as the top contributor to the Nifty upside. Now 24 points is what ICICI Bank is contributing, marginally off the highs of the day, but still holding on to gains of just close to 1%. What's not doing well? Sun Pharma, Mahindra and Mahindra, both of them nearing the lowest point of the day. Mahindra and Mahindra down 1.5%. Sun Pharma now down 2.5% as we speak. So these are some of the stocks that are contributing towards the downside. Just before we take your leave on this edition of Trading Hour, from Mangalam, Ritu and me, thank you so much for watching. Halftime report on the other side.
Stocks see some recovery after weak start but stay ranged. IT and financial show a positive spark, but auto and power are big drags.
SEBI has revised the total expense ratio for mutual funds by excluding statutory dues from the equation in a positive move for the AMCs. Brokers too, mutual funds also heave a sigh of relief as the cap on their fee proposed in the draft rules is raised significantly.
TCS reveals its AI play, saying it has executed over 5,000 engagements worth $1.5 billion. It adds that growth in the segment is well ahead of others and reiterates its ambition to be the world's largest in-tech solutions player.
A day after Ola Electric promoter Bhavish Agrawal offloaded shares worth 90 crores, he sells another lot for around 140 crores. He's expected to sell again to mop up 260 crores needed to repay the promoter debt. The stock slips.
US FDA classifies Sun Pharma's critical Bazaar facility as official action indicated in a setback for the drug maker. Analysts believe that this limits Sun Pharma's ability on new complex generics. The stock slides.
Good afternoon. Welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra and Vinny Motiwala. Hey girls, good afternoon. Well, we start the show with Nifty at the day's high. There's been a swift recovery from the lows. Nifty is up 50 points as we speak, and it's an uptick of around 140 points from the lows of the day. The mid-caps too doing well, up 0.4%. But do remember, the market breadth continues to be in the favor of declines. So market breadth has been an issue because while the headline index might be doing well, underneath we do see a lot of red stocks versus the green. This seems to be narrowing a little bit, but only time will tell where things go as far as the mid-cap index is concerned. We do have a lot of gains coming in from the IT index. Metals too, they have been doing really well throughout this trading month. What is not doing so well? We have the auto index, CPSE, energy. Some of them are seeing some profit booking, but a one-way move on the metal index and a lot of factors that are leading to that, but a lot more conversations on the show today and a lot of stocks as well.
Hi, absolutely. A lot of conversations that are lined up, plus a lot of stocks that I want to talk about as well. One, in terms of the stocks that are leading the gains for the Nifty today, look at ICICI Bank, top contributors, Infosys, TCS. Obviously, these IT names are coming up. And if you look at Nifty IT itself, obviously the top sectoral gainer today is the Nifty IT. On the flip side, what's not doing well in terms of the Nifty is M&M, Sun Pharma, L&T, Hero MotoCorp. That's seeing a bit of a pressure. And that is why, like Sonal mentioned as well, auto index, that's down and out, down almost 3% in today's trading session. Apart from that, metals continue to shine. FMCG is managing to hold on to green as well, Ekta.
Yes, absolutely. Well, definitely it is the advanced decline ratio which stands out as the key metric to watch out for. In the past couple of trading sessions, it has been weak, and on a day where we are seeing a recovery in the markets after 3 days of decline, it continues to be on the negative side. But nonetheless, let's kick off the show with Dr. Lal Path Labs, which has launched a healthcare and wellness center called Sovaka, which basically means wellness in Sanskrit. This new center will open in Gurugram from January 11. The center is positioned as a diagnostic-led wellness model. I did catch up with the management of Dr. Lal's and began by asking about more specifics on this wellness center. Listen in to a slice of that conversation.
Brand is known as Sovaka, which basically in Sanskrit means well-being. So as you know that we are in the business of keeping people well, and people don't have to really, see us when they are not well. So the idea is that you see us in wellness so that you don't slip into illness. Shanko, something else you'd like to add?
Yeah, so this is our first big foray into the wellness segment. So moving, I think, from disease detection phase to seeing how can we look at preventing, diseases. So primarily through diagnostics, looking at prevention.
Yeah.
So just wanted to understand that what are the services that will be offered within this wellness center, Dr. Lal, and what is the kind of investment and returns that we're anticipating from this as well?
So our first of all, it's a holistic, wellness center, which means that it covers all aspects of diagnostic medicine. So the idea behind is that people don't have to visit their doctors only when they are not well. So this is something which we have learned over the years, that you should meet the doctors also during wellness and carry out a few certain things which help you in prolonging your life and staying away from doctors basically. So talking about Sovaaka very particularly, this is a highly advanced blood diagnostics center which we are bringing to the people, and this is coming from our brand, which is there for the last 75 years. And we have been carrying out all kind of tests, in routine, the not so routine like cancer markers, the lots of vitamins, ANA, and I mean, the whole lot of tests are going to be available here. It is also equipped with the very high quality but low dose imaging, which means that minimum radiation exposure is given to the patient. And also we will make use of a personalized doctor consultation, nutritional modifications, and experienced dietitian will be there all along. And this also will include an early cancer screening across 22 organs. And by the way, Ekta, if you may remember, that we were the ones who brought the first cancer markers into India. So this is going to have all the cancer markers for lungs, brain, liver, gallbladder, kidney, prostate, breast, etc. And also bone assessment of human beings, cardiovascular risk evaluation, which I think is the most important thing, and tests like CT angiography and calcium scoring, advanced lipid profiles, ECG, and other metabolic tests would also be available here.
So my understanding is that it provides imaging along with blood tests, and hence, Mr. Banerjee, it's going to be different from Swasthfit, which is just preventive testing available in Dr. Lal's.
That's right. Swasthfit is a bundled package of pathology tests only. This will be a very comprehensive thing, including imaging and pathology testing. And like Dr. Lal was mentioning, it has a slew of preventive focus where cancer screening is there. A lot of other risk, cardiac risk assessments and those kind of things will be done.
So how much are you investing? How much are you looking to make, say, in this next 6 months to maybe even up to 3 years?
So right now the idea is really not about seeing what the return profile is. If you look at the reason why we have gone into something like this is because we've kind of started observing that people are getting serious diseases quite early in life. The stress situation, the sleeping habits, etc. The lifestyle conditions are changing, and people are getting heart issues or cancer issues earlier in their life. So here, it's more of a play where we feel that preventive medication or preventive testing needs to happen, where people should get a control on what they are doing. In terms of the investment, we are looking at, the center we are launching, the investment is upwards of 15 crores. I think the return profile is not something we are looking as a very immediate thing, but more as a part of our overall offering.
Sure.
I think this is something which is very important for our portfolio.
All right. Okay. So you've invested around 15 crores. You have one center which you're coming up with now. How much are you probably going to look to expand, Mr. Banerjee?
You see, with the expansion scope is quite large. If you look at India, with so many large cities, all the metros, the expansion scope is immense. I think right now our focus is to ensure that, this center is run well. I think the message gets percolated, and subsequently we'll work out our expansion plan.
Okay, interesting chat there coming in from Dr. Lal and Ekta, who took us through that conversation as well. So interesting health, wellness side, that's
Yes.
something different coming in from there
Absolutely.
as well.
You know, they're not really diversifying completely, but they are getting into a space which is completely focused in terms of wellness.
Yeah.
So they will be offering diagnostic testing along with imaging. So basically you get ahead, one step ahead in terms of your health and wellness needs. So let's see, 15 crores is what they've invested. One center is what they are launching at this point in time. So they'll possibly look at pan-India at this point. But then it's not going to affect their margins is what they said.
Okay, but we'll keep an eye out on that for sure. But on that note, we're going to zip into a very short break. After the break, we'll discuss trends in the renewable space with Somesh Kumar of EY India, as well as Girish Kumar Kadam of ICRA.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report. Let's talk about the renewable energy space. India has added 31.25 gigawatt of renewable energy capacity between April to November period and is on track to add another 40 to 45 gigawatt this year itself. To talk about the sector, what the outlook is, what are the challenges, we have with us Somesh Kumar, who's the partner and at Power and Utilities Leader at EVA India, and Girish Kumar Kadam, who's the SVP and Group Head Corporate Sector Ratings at ICRA. Gentlemen, good afternoon. Thank you so much for joining in. Somesh, let me start with you. We are on track to end this year with a capacity addition of 40 to 45 gigawatt this year itself. Do you think this trend will only improve come 2026? And what are some of the biggest constraints that we are seeing right now? Is it land? Is it grid access? Has financing continued the way we were seeing earlier as well?
Yeah, thank you. Thank you for having me here. Yeah, I mean, the country has done very well. I would say that, we've added 40, 45 gigawatts is what we're looking at towards the end of the year. We have a target of about 500 gigawatts to achieve by 2030, which is in about, and we're about half of it as of now. So in the next 5 years, we have to add about 250 gigawatts, which is roughly about 50 gigawatts each year. Looking at the current trends, we are very optimistic that this will happen. But as you said, in terms of some of the constraints, I think, the usual constraints used to be land, financing, and also grid access. But of late, what we've been seeing is that, capital availability for renewable projects has improved substantially. And domestic as well as international investors remain very active. Even in terms of land acquisition, which used to pose challenges, is not so much of a challenge. Yes, it's not absolutely, there, but, things like solar parks, hybrid projects, wasteland aggregation have provided workable solutions. And, we're seeing more and more support of government in acquiring land for this. But the real bigger, bottlenecks, I think there are two bottlenecks, which I would say. One is the grid evacuation, grid access, the transmission readiness. So the generation capacity is often, awarded faster and constructed faster than the grid comes up. So that really, creates an issue for evacuation of power and grid integration of renewables. And there are several issues in that, whether it is right of way, coordination across states, planning mismatches. So I think those are the things which need to be overcome. And the second one is around the intermittency. So, as we see more and more renewables, which are intermittent source of power, I think we have to make sure that there are flexible resources coming up at the same pace, including storage capacity. So I think those are the two things I think we have to focus on.
Okay. All right, that point is taken. Let's get in Mr. Kadam into this conversation as well. Mr. Kadam, like Somesh pointed out, issues such as land acquisition, etc., are sort of easing out when it comes to the renewable capacity in India. But the intermittency problem is something that he did point out. Just give us a sense in terms of how much of an issue it is and a roadblock it is for India to get to its targets on renewable capacity. Mr. Kadam.
Yeah, thank you. Thank you for having me here as part of this show. So certainly the intermittency is something which is inherent when it comes to renewable generation. Now, and that is leading to, the challenges related to the curtailment of, renewable power, which is happening in pockets in states like Rajasthan particularly, and also to some extent in Gujarat, which are, which are highly RE-rich zones. And of late, we have seen a considerable RE capacity addition in these pockets. So, and this particular challenge has precisely happened because of, the mismatch between the installed capacity, the commission capacity vis-a-vis, the available capacity for the evacuation. And that is resulting a challenge, particularly for some, portion of, the installed capacity in states like Rajasthan, where the capacity is sort of getting stranded because of, the temporary, GNA access. So that is a challenge which is currently being witnessed, and that is also because of the necessary transmission lines are still not commissioned. So that's one. The second is, of course, there can be a challenge which is also being witnessed, as we understand, is for the projects which are connected to the state network, and essentially on the pretext of the grid safety requirements. So the curtailment episodes are largely happening because of these two issues. The underlying theme here is the adequacy of the transmission network. So given the fact that we have seen a very rapid rise in renewable share, and in fact it is going to be like that even going forward, the corresponding strengthening in the transmission network, both at interstate as well as intrastate level, is a key. And that's where there has been some slow progress, and some fast track approach is really required. On top of that, what is also required is the storage capacity build up, both in battery and the pump. In fact, the kind of decline, the price decline that we have seen in the battery price levels is something which is highly encouraging for the sector, and we have already started seeing a very good participation from number of players in the standalone battery storage bids at a pretty competitive tariffs. And obviously these are being a short gestation projects, so that should also pick up. So the strengthening in the battery storage projects along with the PSP, which should take some more time because that is a long gestation project cycle, while that is clearly a focus area as we see for number of developers as we discuss. But certainly the progress towards storage would also be very, very critical to manage the challenges which are coming out from the intermittency. And just to give another data point, if you look at the overall renewable energy generation mix in FY25 is about 20%. It is going to rise to about 35 to 40% over the next 4 to 5 years.
Sure.
So we are about a considerable rise. So within that context, these strengthenings are certainly required. Yeah.
Okay. Somesh, I just want to come back to you. If renewable returns, are structurally lower than fossil fuel, why is the capital still pouring in at record levels? What is it that we could infer from this?
Yeah, I mean, that's a very good question. Traditionally, I think fossil fuels have been the mainstay of India, at least in the distant past. But now, over the last few years, we're seeing that the renewables have taken over, and the capital is really chasing the renewable projects only. We're hardly seeing any interest towards funding of fossil fuel-based projects. In many cases, we've seen that, or typically renewable energy projects sometimes do offer lower nominal returns than fossil fuel investments. But the capital is chasing them because they provide more stable, predictable, and long duration cash flows, as I would say. For large institutional investors such as pension funds and sovereign wealth funds, I think this stability is highly attractive. And renewable projects with long-term power purchase agreements resemble infrastructure assets more than what would be said as commodity-based energy projects. So revenue certainty and reduces the downside risk, which is increasingly valued in a volatile global environment. So as the global pool of long-term capital expands, I think the demand for predictable assets has increased faster and will increase faster than demand for high risk, high return opportunities. And clearly investors are both accepting lower returns and actively reassessing fossil fuel risk, because the latter is becoming more and more decisive. I think fossil fuel investments face increasing regulatory uncertainties, carbon pricing risks, financing constraints, and the possibility of being stranded at some point in time. So I think because of all these reasons, even if the returns are slightly lower in some cases, I think the investors are still, very encouraged to go for the renewable energy sector, and investments are coming into that.
Take that point, but that continues to be the big point of debate, right? Why should one invest in renewables versus fossil fuels? But of course, so far money has poured, and we'll have to see whether that continues or not without policy support. Somesh and Girish Kumar, a lot more questions, but we are completely out of time. But thank you so much for joining in with your insights on the renewable space and what the outlook is going forward for a country like India, which has a huge dependence on fossil fuel as a source of energy. Time for a break now. Up next, we'll get in Mangalam Malu, who will get you all the trends coming in from the F&O market. Stay tuned for that.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is at 25,875 levels, up around 60 points in today's trading session, almost near the day's highest point. We have those AMC stocks that are buzzing away in trade as well. Whether you look at an HDFC AMC, Nippon Life AMC also is what we're keeping an eye out on. Also, we just have some comments that have come in. FM has introduced the Securities Market Code 2025 bill in the Parliament as of now. So we'll keep out for more updates coming in here. But this is the latest that we have, as you can see, flashing at the bottom of the screens for y'all. But let's move on and bring on board Mangalam now, who's here to tell us what is happening in the world of F&O, what should we be keeping an eye out on. Mangalam, good afternoon.
Good afternoon. So if you look at the market right now, it's off the lows. It's also finding some supply at higher levels. So we're basically in a range for the frontline indices. The good part is that the India VIX is fairly managed and it's below that 10 mark, telling you that this range is likely to continue, notwithstanding the sort of volatility that we're seeing in the broader markets as well. The Nifty Bank, that has to cross the 20-day moving average, 59,285. That's an important one for the other indices to catch up as well, and the market to perhaps break out of this range. The Nifty today's low was 25,726. The part about resilience is that it's managed to hold on to the 50-day moving average on multiple occasions. Yesterday as well closed above that. Today as well has managed, despite being about 75-80 points below that, crossed past that 25,800 mark and above the 50-day moving average. So that gives you a firm amount of support. Now, were the market to break out, with the Nifty Bank to go above that 20-day moving average and the Nifty above that 26,000 mark, there could be a wave of short covering, largely because of the shorts that are piled up in the system. The FII longs are now just at 8%, which have been coming lower over the last few trading sessions. So let's see whether that comes about or not. For now, bulls believe that the supports are firmly intact. So 25,800 put writers active, 25,750 put writers equally active as well. But the bears believe that 25,950 above, that's their territory. Why do I say that? Because the market, despite recovering from the lows, we've seen a decline in the 25,900 call premium, implying that there has been writing out there. So 25,900 call has seen some writing. 26,000 could be an important resistance for the market. And that's where technically the 20-day moving average of the Nifty comes in as well at 26,018. A couple of stocks which are on our radar right now. We have HDFC AMC, which is seeing a lot of long build-up at this hour. And Hitachi Energy has been underperforming. A lot of shorts piled up on that counter.
Okay, all right, Mangalam, thanks very much for that. So that's what's taking place in the entire F&O space. Just watch out for Ola Electric, because that stock continues to be under pressure after the promoter selling which has taken place. In fact, at around 31 rupees is the lowest level that you've seen since listing for that particular counter. We'll take a short break, but on the other side, Manisha Gupta will join in to take us through what she's tracking in the commodity space. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back, and joining us on the show now is Christophe Ruel. He's Global Advisor at Crystal Energy. Christophe, hi, thank you so much for joining in. And a third straight year when we're looking at energy prices continuing to decline, and most experts believe that next year it's going to be electricity and carbon which will gain, and gas and crude oil perhaps could continue to decline. What would you say to that?
I think this is probably correct. I think it is correct at least for the first half of next year. We will see crude oil being under pressure fundamentally, as it has been for a while. There's always the risk, of course, of something happening in Russia, Venezuela, Iran, any of these many producing countries, which may cause difficulties between them and the US. Natural gas also is coming online massively in the US as an export vehicle, should be declining into the summer of next year. And electricity prices will be determined regionally, but there is probably a tendency to stabilize or move upward if the AI boom continues. And not to forget, if the world doesn't forget about climate change, then we are in also for a further boost in carbon prices.
Christophe, when you look at the next year, and there's just so much in play when it comes to energy as a space, we have Venezuela as the latest threat, clearly, that seems to have given some sentiment boost to the crude prices. But apart from that, it is still about higher supplies from OPEC and non-OPEC as well. How are you looking at the supply situation now moving into next year?
I think one have to, as you said, one has to distinguish two things. One is fundamentally, the market is very well supplied. It's actually oversupplied. There's excess supply, as some people have been preaching for a long time. But by now, this is also one of the best advertised supply overhangs ever. So that should make any experienced observer of oil markets very suspicious, because if everybody agrees there's too much supply, for example, then something is likely to change. So I would expect this to play out with pressure on prices, and then production cuts to happen again from OPEC or some other reaction. We have to distinguish that fundamental situation from oil markets to the geopolitical dimension, which is in that case only present, and that strength only present in oil markets. And here we have two hotspots, of course. One is Russia and Russian exports and the sanctions they're subjected to by the US. The other is Venezuela. They're very different, but they do play together. On Russia, the world is now observing these negotiations. I listened to Putin yesterday or 2 days ago giving a speech. He does not sound like somebody who is willing to give up some of his demands for a settlement or for a peace, which raises the specter, what will happen next? Will the US then tighten sanctions again if he doesn't play ball, or will they just not do it? The new uncertainty in dealing with all of this is, it used to be a clear equation. One of them didn't want to play ball, and then everybody knew sanctions would or would not happen. Now it's not so clear. Russia may not play ball, and Trump still may not tighten sanctions. If he doesn't, oil prices will get more under pressure from that corner. If he does, we will see a little bit of a risk premium, a geopolitical risk premium coming. The case of Venezuela is even more interesting, because Venezuela has a huge potential, but at the moment is not producing very much, not exporting very much. But it is not only an issue of volumes, it's also an issue of quality. The oil produced in Venezuela is very heavy, very sour, as we call it. And there's a few refineries in the world which are equipped to handle that. And many of them are on the Gulf of Mexico in the US. So here we have a situation where there is special refineries on the Gulf of Mexico attuned to that kind of crude quality, which are now waiting. And to some extent, other than Chevron's special deal, they are shut off from the exports from Venezuela. So if Venezuela would come back online, which is thinkable only after the government changes, then we would see a triple effect. Number one, it is more supplies, generally lower prices. That will help in keeping Russia on track. Number two, generally lower prices, also lower prices in the US. That will help with the president's agenda.
Sure.
Number three, the flow of this heavy oil, which can be processed in the US, into the US, back employment and utilization of these refineries secured. That will also help the American administration. And there's a third and a half or a fourth point, which is that some of this heavy oil used to be replaced with Russian mazout and Russian diesel. And that would also take a hit, which again plays into the Trump cards when it comes to disciplining Russia. So Venezuela is a situation, I leave it to you to draw the conclusions, but people call it gunboat diplomacy, which is not entirely misguided, the term, but it's also a situation where regime change would have sizable benefits for the current US administration. And one should, I'm not usually a conspiracy theorist, but in this particular case, one should not let this out of the equation when trying to estimate what happens next.
Oh, absolutely. There's just so many ifs and buts on what happens and how would the crude prices reacting to that. But as you said, most of that really works well for the US markets as of now. Just last one thing. How would you, or at what point do you see OPEC coming into the market and reversing its position from right now where they are adding more barrels to not adding more barrels or even reducing for that matter? What is that price point going to be as per you? And what is your own sense on the kind of range that we could look at the crude prices for 2026?
I think that OPEC is caught now between a rock and a hard place, because the reason that they expanded production at the expense of prices was not that they're some kind of, that they're not stupid and they're not masochist or anything. The reason is that they expected demand to be low, and they knew that this would be a race to the bottom where exporters, to keep the export volume steady, would have to gain market share, and they wanted to be prepared for that by having fully utilized capacity. So that means there is a pain threshold which they're willing, some pain, price pain they're willing to endure in order to maximize market share, because there's a clear reason for why you want to have high market share in this situation. Based on that, I would expect it that they are tolerating prices in the mid-50s probably, and that the decision of when to switch will be based on politics and based on observations of the rest of the market, in particular what happens in Russia and in Iran and in Venezuela. And it's not just a decision which is tied to a particular price point. So it's not that they say at $55, we increase production again. It is when they say see 55 and they see into the future and see it sustained, then they probably will limit production again. And that would be at the mid-50s range, I think.
Okay, all right. Christoph and Manisha, thank you so much for taking us through this conversation. This is the energy outlook for 2026 and what went by in 2025. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get in some stock-specific news. Ola Electric is trading lower by 5%. We'll get you the detail on the other side.
Fly Emirates, fly better.
Welcome back. Well, for the markets, as of now, we're just about higher at this point in time by around 0.3%. Currently for the Nifty, up around 72 odd points. Mid caps are doing better. There's an improvement in the advanced decline ratio, which has taken place as well. So let's see whether that sustains and whether that improves further as the day goes along. In terms of specific stocks within the broader markets, just watch out for Route Mobile, because that one is up around 82 odd rupees at this point in time. Good gains coming in on that one. Gabriel India is also seeing some amount of traction at this point, so maybe that stock should come up for you. Gabriel India is doing well in today's trading session. But just note that even if Root is up around 12 odd percent at this point, it's a far cry from its 52-week high, which stood at around 1,489 odd rupees. But not the case for HDFC AMC, which is at a fresh 52-week high in today's trading session, so doing well for that counter. But let's get talking about Ola Electric, which is trading with guts as the promoter. Bhavish Agarwal sells stake for the second straight day, and that's pressuring the stock. Ria's here with more details on this. Ria.
Well, yes, Ola Electric is down roughly 4.5% today, and this is after yesterday's fall of 4% as well. And this is also the third consecutive day of losses for the stock. Now, as you were saying, the founder of the company, Bhavish Agarwal, has sold roughly 4.2 crore additional shares in the company. And this is after selling 2.6 crore shares on Tuesday as well, when the stock took a hit of nearly 8%. Now, Ola Electric on Tuesday had said that this transaction was being executed to fully repay a promoter level loan of roughly 260 crore rupees, and they had also said that this share sale was a one-time limited monetization of the founder's personal stake. Now, these two transactions up until now have been valued cumulatively at rupees 234 crores. So some more selling is also expected going forward. Now, apart from this, with all of this, the previously pledged 3.93% shares of the company will be released, which will remove a critical overhang for the company. But overall, this remains negative for the stock after this substantial promoter selling. So the stock is down roughly 4.5% today, and even since its listing in August of 2024, the stock is down roughly 60% since then as well.
Okay, thank you so much for that, Ria. But on that note, we're actually going to slip into a very short break. We'll come back and get you more on the market, stock-specific action on the other side.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. At the day's high, Nifty is up 63 points as we speak. Some pickup in the mid caps as well. From the Nifty pack, there are certain stocks which are at the day's high. For instance, Nestle India has moved to the high point of the day. We do have Hindalco as well, which is doing well. A lot of these IT names, because IT is the top gainer, the likes of TCS, Tech, Mahindra, these stocks are on our radar. Infosys too is inching towards day's high. The big boy Reliance Industries, that too has moved to the highs of the day, leading to some of the gains that we are seeing on the Nifty as we speak. But again, the market breadth continues to be under pressure in favor of declines, and that is a key metric that we'll be tracking for moves in the broader markets. While the index is up around 0.4%, the advanced decline ratio continues to be in favor of declines. But with that, we have run out of time on this edition of Halftime Report. Stay tuned. Business Lunch will take all the action ahead.
Stocks recover from a weak start and trade near the highs of the day. IT, financials and metals are showing a positive spark, but auto and power are the big drags.
SEBI has revised total expense ratios for mutual funds by excluding statutory dues from the equation in a positive move for AMCs. Brokers to mutual funds have also heaved a sigh of relief as the cap on their fee proposed in the draft rules is raised significantly.
A day after Ola Electric promoter Bhavesh Agrawal offloaded, shares were 90 crore. He sells another lot for 140 crore. He expected to sell again to mop up the 260 crore needed to repay the promoter debt. The stock slips.
US FDA classifies Sun Pharma's critical Bazaar facility as official action indicated in a setback for the drug maker. Analysts believe this limits Sun Pharma's ability to new complex generics. The stock slides.
An Indigo CEO tells employees that the worst is behind and operations of 2,200 flights have stabilized. He adds that the focus will now be on resilience, root cause analysis and rebuilding. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormaz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. Mirroring the sentiment of the markets again, but doing well at the high point of the day. The Nifty and the Sensex, broader markets doing better than the Nifty and Sensex.
Well, the bulls will be happy, especially from the recovery that we have seen from the lows of the day. It's almost, 160-point recovery now from the lows. 25,726 was the low of the day today. And we are now at the highest point of the day. The next important level is the 25,900 mark. We're still finding some bit of resistance at that level. The fact that the call writers are still very active on that 25,900 strike. So it'll be interesting to see if there is a push through from that 25,900 level in the second half of the trading session. And IT is leading the charge today on the index. But of course, the 20 DMA on the upside is now at 26,000. So those are the two important levels to watch, at least on the index as of now.
Absolutely. And if you take a look at that advanced decline ratio as well, right, even though the markets are in the green, it is still in favor of the decline. So we'll have to watch what happens with the advanced decline ratio. But let's take a look at some of those stocks leading from the front. As Hormaz pointed out, the IT index is the top gaining index with names like TCS, Infosys, Wipro, all of them gaining 1% or more. And what will be key to watch will be Accenture's earnings later today. That metal pack as well doing really well, continuing to shine. They've been doing well the whole week as well. Hindustan Zinc, Hindalco and Vedanta, all of them gaining in trade, doing really well between 1% and 2%. On the downside, though, you've got those auto names. That index is nearly 1% lower. Hero MotoCorp, M&M and Bajaj Auto, all of them about 1% in the red.
Some interesting moves that are coming in on these names. We'll watch out for Accenture's earnings later this evening, as Arundhati was highlighting, and a lot to talk about in the IT space as well. But just before we move to this first story, just pull up the asset managers charts, the HDFC AMCs, the Nippon AMCs. HDFC AMC at one point was up almost 5 to 6%, and that has been the big talking point. Now it's extended its gains, now 7% higher on HDFC AMC. Nippon Life, at the start of the session, was up around 5% as well, and that has slightly come off the highs of the day. But as of now, Nippon Life AMC is also a stock that is doing well for itself, still 4.5% higher there. And this comes after market regulator SEBI revised the expense ratios for mutual funds. Surabhi is joining in with more details on this. Surabhi.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled, and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduced the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or they're cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
All right, Surbhi, many thanks for those details. We also spoke to Sandeep Parekh, the managing partner at FinSec Law Advisors, on the impact of this outcome. Listen in to what he had to say.
The regulator should not be getting into price fixation, right? It should do that only if competitive forces are not working. Let's say there's a monopoly, if there's an oligopoly. So, from first principles, I'm not a big fan of setting caps on any products, not just financial products. The industry is certainly grown, so I think, if you look at it from that principle, certainly it's a good thing, but it will favor the large funds and disfavor the smaller funds. I think it will adversely impact both the funds and the brokers as well. And again, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You have people who spend their entire lives just looking at infrastructure or just looking at transport industries. If mutual funds start hiring those kind of specialists, they'll have a research team of 100 people. So clearly, there are efficiencies in a brokerage hiring a transport expert and then distributing that research to 45 or 50 mutual fund and many other institutional clients. It's much more efficient. It's more cost effective versus having 45 different transport experts in 45 different mutual funds.
Now, meanwhile, Finance Minister Nirmala Sitharaman has tabled the Securities Markets Code Bill 2025 in the Lok Sabha. The bill, which aims to amend and consolidate rules related to the securities market, has been sent to the Standing Committee for a review. Listen in to what she had to say while tabling the bill.
Gone through in detail the points which the members who are opposing the introduction of the bill. I think instead of going into details of each one of the objections, I would like to highlight the point that at this stage of introduction, we are only making the bill to be sent over to the Standing Committee to do a complete review of the bill.
On to the latest on the Indigo crisis. As Indigo's flight services return to normalcy, CEO Peter Elbers said in a video message that the worst was over for the airline, adding that Indigo will now focus on rebuilding. Here's what he said.
Through the storm, we are finding our wings again. The worst is behind us. These last 2 weeks have been very challenging for all of us. As Indigo employees, we stood tall and united, weathering the storm together with unwavering support for one another. Thank you to our pilots, cabin crew, airport staff, operations control, customer service, and all functions who supported. Your collective dedication is the backbone of Indigo. On December 9th, I shared stabilization of Indigo's operation. After that, we restored our network to 2,200 flights today. Given our scale and complexity, recovering such situation in short time is a testament to our teamwork and the strength of our operating principles. Now we focus on three things: resilience, root cause analysis, and rebuilding.
Operations stabilizing at Indigo. Now moving on, dense fog across North India continues to impact daily lives. The Delhi airport has cancelled at least 11 incoming and an equal number of outgoing flights today as the visibility at the Palam airport dropped sharply to 150 meters this morning. Both Air India and Indigo have flagged the likelihood of reduced visibility across airports in North and East India. The weather department predicts heavy fog to continue at least till Friday. Meanwhile, air quality in the national capital remained in the very poor category, with the air quality index recorded at 358 on Thursday. Take a short break. More news and updates follow on the other side. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still with us on Business Lunch. Now, amid slumping approval ratings, U.S. President Donald Trump used his brief remarks to the nation from the White House to tout his record since returning to office. In his 18-minute address, the U.S. president tried to deride his predecessor and assert that his economic plan is working, urging Americans to be patient as policies start to kick in. Take a look.
The wages, just look at it. Wages are going up much faster than inflation. How big is that? Very importantly, there are more people working today than at any time in American history, and 100% of all jobs created since I took office have been in the private sector. Think of that. 100% of all jobs have been in the private sector rather than government, which is the only way to make a country powerful and great. This historic trend will continue. Already, I've secured a record-breaking $18 trillion of investment into the United States, which means jobs, wage increases, growth, factory openings, and far greater national security. Much of this success has been accomplished by tariffs. My favorite word, tariffs. Standing up to the special interests to dramatically reduce the price of prescription drugs. I negotiated directly with the drug companies and foreign nations, which were taking advantage of our country for many decades, to slash prices on drugs and pharmaceuticals by as much as 400, 500, and even 600%. In other words, your drug costs will be plummeting downward. And I used the threat of tariffs to get foreign countries who would never have done it to pay the cost of this giant dollar reduction. They stopped ripping us off, and it began as of 4 days ago. There has never been anything like this in the history of our country. Drugs have only gone up, but now they'll be going down by numbers never conceived possible. The Democrat inflation disaster, again, the worst in the history of our country, also robbed millions of Americans of home ownership and indeed the American dream. The yearly cost of a typical new mortgage increased by $15,000 under Democrat rule. In 11 months, we've already gotten that annual cost down by $3,000, and it's coming down a lot lower. Wait till you see, the numbers are going to be shocking. And I'll soon announce our next chairman of the Federal Reserve, someone who believes in lower interest rates by a lot.
Now, President Trump also claimed that he has ended 8 wars in the last 10 months in his primetime address, even though many of them continue to remain unresolved. Meanwhile, reports also say that the US and Russia are planning to meet in Miami over the weekend to hold talks on the war in Ukraine. CNBC's Dan Murphy with all the details.
President Trump also spoke about global conflicts and claimed he ended 8 wars.
I've restored American strength, settled 8 wars in 10 months, destroyed the Iran nuclear threat, and ended the war in Gaza, bringing for the first time in 3,000 years peace to the Middle East, and secured the release of the hostages, both living and dead. Here at home, we're bringing our economy back from the brink of ruin.
Again, while President Trump has intervened in a number of international conflicts, many remain unresolved. The most significant was the Israel-Gaza war, where Hamas released hostages under the first phase of a ceasefire deal that he did broker. However, truce violations have occurred, and Israel and Hamas remain far apart on major issues. Trump has also intervened in disputes between Cambodia and Thailand, Armenia and Azerbaijan, India and Pakistan, and Rwanda and Congo. Yet conflicts have also flared up again in some regions, such as Cambodia and Thailand, with underlying issues in most of these disputes still unresolved. Moving on now, in Russia and Ukraine, another major conflict that Trump has intervened in and that has not yet been resolved. Politico reporting today that the US and Russia could hold talks in Miami this weekend to work on a peace plan. Meanwhile, at an annual meeting with Russia's top military officials, President Vladimir Putin warned that Moscow could continue to seize more territory in Ukraine by force if Kyiv and European leaders refuse to engage with US-backed peace proposals. Putin also taking aim at European countries, accusing them of trying to weaken Russia. He delivered a pointed message to the supporters of Ukraine as well.
Everyone expected they would destroy Russia in a short period of time, tear it apart. The European swines immediately joined the efforts of the previous US administration under President Joe Biden, seeking to profit from the collapse of our country, to reclaim what has been lost in previous historical periods, to take revenge. As it has become obvious to everyone, all these attempts and destructive plans against Russia have failed, completely failed.
On that note, it's time for us to head into a short break, but more news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Now, the two-way fight to acquire Warner Brothers continues to heat up. The saga started when Netflix proposed a cash and stock deal for Warner Brothers' streaming and studio assets, valuing Warner Brothers Discovery at $83 billion. Soon after, Paramount Skydance launched a hostile all-cash bid for the same assets, valuing Warner Brothers at an enterprise value of $108 billion. Now, the board of Warner Brothers Discovery has unanimously recommended that shareholders reject Paramount's takeover offer and stick to that received from Netflix.
And as we wrap up on Business Lunch, some news from the world of showbiz. The Academy of Motion Pictures has signed a multi-year deal with YouTube, giving it exclusive rights to telecast the Oscars from 2029 to 2033. So 2029 onwards, the Oscars will be streamed free of cost on the video streaming portal.
And with that, we take your leave on this edition of Business Lunch. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and with me is Ekta Batra. We did see a recovery from the lows of the day and we are slightly off the highs, but yes, continues to be above the 25,850 mark. Broader markets, the breath is under pressure, but the headline index is higher in trade. Hey, Ekta.
Hi, Sonal. Yes, a recovery for after 3 days of a decline for the market. So let's see where we end up. As of now, just about consolidating with a little bit of a green tick on the markets. But let's take you through all of the top stories that we're tracking this afternoon on Midcap Radar. Stocks recover from a weak start and trade higher. IT, financials and metals show a positive spark, but autos and power are big drags.
A day after Ola Electric promoter Bhavish Agrawal offloaded shares worth 90 crore rupees, he sells another lot for 140 crore rupees. He's expected to sell again to mop up the 260 crore rupee needed to repay promoter debt. The stock slips.
Shares of Antony Waste Handling zoom in trade as subsidiary wins 1,300 crores of municipal solid waste contracts from the Bombay Municipal Corporation.
And shares of Nuvama Wealth, HDFC, AMC, Nippon Life trade higher as SEBI revises total expense ratios for mutual funds by excluding statutory dues from the equation. Brokers to mutual funds also heave a sigh of relief as the cap on their fee proposed in the draft rules is raised significantly. Okay, all right, those are the top headlines. We'll discuss some of them in greater detail through the course of the show. Nifty IT continues to be the top sectoral gainer, but that too has come off from the high. So we'll keep tracking the market moves for you. For now, most of the indices in the green as we speak, barring auto, energy and pharma as well, which are putting some pressure on the markets. And small caps too. The index is higher in trade, Ekta, and a lot of movers that we are tracking closely.
Yes, absolutely. So today is quite a lively day in terms of what's taking place internally in terms of the markets. So like we pointed out, Antony Waste is up around 14% at this point in time. But we have other stocks also which are showing quite a lot of traction in terms of the volume as well as the price picture. So transformers and rectifiers, for example, is up around 2%. We have Praj Industries, which is up around 2% as well at this point in time. So some amount of traction which is coming into these specific stocks. Just watch out for something like a Man Industries. That 400 rupee odd stock is down around 4% at this point in time. But let's kick off the show with our mid-cap mover segment. We have Hormuz joining in to tell us what he's tracking this afternoon. Hormuz.
Oh, better if not the best, if you could call it that. And the screen shows the bulls would be happy to take this gain, the mid-cap index being at the highest point of the day. So we'll start off with some of the movers in the broader markets belonging to the asset management space. HDFC AMC is continuing to build on to those gains, now 7% higher on the stock. Nippon Life is slightly off the highs of the day, but Motilal Oswal has now surged to the day's high, 4% higher on this stock. Metals as a pack continues to do well, as it has been the case over the last couple of weeks. Hindustan Copper is now up 5. Hindustan Zinc, a new 52-week high, now nearing the mark of 600, 2.5% higher here as well. And Vedanta also continuing to move higher after the demerger approval. Newsmakers today, you highlighted Antony Waste doing well. Crompton, after a positive brokerage note at one point, was up 6.5%, so slightly off the highs. But Ola Electric at the lows of the day, another low for the stock, down 5% now. And Voltas, after the double upgrade, doing fairly well for itself. Among stocks doing well on some of the broader market losers today, let PTC Industries and Siemens and Hitachi continue to move lower. It's some concerns with regards to these two, 4.5% down on both of these names. And lastly, stocks at 52-week lows today. Westlife Food World continues to grind lower, as does Ramkrishna Forgings, and HG Infra has joined the list of stocks at 52-week lows. Another 2.5% gone in today's session.
All right, take that point. Thank you so much, Hormuz, for joining us. Some other stocks which are buzzing on huge volumes. Root Mobile is one of them, 12% higher. We have Bliss GVS Pharma, which is higher by 12%. Prime Focus is also doing well, 6% higher on that. We do have HCC, which is higher by 5%. So yes, while there are more losers than gainers in market today, some of them are bucking the trend as far as the advanced decline ratio is concerned. We'll slip into a short break. When we come back, we'll get you more stock-specific action on the other side. Stay tuned.
There is need for growing protection through insurance in this country. We need to have insurance more accessible.
A long wait of 4 years for the Indian insurance sector comes to an end with the Insurance Amendment Bill finally being tabled in Parliament.
When it comes to inviting 100% of the capital for the insurance sector, this will go a long way.
The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies.
Always expected that an agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're still tuned in to Mid-Cap Radar on CNBC-TV18. Let's talk about specific stocks then. Just wanted to point out that there are a lot of stocks within the small cap index which are buzzing around at this point in time. So Radico Khaitan is one of them, which is up significantly in today's trading session. So that should come up for you. And even something like a Hindustan Copper is doing well. We have Gabriel India, MCX, all of these stocks which are showing some amount of traction within the small cap space. But nonetheless, let's talk about Antony Waste Handling with zooms in trade with gains of more than 15%. This is after its arm has bagged 2 orders worth around 1,330 crores. Ria joins in with more details on what this means for the company. Ria.
Well, yes, Antony Waste Handling is up roughly 14 to 16% in trade today after the company's subsidiary AG Enviro Infra Projects has received 2 orders cumulatively worth rupees 1,330 crores for a period of 7 years from the BMC for the collection and transportation of municipal solid waste. Now, these contracts have been awarded to a JV wherein AG Enviro holds roughly 51%. The other 2 companies in the consortium are Jigger Transport as well as MK Enterprises, which hold roughly 29% and 20% stake each. Now, today the stock is seeing a big move as a result of these orders, but in the last 1 year, the stock is down roughly 25%, and since its peak in July 2024, the stock is down nearly 51%.
Okay, all right. So big move today, but as Ria pointed out, the stock has been out of pressure in the last 1 year. But that's not it, Ria. You're also tracking Ola Electric, a big cut there in stock price this year as well. The stock has not done well. Tell us what's happening here.
Well, yes, Ola Electric is seeing a big cut in trade today, and this is after yesterday's 4% fall, and this is also the 3rd consecutive day of losses for the stock. Now, the founder of the company, Bhavish Agarwal, has sold roughly 4.2 crore shares of the company, and this is after selling 2.6 crore shares on Tuesday as well, when the stock took a hit of nearly 8%. Now, Ola Electric on Tuesday had said that this transaction was being executed to fully repay a promoter level loan of roughly 260 crore rupees, and they had also said that this share sale was a one-time limited monetization of the founder's personal stake. Now, these 2 transactions up until now have been valued at roughly 234 crores, and more selling is also expected going forward, which is why the stock is taking a big knock in today's session, and the stock is also down roughly 60% since its listing in August of 2024.
Okay. All right, Ria, thanks very much for that. So that's Ola Electric. That stock is down around 5% at this point, sitting at the lowest level that we've seen since listing. But nonetheless, Crompton has gained in trade after Motilal Oswal has initiated a buy rating on the stock and believes higher ad spends will in fact strengthen the brand value. Hormuz is back with us to talk about this. Hormuz.
It is an interesting note that from Motilal Oswal, they've initiated coverage with a buy recommendation, a price target of 350 rupees and implying a 40% upside from current levels. What they're saying is that Crompton is hopeful that their stake in Butterfly Gandhimati, where they have close to 75% stake, that will help them realize a lot of the cost and revenue synergies through that stake. And as you mentioned, the higher brand spending, the ad spending will help them strengthen their brand value as well. Now they are expecting an EBITDA and PAT CAGR of 17% and 21% respectively over FY26 and 28. The higher competitive intensity and a slowdown in demand, in case that happens because of an economic slowdown, are some key risks that they have highlighted, but they are projecting a 40% upside. In fact, their bull case target price is 460 rupees. Now that implies a 77% upside from current levels. On the downside, they are saying that in a bear case scenario, the stock may fall to 220, which is a 15% downside, but nonetheless a positive note coming in on Crompton. This stock has also been an underperformer this year, but Motilal Oswal is expecting a 40% upside.
Okay, all right. That stock is higher in trade on the back of this brokerage note. Thank you so much, Hormuz, for bringing us all these details. With that, we'll slip into another break. When we come back, we'll get you more on the markets and a lot of stock-specific action that's happening in the broader market. Stay tuned for that.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, Aurobindo Pharma is in focus, and the news on the back of the reason why the stock is in focus is because the US FDA has inspected their Unit 4, which is basically a facility in Andhra Pradesh. It was inspected between the 8th and 17th of December, so it basically closed yesterday in terms of an inspection, and they've been issued 5 observations. The company has said that they are 5 procedural observations, so maybe that's why the stock is a little more optimistic at this point in time, holding up with a gain of around 1%.
Okay, in a market where pharma is lower in trade, there are a couple of stocks which are bucking the trend, and Aura Pharma is one of them. IT remains in focus as well. From the mid-cap space, Cyient is in focus. The company's semicon arm will buy majority stake in Kaynes Tech. Rima is here with more details on what it means for the company and a lot more. Rima.
Thanks so much for that. As you rightly said, Cyient Semiconductor, which is a wholly owned subsidiary of Cyient Limited, has announced an acquisition. They will acquire a more than 65% stake in Kaynes Technology for $93 million. The acquired company had are estimated to have revenues of $40 to $41 million for this calendar year. We spoke to the company. They said that this acquisition on the top line will double the company's semiconductor revenues, and this acquired company has been growing at 25%. Now, in terms of the margins and the EPS impact, the company said the acquisition is expected to be EPS accretive from year 2 and EBIT margin accretive from year 1. Kinetic Technologies margins are at 45%, according to the company. Now, with respect to the valuation, we said the payout is $93 million. The management said that the company has been acquired at 2.9 times EV to sales, which is less than what the industry deals are happening at, which is 5 times. But JP Morgan still believes it's on the higher side because the last 3 acquisitions that Cyient did were at about 1.9 times EV to sales. In terms of the funding, not much clarity, but it seems that it could be a combination. The company said that they will be able to provide cash, but other funding options, including debt, will be considered. Back to you.
So basically, with this acquisition, we will double our revenue. Our margins will be positive, and we will be accretive in year 2 from an EPS perspective. As the acquisition doubles our addressable market now in power. Power is a large market in semiconductors. It's like a $40 billion market. Now it gets us access to about $8.5 billion of the TAM in power, especially in power conversion. Now, Kinetic has a strong customer relationship, especially pretty deep. Many customers have been with them 10 plus years. It's reflecting just strong product conviction, higher switching costs, and the enduring value of their IP. And fourth, I'd say, obviously it's going to be financially accretive as we talked about, and it helps us double the revenue and also the addressable market. In summary, it accelerates our power strategy by years and expands our market opportunity. It strengthens our IP moat and improves our financial profile, making it a critical step for us to build a high margin power business for India and for the world.
Okay, that's on Cyient. But SEBI has revised the total expense ratios for mutual funds by excluding statutory dues from the equation in a positive move for AMCs. We did speak to Sandeep Parekh, who is the managing partner at FinSec Law Advisors, on the impact of this outcome. Listen in to what he had to say.
The regulator should not be getting into price fixation, right? It should do that only if competitive forces are not working. Let's say there's a monopoly, if there's an oligopoly. So, from first principles, I'm not a big fan of setting caps on any products, not just financial products. The industry has certainly grown, so I think if you look at it from that principle, certainly it's a good thing. But it will favor the large funds and disfavor the smaller funds. No, I think it will adversely impact both the funds and the brokers as well. And again, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You have people who spend their entire lives just looking at infrastructure or just looking at transport industries. If mutual funds start hiring those kind of specialists, they'll have a research team of 100 people. So clearly, there are efficiencies in a brokerage hiring a transport expert and then distributing that research to 45 or 50 mutual fund and many other institutional clients. It's much more efficient. It's more cost effective versus having 45 different transport experts in 45 different mutual funds.
Okay, all right. On that note, let's get you some market perspective. Anish Tavakle, who's the co-CIO equity at ICICI Prudential AMC, says he will remain cautious of mid and small caps in this environment. Listen in.
In general, in the markets, I would say, when you're seeing a lot of promoter selling, a lot of private equity selling, you have to be careful. And that is what has been happening in the small and mid cap space, right? And if you look at that overall space, it's kind of weakening. Because, I distinguish, I say there are 3 types of companies. There are hardware companies, there are software companies, and vaporware companies. Vaporware companies being ones where the narrative is way in excess of the reality. And I think those narratives are being exposed. And I expect that to continue. So small and mid caps, I would still be careful. Large caps, I think, are offering a reasonable risk-return trade-off over a 3-year view. We are positive on the economic outlook. And as a consequence, we like basically sectors that do well when the domestic economy does well. So that's stuff like financials, it's stuff like industrial and capital goods, automobiles, and also cement. I have avoided EMS companies. I'm not sure of the competitive advantage these guys have built. I think the market is making a mistake by giving a multiple to PLI earnings.
Okay, all right. So that's the view coming in on the markets. But as of now, we're seeing some amount of consolidation which is taking place. Nothing really to write home about in terms of significant gains for the markets. So it's just about consolidating. And you'd have to say that not very confident in terms of gains at this point in time. We could probably ask for more. The Nifty is just about higher by around 34 odd points. We have the mid-cap index, which is up around 0.3%, and the bank Nifty, which is up around 0.2%. The advanced decline ratio, as we've been pointing out, has been on the declining side. So there's no real improvement which has taken place in terms of the advanced decline ratio, which stands at around 1,750 stocks advancing to 2,500 stocks declining. We need to wrap on the show, but stay tuned. We have more news and updates coming up, and we do have your stocks and mutual fund corner up. Stay tuned.
Hello, good afternoon. You're tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra as well. Sonal, good afternoon to you as well. And last evening, obviously, those major changes, that were proposed to the SEBI, that has been finally announced. These are some big changes that have come in for the mutual fund industry. What are these changes? What does it mean as well for investors? We'll talk about all of that. But first, let's understand what these changes are, and let's go across to Surbhi to give us those details.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled, and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduced the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or their cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
Thank you so much, Surbhi, for explaining that change for us. To understand it from a retail perspective, retail investor perspective, whether it will actually go ahead and cut costs for them. To understand this, now we are joined by Varun Fatehpuria, who is the founder and CEO of Daulat Finvest. Varun, good afternoon. Thank you so much for joining in. Well, we heard now the total expense ratio is split into base expense ratio and the statutory levies will be separate. Is it just on paper, or will we actually, or the retail investors will actually see it in their cost when they're investing in mutual funds or not? Or do you think it's just a separation of 2 costs that they'll only be able to see, but it will not meaningfully turn to lower costs for them?
Hi, Sonal. Good afternoon. So I think, as Surbhi correctly pointed out, first things first, it is currently an unbundling of the cost. So what was previously included in the TER, including all of the security transaction tax, the GST, the stamp duty, so on and so forth, now investors have a very clear distinction with respect to what they're paying towards the fund management charges and what is going towards government in form of duties. With respect to whether there is going to be an actual reduction in from a cost perspective to the investor, that remains to be seen. But just from a limit perspective today, as things stand today, the BER at the highest slab has been reduced from 2.25% to 2.1%, but that actually excludes all of the levies that were being passed on to the investors. So net, I think we are not going to see a major impact from a cost perspective, but what it definitely does is provides a higher level of transparency. So in the future, if there is going to be a certain deduction in charges from the fund management perspective, that is going to be clear. But if that sort of gets negated by a higher regulatory and statutory levy, then investors are clear where their money is going towards.
Okay, so that's a clear demarcation in terms of where we may see changes coming in terms of the cost going forward as an investor. Varun, good afternoon. But obviously the other change is that brokerage cap is also coming, right, for these AMCs. Now, will that in any sort of a way make a difference on the investor side as well? Do you think that's something that could be passed on to the investor?
So I think previously what SEBI had made it very clear that when you're paying a certain amount of fund management charges, the brokerage charges were already being accounted for in the scheme itself when the AMCs were actually making use of the services being provided by the brokers. Now, since there is a hard cap on what the brokerage could be, so on the cash market transactions, it's closer to 6 basis points, and on the derivative transaction, it is closer to 2 basis points. So SEBI is effectively telling is, hey, we need to sort of look more deeper and make sure there is no double charging of charges. And to that effect, that has been capped. So yes, I think initially when the regulation paper came out, there was a big impact on the brokers. But today, as we see the regulations coming a bit more clearer, most of the AMC stock are up. And correspondingly, I think brokerage is also not expecting a major impact to the earnings. So vis-a-vis, I think we are not going to see a huge impact on the investor side as well.
Okay, so no impact on investor side, which was expected to be big had the proposed regulations been notified as well. But of course, there's a big change there as well. It's lower. It's not as onerous as it was expected for the industry. Just a quick point on passive versus actives, Varun, because passives already have a lower cost. Do you think this could any chance, because now we're splitting or unbundling the levies, right, to give more clarity to investors, this could be more positive for active investing, or do you think things will stay the way they are right now?
No, I don't think it is going to have any particular impact on the active side of most of the equity mutual funds, given the limits pretty much remain the same. So I think for newer AMCs, pretty much they have operated on the higher end of the TER anyway. And once the AUM crosses a certain amount of threshold, that correspondingly sort of comes down. Even with index funds, I think when most of the AMCs are starting out with a smaller AUM, even at the index fund level or the passives, the TER usually tends to closer to be 100 basis points, right? So given with the regulations that are also coming, we do not see a major impact on the differential between active and passive, and net expecting it to remain broadly in the same range.
Varun, just want to understand, you mentioned it, right, that we may not see, or one investor may not see much of a difference in terms of these new rules coming in, but does one have to look at their portfolio strategies right now? Anything that an investor needs to do after these new norms?
I don't think so in particular, just because there has been a certain amount of change from an expense ratio perspective. They need to tinker their portfolio so much. I mean, for all intents and purposes, this does not really have a major impact on what the underlying portfolio, that pretty much remains the same, right? So yes, to your question directly, I do not think investors today at this point in time need to read too much into what the regulations are, apart from the fact that there is going to be a greater transparency. So they have a better understanding where, again, their money is being channelized.
Okay, all right. So more transparency, but not major change to costs for investors. That is the big takeaway, because the expectation was that maybe because such reform is coming after 3 decades, there could be something from the investors in it. The only thing is more transparency and breakup of your costs rather than reduction of your costs. So that's an important analysis of the big change that has come by in the total expense ratio, which has been announced by SEBI last evening. We'll now do one thing. We'll take a quick break, and up next we'll talk about investing in international funds via Gift City with Varun. So stay tuned for that conversation.
Welcome back to MF Corner on CNBC TV18. And like we mentioned before, we're going to be focusing on investing in international markets via Gift City. Now, this recent time, we've seen a couple of funds actually being launched here. PPFAS has launched 2 funds coming in here. One is the S&P 500 fund and the other one is a NASDAQ 100 fund. Obviously, they are tracking the US markets. Apart from that, there is a Baroda BNP Paribas AMC, which has launched a Gift City fund investing in US small caps as well. So obviously this offers direct access to US small cap market. Now, what are the risks? What are the advantages? How should you go about it? Does it make sense to go via this as well? Let's continue this conversation now with Varun Fatehpuria. We have with us who's from the founder and CEO at Daulat Finvest as well. Varun, you know, obviously we've spoken about Gift City investing in the past as well. But if you could highlight the key advantages that come in here for an Indian investor seeking to invest in the international market, the diversification that you want over there. And obviously, there are a lot of talks that come in terms of the perception of tax-free also. Is that the case? What is the scenario in terms of taxes here as well?
So, Vinny, I'll take the first question first with respect to one of the biggest benefits and why Gift City funds today are in an investor's radar is because for all intents and purposes, the $7 billion cap at the industry level has been hit, due to which a lot of investors like us are unable to invest through the traditional mutual fund route, right? So a couple of years back, you could just passively invest in an S&P 500 or a NASDAQ 100 through the international mutual fund route. But today, because the cap has been hit, investors are forced to choose the Gift City fund route. So one of the biggest advantages today, instead of directly investing in US stocks or any other global stock, is the familiarity and a regulatory framework through which you can actually invest. So think of it as similar to SEBI, but the Gift City regulator, IFSCA, provides you with a very traditional and a formal framework through which you can actually send your money outside of the country. So while physically Gift City is still located within India, technically it is an offshore jurisdiction. So when you're investing in Gift City, you're actually sending money outside the country. So that is one of the advantages. Second, with respect to, I would say, taxation. So most of the funds in Gift City today are structured as a trust, right? And as a retail scheme today, since it is set up as a trust, the taxation incidence is at the hands of the trust. So whenever investors actually redeem their funds, they are redeeming at a post-tax snap, which investors need to understand compared to, let's say, a traditional international mutual fund route, where the tax incidence actually lies in the hands of the investor. The tax is already accounted for at the Gift City fund level. Okay. So whatever the investors receive is at a post-tax snap.
Also, you don't have to pay the tax collected at source, right, which was announced earlier, and that also brings in a lot of liquidity, which you would do otherwise if you're investing directly in international stocks. But there are, of course, risks which would be involved, right? People are looking at Gift City also because there are limits to how you can do it directly via international funds. So what are some of the risks that investors should be aware of when they're investing via Gift City in these fund of funds?
So I would say, Sonal, I think less of a risk and more of a structural novelty, in the sense that people are less familiar with respect to how to actually send their money outside of the country. So if I were to invest in a plain vanilla international mutual fund, I could probably just do that with a couple of tap of a button, and that is relatively straightforward. Today, if I'm investing through an LRS route, I need to first make sure the currency conversion happens at an appropriate rate. Then my bank needs to actually send that capital to the AMC unit in the Gift City, which further then invests that in the international markets. That number one. Number two, these funds are actually dollar denominated. So when the redemption proceeds actually come into your bank account, they come in US dollar format. So this could actually be a very well way to actually build a certain amount of dollar asset over a 3 or 4 year period, if you're able to utilize the 250K limit which the LRS allows. So no risk per se, apart from the traditional or the standard international investments risk, which anyway you are exposed to, whether you're investing through Gift City or you're investing through an international mutual fund.
Okay. Varun, what kind of investors are best suited for these international fund of funds or investing via Gift City? And obviously this will be considered as a satellite allocation, right, in their portfolio?
So we always advocate that people need to build maybe anywhere in the range of 15 to 25% of the overall portfolio for international allocation. But having said that, yes, I think it really depends from individual to individual, investor to investor, based on what the risk appetite is. So Vinny, I think all said, investors could look at allocating to that range, because today we are pretty much have a very strong bias towards our home country. So almost all of our assets, whether we are working or have a business, are actually invested in the country. So actually taking that away and putting that aside from a small pie perspective into the international markets could actually be a very well strategy to hedge your exposure, number one. And number two, given the depreciation of INR against most of the global currencies, this could also be a very well way to hedge your international currency risk, where if the INR actually depreciates, you stand to benefit more.
Okay, all right. So people who are investing right now must be benefiting from the rupee depreciation that we saw in the last 15 days. Two-part question here, Varun. One, would the investment via Gift City be costlier for an investor? Also asking because we've seen these changes in total expense ratio now, right? And how should investors balance their exposure between Indian and international markets using the new products?
So today, Sonal, most of the number of investment options today available in the Gift City are fairly limited. So if I want to categorize that, there are retail schemes and non-retail schemes. Retail schemes start at about $5,000 at minimum, compared to, let's say, an international mutual fund route through the onshore route, where you can invest as low as 500 or 1,000 rupees. But the expense ratio that we have seen today, anywhere for regular plans, are in the range of 1.5 to 1.75%, definitely higher than what you would see in the domestic markets for passive exposures, right? So yes, definitely from a cost perspective, if you're looking to get an active exposure to the global markets through the Gift City, the TER is slightly on the higher side compared to international mutual funds. And just on your second question.
Yes, go. I'm sorry, you were saying something, Varun?
No, could you just repeat your second
Oh,
question?
yes. I was just saying, how can one balance their domestic and international exposure via these products? Because you do have to have a balanced portfolio, right? So how does one go about that?
So I think typically, again, as I mentioned today, most of our investments are biased towards the Indian domestic equity markets. So we always advise clients that you start small and maybe take a 7 to 10% exposure to global markets. Maybe US is the most familiar destination. And obviously, given how the US markets or most of the other emerging markets globally have performed over the last year and a half, with the AI boom, which is actually taking place, right? Then maybe I think once you become familiar, you understand what are the risks involved, you could obviously dial that exposure up to 15 to 20% of your overall portfolio. So it gives you a more balanced portfolio, given the Indian equity markets have not really performed over the last 15 to 16 months. So if you would have had international exposure, at least a certain part of your portfolio would have been hedged.
Right. Varun, you did mention, right, that the amount at the start, when you do start investing in this fund, is going to be $5,000, if I'm not wrong, right? That's what you said. So when you're investing in these funds, whether it's a PPFAS, S&P 500 or the NASDAQ 100, there will be a lump sum amount that goes. And then is there a minimum amount for SIP that you have to go through every month as well? How does that work?
That's right. So the minimum initial contribution amount is $5,000 for most of the funds that we're talking about, whether it is the DSP Global Equity Fund or the PPFAS S&P 500 NASDAQ 100 fund. And once you have made that $5,000 contribution, then you can make an ongoing contribution of $500, which is closer to 45,000 rupees in current exchange rate. So definitely, yes, slightly on the higher side compared to most of the mutual funds that we are familiar with, but definitely not out of the reach of people.
Or for HNIs, according to you?
So HNIs also today have a Cat 3 option where they can invest about $150,000. So the Baroda fund that you talked about initially, so that is actually a Cat 3 AIF where the minimum investment amount is $150,000. But that could be brought down to about $10,000 if you are an accredited investor.
Thank you so much for explaining that to us so comprehensively. So that's all about investing in Gift City or international funds via the Gift City route. Thank you so much with your insights today. With that, we'll do one thing. We'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng has opened with cuts of 0.6% as well. For the Japanese index Nikkei, that's seen a sharper cut of almost 1%.
Equity transactions as well as derivative transactions, the brokerage charges have come as a relief.
The downside of that range is about 28,700 and the upside is what's on your screen.
A couple of indicators indicate that maybe, at least in the near term, we could see some bit of a relief either today, tomorrow or the next couple of trading sessions.
It is a lower start. It's becoming quite clear, but it's not sort of a washout by any stretch.
Health insurance is less about delivering healthcare than about managing fraud.
Acquisition doubles our addressable market now in power.
Everybody pays 6 bips
then I think the institutional broking industry will not be very badly impacted.
Negative news for Sun Pharma, but how they basically respond to any kind of compliance issues will be critical to see.
The market's looking relatively better today than what it was yesterday, but then again, it's just the first couple of hours of trade. Let's see where we go from here.
A complete pivot towards AI. For the first time, the company quantified the AI revenue at $1.5 billion.
As of now, just about consolidating with a little bit of a green tick on the markets.
And that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel D'Souza. All in all, a sluggish day. At 2:30, as we begin the show, markets are flat. The Nifty is just a tad below the 25,800 mark. Mid-caps unchanged. The Nifty Bank just down 5 odd points. But it's the individual stock price action. I think a couple of them. One, get Meesho. Yesterday, locked in an upper circuit of about 20%. This morning, there was profit booking. And now look at the kind of buying that's emerged in Meesho in the last 1 hour of trade. Stock again is back at the highs. And the other one is Shriram Finance. There's been a sudden dip in the stock. Remember, the board meeting is tomorrow. The company has said the board meeting is expected to be concluded by 12 o'clock. I think the press conference is scheduled for 12:30. And there you have it. It's been a big mover since the beginning of the year. The street is anticipating a deal with MUFG. But looks like some profit booking, maybe some nerves, maybe the contours of the deal, that will be crucial.
Well, that's right. And it's already seen quite a big run, Reema. I remember, it was 550 odd. Valuations are very, very cheap. Another stock is a 850 rupee stock. So in the last few months, it's already seen a big run. But as you mentioned, Meesho is one stock. The other one I'm looking at is Ecos Mobility. I think that was a newly listed IPO in the last 12 months or so. That as well has seen a bit of a spike up in the last few minutes. Let's get it up for you on the screen. And Gabriel, that's the other stock. I think now it's up close to 20%. I'm not sure in terms of the news flow, but I recall the stock being up 10%. And now Gabriel India, that's locked up in upper circuit, up 20%. You have some pending orders as well, on the buy side. So keep an eye out on that name. Some of them should come up for you on the screen. Gabriel up 20%. Ecos India Mobility as well, up and about in today's trading session.
Okay, and sectorally, capital market index is the best performing sector. A lot of oil marketing, AMCs like HDFC, AMC doing well. Tomorrow is the ICICI Pru AMC listing. Today there was a brokerage note from Aquarius, put the target price at 2,900. That's about a 30% upside. But generally, the relief that the TER the announcement that's coming from SEBI is not as bad as what was feared in October. That will blunt the impact, and stocks are seeing quite a bit of a relief rally. Not just HDFC, AMC, pull up the other AMC names and brokerages. And sectorally, the other one, which is resilient today, is IT. TCS, the AI pivot, Infosys, Tech Mahindra also moving up nearly 1%. And Accenture, remember, comes out with numbers later today. So that maybe is providing some optimism. Will they go ahead and revise the FY26 guidance, which is subdued currently at 2 to 5%? But let's also tell you what we've lined up for you on our show today. It's mixed moves across the indices. Markets are off the day's high. The Nifty is hovering just below 25,900. It's mixed across sector. Global facing sectors, IT, metals leading the gains. Pharma downbeat on account of Sun Pharma, which is down 3%. Shares of capital market players rally as SEBI revises the expense ratio for mutual funds. All statutory levies will be excluded from the base expense ratio, which has been cut across schemes. Limits on brokerages for derivatives and cash trades, also by AMC, have been capped. Sun Pharma has been dragging the pharma index. It's the top Nifty loser after the company's Bazaar facility receives an official action indicated from the US FDA. An impact analysis coming up on the show. And a couple of counters reacting to brokerage notes. Jefferies downgrades Hero MotoCorp to an underperform. Shares of consumer durables majors like Crompton flying high on the back of a bullish note from Motilal Oswal. All this and more coming up in the next 1 hour.
All right, how do you position yourself though in the final hour of trade? Mitesh Thakkar joins us on the show to help us out with him. No, actually, it's not Mitesh right now. Sorry. It's Nagraj Sethi from HDFC Securities who joins in. Hi, Nagraj. Good afternoon. Good to see you win. Nagraj, on the headline index, we're virtually unmoved. But from the lows, we did see a bit of a bounce, which is telling you that 25,700 mark is actually important. What the bulls are, holding on to is that the FI net short positioning has moved to 92%. And the PCR had moved to the lower end of the range. So currently, it's above that 0.8 mark. Your view on the index, is there a trade?
Good afternoon, Nigel. Yes, rightly said, market has been in a consolidation phase, minor weakness over the last few sessions, last 2-3 sessions. But to some extent, the decline is not in the face. The sharp decline was absent during this period of time, showing some kind of a choppy movement in the market at the lower levels, but some stock-specific correction was going on. I'm not expecting a bigger decline from here onwards. At the low level, 25,700 to 25,600 is likely to offer a strong support, and I'm expecting bounce from the lower levels. So at the higher level, 26,000, 26,050 is going to be the strong resistance on any bounce back from here onwards. At the same time, I have two stock ideas from the long side. First one is M&M Finance. The chartically, M&M Finance has been a tremendous uprun over the last few months. The higher tops and higher bottoms over the chart indicates that the stock was in a strong uptrend. After showing a consolidation, it has broken above the hurdle in today's session and currently trading higher. Currently trading around 364.50, 365. One can look to buy at this point of time. Immediate target would be around 385. One can place a stop loss at 372. Sorry, 352. And second one is from a metal side, Hindustan Copper. Hindustan Copper has been in a consolidation phase recently and witnessed sharp upside breakout in today's session from near the important support of 10-day EMA. Currently trading around 386, 386, 50, 387. One can buy at this point of time, and upside target would be 408, and one can place a stop loss at 375.
Thank you. We'll come back to you, Nagraj. Those were some trades for the last hour. Let's get back to the big story. That is, SEBI has revised the expense ratio for mutual funds. Surbi joins in with the details. Surbi.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled, and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduced the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or their cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
Well put, Surbi. Thanks a lot for explaining that to us. In fact, earlier today, we spoke to Sandeep Parekh, Managing Partner at FinSec Law Advisors, on the impact of these decisions. Let's listen in to what he had to say.
The regulator should not be getting into price fixation, right? It should do that only if competitive forces are not working. Let's say there's a monopoly, if there's an oligopoly. So, from first principles, I'm not a big fan of setting caps on any products, not just financial products. The industry is certainly grown, so I think, if you look at it from that principle, certainly it's a good thing, but it will favor the large funds and disfavor the smaller funds. No, I think it will adversely impact both the funds and the brokers as well. And again, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You have people who spend their entire lives just looking at infrastructure or just looking at transport industries. If mutual funds start hiring those kind of specialists, they'll have a research team of 100 people. So clearly, there are efficiencies in a brokerage hiring a transport expert and then distributing that research to 45 or 50 mutual fund and many other institutional clients. It's much more efficient. It's more cost effective versus having 45 different transport experts in 45 different mutual funds.
All right, let's welcome Sudeep Bandyopadhyay, market expert who joins us on the show. Hi, Sudeep. Good afternoon. Good to see you in. What do you like from the capital market plays? This has clearly come, as a relief to the AMCs.
Absolutely correct. I think there was a lot of confusion and a lot of apprehension amongst the AMCs as to what's going to happen. But I think SEBI walking the middle path and the cuts not being as severe as was being envisaged is a big, big relief. Also, remember that there is an AMC listing going to happen very soon, and that should create a lot of excitement in this entire space. We do like ICICI Prudential, which is going to get listed, and we believe that this was a good issue. So somebody getting an allocation is definitely going to be lucky. As far as the listing gains are concerned, that's what we believe. If you are really looking at buying some of the other AMC stocks and all that at this stage, it may be worthwhile to wait and let prices settle down post the post-listing excitement of ICICI Prudential, and only then venture into this space. Fundamentally, we do like the AMC space from a long-term perspective.
Today on Nuvama in the brokerage cap, Citi has a buy rating. Their target price is at 10,175. I think that stock is up nearly 1.5%. They're saying the wealth management flows continue to remain strong. New product is scaling up. So they like the story here. But Sudeep, betting on ICICI Pru for some listing gains. Talking about listing gains and the move thereafter, Meesho, what does it tell you? Manglam has been pointing out that very little float is available because most of the shares are locked in till I think 6th of January. So that explains why you are seeing exaggerated up moves. But this kind of an up move, and what is it symptomatic of? What is this kind of price action telling you about the market and the investor psyche?
Investors are definitely hungry for this stock, and that's exactly what we are getting seen reflected in the price. But I don't think this is a proper price which it should be traded at. You're absolutely right. There is a lock-in, and post the lock-in, I'm reasonably confident a lot of selling will come and price will settle at a different level. Look, I think the company is doing a lot of right things. They are completely focused on free cash flows, which is a very good thing to do for a startup which has just got listed. Yes, the company is still not profitable on the PBT, PAT level, but the focus on free cash flow is definitely the music to the ears of the investors. And that's the reason why I think the investors are flocking to this counter. But having said that, the valuation at which it is now quoting is definitely very rich. And I will definitely not recommend buying in at this level. It's a good company, good business, great potential, but not at today's valuation. Let's things settle down. Maybe in mid-January we'll have a look. Post the the locking and selling consequent upon release of locking is over.
Okay, all right. I wanted to view Sudeep on the pharma names. So Sun Pharma, that's the top loser following some regulatory action from the US FDA. Ekta joins us to help us out with a quick take on what's gone on there. Ekta?
Well, yes, Sun Pharma is in focus in today's trading session on the back of negative news with regards to their Bazaar facility, which has been classified by the US FDA as an official action indicated status, which basically means that there are compliance issues in that particular facility. Now, the plant was inspected from the 8th to the 19th of September 2025. The company has said that they continue to manufacture and supply approved products from this facility to the US as of now. Now, analysts say that Bazaar facility is probably one of the most important facilities for Sun when it comes to their new complex generics, and hence the probability to deliver a potential positive surprise in the generic business might be lower for Sun Pharma as of now, but the official action indicated status as of now does not change the forecast, because analysts are not really pegging in a lot of complex generics in their forecast when it comes to approvals and sales from that particular segment. And hence, however, going forward, the approval timelines could change because of the compliance issues at the Bazaar facility. Now, remember that there are other facilities which are under the US FDA scanner, which Sun has. For example, the Halol facility, which has had an import alert since June 2022 and was classified as an official action indicated status post a June 2025 inspection. And they have the Mohali plant, which also has a consent decree or was sent a non-compliance letter in 2023. So yes, negative news for Sun Pharma, but how they basically respond to any kind of compliance issues will be critical to see in terms of what the complex generic pipeline could look like for the company going forward.
Sudeep, you want to comment on Sun Pharma?
Well, I think a little unfortunate, but obviously the market didn't like it and the prices are down. So I will be a little cautious here. I have been for quite some time maintaining that we should focus on purely domestic focused pharma companies, and Mankind has been our favorite stock, and we continue to maintain that view.
On Oro Pharma also, I think there was some news where the US FDA inspected the facility between 8th and 17th of December, and they received Form 483 with 5 procedural observations. So procedural observations. Let's get Aurobindo Pharma stock up for you on your screen.
Okay, all right. Sudeep, I wanted one quick word with regard to BSE. You know, that's one of the favorites, right? Valuation's expensive. 3,000 rupee stock became around 2,500, but there's nothing adverse that has come actually with regard to BSE. There is still some fear out there with regard to regulatory problems. What's your view on the name?
Well, if I'm a little aggressive, then I'm very, very positive on BSE. Somewhere NSE, Nigel, will get listed, and that NSE listing will happen on BSE. It definitely will become one of the very largely traded stock, and BSE will benefit because of this trading volume, which will get driven to BSE by default. So yes, beyond everything else, I think that will be a big positive for BSE going forward. And I will maintain my positive view. But remember, it's a very, very aggressive position. The PE multiples are at a level which is stratospheric. And at this level, the margin of error is very, very limited. If I have to pick up one exchange stock, I will still probably go for MCX. We know what's happening in gold and silver. We also know that new option contracts are getting introduced. And the scope for the upside in MCX even now is significantly higher.
Okay, let's pull up Interglobe Aviation. That's having a good Thursday. The Indigo CEO, Peter Elbers, in a video said the worst is behind the company. The company has managed to restore most of the flight network to about 22,000 daily flights. Listen into that bite and then we'll get a sense of how to approach the stock.
Through the storm, we are finding our wings again. The worst is behind us. These last 2 weeks have been very challenging for all of us. As Indigo employees, we stood tall and united, weathering the storm together with unwavering support for one another. Thank you to our pilots, cabin crew, airport staff, operations control, customer service, and all functions who supported. Your collective dedication is the backbone of Indigo. On December 9th, I shared stabilization of Indigo's operation. After that, we restored our network to 2,200 flights today. Given our scale and complexity, recovering such situation in short time is a testament to our teamwork and the strength of our operating principles. Now we focus on 3 things: resilience, root cause analysis, and rebuilding.
And the stock is slowly rebuilding. At the peak of the operational crisis, the stock had dropped to levels of 4,800, sub that. And today it's gone up by nearly 300 rupees, but far, far away from the recent peaks on that. Sudeep, for now it appears the worst is behind. Operationally, they're back on track, operating those 22,000 daily flights. But there will be that financial impact in terms of the penalties they may have to pay, the refunds on account of the lost revenue, loss of confidence in the airline. At this price, 5,100, what is the view?
Well, I will definitely stay away and recommend that. You're absolutely right about the financial impact in the the next couple of quarters. But structurally, I'm a little worried because I think this first week of December exposed the weakness in Indian aviation industry, the kind of monopolistic situation which had been created. I think the government will necessarily take action to ensure that we don't have a repeat of the situation and the market share of Indigo does come down over a period of time. Now, this has to be done from a government and DGCA point of view, which doesn't augur well from an Indigo shareholder point of view and Indigo valuation point of view. So if I'm an Indigo shareholder, I think I'll be extremely careful because loss of market share and loss of our business is definitely not good news from a valuation point of view. And remember, we are not talking about very cheap valuation or reasonable valuation. The margin of error at this kind of valuation is very, very limited. So I will be very cautious on Indigo.
Got it. All right, Sudeep, always good to hear your thoughts. Thanks a lot for joining in. Wishing you a good rest of the day and we catch up soon. For the timing, we slip in a short break. On the other side, Alok Agarwal of Alchemy Capital will be joining in. Welcome back. Well, some of those metal stocks actually are slipping a little bit in the last few minutes. We'll update you with regard to a downgrade that's come in from Nuvama on sale. But otherwise, you have JSW Steel, Tata Steel, both of them have seen a bit of a downtick. In fact, if you put Nestle as well, that as well has seen some kind of a downtick in the last few minutes. These are all Nifty constituents, so just highlighting a few of these names. But Hormuz joins us as always. He's going to put the spotlight on all the movers of this hour. Hormuz.
Well, HDFC AMC, start off with that because that has been the big talking point. The stock move is justifying the big talking point as well. 7% higher on the stock now, the biggest single day gain since June of last year. So it's taken 18 months for the stock to have a gain of this quantum. It snapped a 3-day losing streak today. Today's volumes nearly the highest in 2 months. 25 lakh shares have been traded on the stock already. 20-day average of 5 lakhs. So 5x its 20-day average. The stock has moved above its 50 DMA of 2707 and it's made a double bottom of sorts at around its 200-day moving average of around 2550, and the stock is up 30% so far. It's turning out to be the third straight year of positive returns for HDFC AMC. A news flow driven move on Antony Waste. The stock is up 19% as of now. At one point was up 19%, was up around 17 right now. The biggest single day gain since May of 22. Volumes are the highest since September of 21. We have had more than 1 crore shares that have been traded on Antony Waste. The 20-day average is less than 50,000 shares. So gaining on very, very substantial volumes. The stock has moved above its 50 DMA. Now the 100 DMA comes up at 525. So that's the first important level to watch on the upside. But the stock is still down around 40% from its July 2024 peak, which is well in excess of 900 rupees. Gabriel India is seeing its biggest single day gain in the last 5 months. We've had close to 50 lakh shares that have been traded on Gabriel India. The 20-day average is around 3.5 lakh shares. So yet another stock gaining on very substantial volumes in this 17% up move. It's taken support at its 200-day moving average and has seen a rebound from there. The 50-day moving average is now at 1138. So that's the next level to watch on the upside for the stock, which has had a pretty good year so far. More than doubled in value, almost 2.5x now. And it's having the best calendar year since 2014. And lastly, on the downside, Vishnu Prakash Punglia, we've been speaking about this over the last couple of weeks now. The third straight day of losses, and in the last 25 sessions, the stock has gained in only 4 of them, including one on Monday. And this has been the second highest volumes that the stock has seen this week so far. And with over 50 lakh shares that have been traded, the 20-day average is just around 8 lakh shares. So falling on volumes that are 6x its 20-day average, and it has remained below all of its key moving averages since the month of July. The December 2024 peak was 345 rupees. The stock is down 80% from those levels, and including a 33% drop from its IPO price of 99 rupees as well.
Thank you very much for that. Alok Agarwal, Head of Quant and Fund Manager at Alchemy Capital Management, is now joining in. Alok, markets may be sluggish, but there is optimism in the air as we turn into the new calendar year. The 2026 is going to be better for the Indian markets, with earnings growth picking up to, like mid-teens kind of a revenue growth. Plus that US-India trade deal, whenever it happens, will be the upside kicker. A lot of things are falling in place from a macro front. And I remember our last conversation where you said you're positioning for growth irrespective of the deal. So tell us, in the last 1-2 months, what have been the big changes that you've made to your portfolio? What are you very bullish on?
Yeah, hi, good afternoon. Yeah, as you rightly pointed out, while the markets are sluggish, there are a lot of positives to concentrate on. A lot of policy level decisions also have been quite pro-growth, especially on the RBI side, who has been there to push the liquidity as well as keeping the rates as well as CRR low. Yes, a couple of things were a little disappointing the last few months. The outcome of the GST, the first full month, for the October month, the collections were a little underwhelming. Possibly we'll look out for the next few months to watch out whether the activity is picking up or not. At the same time, the disappointing number was on the capex side for the month of October, as a result of which we are seeing some of the industrials and some of the beneficiaries of those capex are selling off in the last couple of months. But the focus of the government continues to be on the manufacturing side and ensuring that they do not loosen up too much on the fiscal deficit as well. So we do think that a risk reward is changing positively in India's favor. And the valuation gap that India had versus the emerging economies and the global economy, due to the underperformance of this 1 year, that has also got corrected to a large extent. So we enter 2026 with a more positive expectations. But yes, as we had said last time as well, the focus is more on those names that are likely to fetch higher double-digit growth rather than those which are sluggish on the growth side.
Hi, Alok. Good to see you. And I think you're a little contra, right? You're expecting mid-caps and small caps to actually outperform as earning momentum gains pace?
Yeah, in fact, it's quite intriguing to note that this year, while Nifty was up close to 9-10%, the average return of the top 750 names is close to -5%. So that has been the broad divergence in the markets. But if you look at the earnings growth trajectory as well, the Nifty 50 earnings growth for last 6 quarters has been in single digits. So the best performing index actually had quite underwhelming earnings growth for 6 straight quarters. So either the earnings growth needs to pull up or the outperformance may come from the broader markets. So we do think more than the market cap side, it is more on the sectoral side or on the specific companies or themes which are likely to deliver the higher growth. They could possibly be in the broader markets.
Tell us about a few themes that you're very, very bullish on. Maximum upside from here?
So the upside do we see on the consumer tech side? We do see on the financials, apart more on the smaller private banks, the PSU banks, and more importantly, the capital markets. And the global theme itself is pushing more towards the precious metals as well as the non-ferrous metals. The beneficiaries of these are the prime areas where the path of least resistance is of a higher double-digit growth. And that could actually result into outperformance of these sectors as well.
So consumer tech, smaller financials, PSU banks, in the commodity space, precious metals, non-ferrous. What else did I miss?
On the capital market side, the whole value chain, right from the exchanges to the brokers, to the wealth managers and the asset managers, some of them are doing well today itself, but the story there is quite structural. In fact, one of the regulations being out today ensures that the path for the next few years, it's quite clear. And we're seeing that the huge amount of inflows that are coming in the form of SIPs. So these companies are growing. They're beneficiaries of the growing GDP of India, rising per capita income, and rising wealth concentration as well.
This consumer tech, are you referring to these new age tech companies, the likes of Meesho, Eternal, Swiggy? Because while the opportunity and the growth and the increase in penetration is undeniable, just the valuation, the rapid rise seems to suggest that a lot of it could be priced in. So at this juncture, to put in money?
I completely agree with you, Rima. Like, all of them are not possibly great investable names currently. What do we need to watch out for is who among them is actually gaining market share from the traditional side of businesses, those who have already turned profitable and the profits are improving. Because a number of these consumer tech companies are actually loss-making. So I'm not really too much on favor of companies which are loss-making. They need to turn the leaf, they need to be profitable and then grow and thereafter gain market share. So once these things are in place, which a lot of times we need to possibly wait out also to see who the emerging winner is. Some of them are already paving that path. Few companies on the payment side, few companies on the consumer tech on the beauty product side, and a couple of them on the food delivery side as well. So few of them are already ticking those boxes. Few others might have to wait out for some more time.
Okay, all right. I think cement was something as well that you liked, if I remember correctly. Cement as well as chemicals earlier this year. Do you still have a positive bias out there?
Cement would actually be more of a function of how the capex also picks up. So in case there is a sustained slowdown in the capex because of the overall reduction in the total tax revenue that we have had this year, in that case, we might find that the volumes are not growing as much as we would have expected to be. So our exposure increase that has happened in areas like precious metals and non-ferrous has also been to an extent at the expense of some of the other industrials, because we saw the capex coming down. Cement was also an area where we have reduced our overweight positions to a little more neutral position, as well as in chemicals. In chemicals as well, there was an up move that we saw in the last few months. And because the trade deal is still not very, very clear, we have cut out some of the overweight positions to a little more neutral position out there.
Okay, great conversation, Alok. Thank you very much for joining in. if it's not the last one before, I mean, maybe it's the last one before the close of this year. So wish you and your team a very happy new year. But love to have another conversation in 2025.
Wish you all the same. Thank you.
Let's get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment, D Street Chatter. Also, a few BTST calls from our experts. Welcome back. Absolutely unchanged on the Nifty. 30 minutes to go to wrap up trade. The Nifty is at 25,812. A theme which is playing out well are the CV makers. Tata Motors CV up nearly 4%, 400. Target price set by a few brokerages like BofA and JPM is 475, so more upside to go. And Ashok Leyland too is moving up. The key rationale being that after 3 years of sluggish growth, maybe the CV cycle is turning and EU truck market appears to be bottoming out. But other than that, other than these individual movers, at the index level, things are very, very flat. So let's find out what Nimesh has picked up from his dealing rooms and the chatter he's had. Nimesh?
Hi, Rima. So, while the Nifty is flat, it's been extremely choppy and volatile as well in today's market. We've seen, 100 point or more than 100 point swing as well throughout the day. I think there is resistance clearly at the upper end, and there is a lot of selling in the broader markets as well. Even today, I understand the FIs, the net sellers in the cash markets expect a high number in terms of sell from the FI category. So that's from a flow perspective. The sector which has done well today is capital markets names. And I guess there is a bit of a relief rally there, a bit of short covering as well in the likes of HDFC, AMC. But in general, that entire package done well after that SEBI, final expense caps on both mutual funds as well as in brokerage. So a bit of a relief rally there. I guess IT will be in focus because of the Accenture numbers tonight. And of course, the big Shriram Finance deal is likely to get announced tomorrow. So the entire NBFC space as well can be in focus tomorrow. So those two sectors stands out. But I guess it's basically a broader market underperformance and selling from the FIs continue.
It's also the Sensex weekly expiry today. And the mid-cap index, by the way, was absolutely flat when we started the show at 2:30. Now it's up nearly 0.5%, so spiking. What about stocks, Nimesh?
So the first stock on my list is Varun Beverages. That's been consolidating in a very narrow range of late, but I understand the city is anticipating some corporate development very soon. A potential acquisition is on the cards, is the buzz as far as Varun Beverages is concerned. Remember, they've already announced a foray into beer business via Carlsberg. So on similar lines, there could be further acquisitions as well. So that's the buzz as far as Varun Beverages is concerned. The second name is PFC. Again, stock has underperformed in the PSU basket, but looks like the selling pressure from a leading FI is largely over. So from a supply point of view, looks like that's largely done with. The third stock is Misho. That's been a big outperformer this week. Been buzzing off late. Even today, the stock has recovered from the intraday lows. Essentially on back of buy flows. I understand a leading family office and some large HN has been active buyers in the last couple of days, and hence we've seen a big up move there. And the last is Ashok Leyland. You spoke about both Tata Motors, CV and Ashok Leyland doing good, but Ashok Leyland has been standing out in terms of very strong delivery-based buying for the last many days, and that stands out in today's trade as well, and hence a big up move in that name as well.
Do you want to give us some more information or teasers about Varun Beverages and what they're looking for in terms of an acquisition?
Well, Rima, as I said, they've already announced one big tie-up getting into the beer business through Carlsberg. I guess there is one not big, but there is one company which they might acquire to further get into the beer business. So that's something to track as far as Varun is concerned.
Yeah, recently the company had also amended its memorandum of association to include the business of manufacturing, producing and distributing various alcoholic products, including beer, wine, whiskey, gin, rum, vodka, both in India and internationally. That's thank you, Nimesh. Interesting list as always. Let's go across to Nigel now to get us the latest trends from the F&O space.
Well, Rima, if you look at it, we're in a bit of a range right now, and you just look at the action today, the writers are making the money because the 25,800 put, well, out there, the premium has dipped out there. The markets are more or less flattish. Even on the upside, the call writers as well making money because on the 25,900 call as well, the premium is down. So today's the day of writers. It seems the market's in a bit of a funk, in a bit of a range as well. On the downside, I mentioned this earlier today as well, 25,700 extremely important. You don't want that mark to get broken. And if you're looking at the range, 25,500, 25,700. On the upper end, 26,100 has got rejected. So that becomes the important mark to look at. The problem today is the Nifty bank. Well, it's relatively outperformed, but it's not able to get past the 20 DMA. As in terms of the first level you wanted to get past is the 20 DMA. So I'll keep an eye out on that front. But with the shorts heavily in the system, at around 92% or thereabouts, the bulls are fancying their chances that if they can hold on, consolidate a little bit, then maybe in fact we would be bracing for a bit of a fight back. But we can't break the 25,500, 25,700 on the downside. Finally, in terms of stocks that we're looking at, Bandhan Bank, that's the one I've been highlighting for the last two trading sessions. The last time I checked, that's almost a sure shot coming out of the F&O ban. So I'll keep an eye out on that when the list comes later this evening. Bandhan Bank could probably be exiting the F&O ban.
Thank you for that list. Nagraj Shetty is back with us. Nagraj, any more trades?
Yes, Seema, markets have recovered a bit from the lower levels. And there are certain stocks which are showing really very well. Out of that, Ashok Leyland, chartically, it has been in a sharp uptrend over the last few weeks. No respite for bears in this case. Sideways range movement, and eventually the stock has witnessed a sharp breakout. Placed at the higher levels, looking very positive. And looks like, though placed at the higher levels, there is no indication of any reversal building up at the highs. More upside could be there. 180 is going to be the next hurdle, next resistance to be watched for the stocks in the short term. Second one is the TCS. IT stocks have outperformed in today's session. In the last few sessions, they were in a consolidation phase. This stock has witnessed a breakout of a range movement around 3200 levels, 3210, and placed at the higher levels. There is a hurdle of around 200 EMA, somewhere around 3300. I'm expecting this to be taken on the upper side. So 3350 is going to be the resistance to be watched in the next near term.
Thank you very much for that. TCS started the day flat, but now has moved to the day's high, 2% up on TCS. One, the AI pivot, the details the company shared at the investor day, and two, maybe something anticipated from the Accenture earnings later today. But top honors once again goes to Meesho. Mangalam now joins in. Mangalam, put it in context, the kind of run-up that we've seen in the stock price.
Well, it's a big move that we've seen on Meesho. In fact, just as we speak, the stock is up nearly 10%. 6 continuous days of a big move that we've seen on Meesho. There are multiple reasons why the stock saw a rally as well. The first part, obviously, post-listing, there were a lot of institutions that did not get allocation in the anchor book. The issue was fairly well subscribed. So those guys went ahead and bought. Secondly, there were a couple of brokerage notes that came by as well. And third, most important, there was very limited float available for the counter. So as a result of which, the impact price or impact cost was a lot more. Just to put things into perspective, and these numbers change as we speak. The stock from its issue price has rallied a whopping 115%. And, we look at it post-listing as well. It listed at around 162, 162.5. If you look at it from there as well, the stock has seen a rally of nearly 45%. It's just 5 or 6 trading sessions. At IPO, the valuations were close to 5 times sales. Now it's moved all the way up to 11.5 times sales. The management has been speaking about generating and growing their free cash flow while improving contribution margins. But at some point, valuations will come to the fore because at the current market cap, upwards of 1 lakh crore, it's well above names like Jindal Steel, Indian Hotels, United Spirits, some companies like Havells and Dabur as well. For perspective, Meesho is a company that was founded just about 10 years ago and now has a market cap much above all these big listed companies too. But the other important thing to track is, again, like I said, it's limited float, right? As we speak, only 6% of the company's overall float is free for trade. The rest is all locked in by pre-IPO investors, by promoters, or by anchor investors. So the first real test of ample liquidity in the stock will happen only in 2026. On 6 Jan is when the anchor lock-in opens, and as a result of which we would see a bigger, liquidity or maybe a bigger depth in the stock as against what we're seeing right now. But as we speak, the moves on both up and downside are fairly exaggerated.
All right, Mangalam, thanks a lot for that. Limited float obviously playing a role out there. And, some have it fast, some take longer to get to that mark. But staying out there is the real challenge out there. So we'll keep an eye on Meesho. By the way, keep your eye on the bottom of your screen. Sammaan Capital, there's a clarification that's coming out there. They are distancing themselves from the erstwhile promoter. They're saying that they have no relation with Mr. Samir Gaylord. They're saying that, in fact, he exited the company as a shareholder as well in September 2023. And also, he exited the board in March 2022. So after seeing a bit of a downtick on that, they're clarifying and they're distancing themselves from the erstwhile promoter. That explains why we're seeing a decent recovery in Sammaan Capital. Hopefully, we can get the management on the show and, in fact, get further clarity with regard to the deal, any kind of spoke, and whether or not the deal will go through. But for the timing, some clarification. The street likes it. Stock is recovered. Well, we have Mayuresh Joshi as well, who's joining in on the show. Hi, Mayuresh. Good to see you in. I think we have Mayuresh with us. Yes. All right. I think he's joining in. Hi, Mayuresh. Mayuresh, any view on Sammaan Capital? There is some bad news that's coming in there, but the management now has gone on record and they're clarifying that, all the question marks are being asked on the erstwhile promoter. So, they're distancing themselves away. And they're also saying that he's not only exited the board, he's also exited as a shareholder. Your quick take on it at around 144 rupees. This is the stock that was 185 rupees on the day they announced the deal.
Afternoon, Nigel. I think some positive statements coming through, which should give some element of respite for the stock itself. However, I think the streets still need some element of conviction to probably come through before a lot of investors probably jump in. Broader market still consolidating, not doing well. And therefore, I think some other bit of conviction, both through numbers and probably some other statements or some clarification from the regulator is something that will soothe the nerves for a fresh investor to get into Sammaan Capital. As our stands on NBFCs, our take is the higher rated NBFCs, leadership NBFCs might actually continue doing well because they've got a plethora of parameters working for them. Better capital adequacy as an example, better asset liability management as an example, asset quality pressures are coming off, interest rates are coming off, which is a good sign in terms of their overall borrowing costs. And therefore, I think within NBFCs, the better rung NBFCs, whether it's the Shriram Finance as an example, which also has lower exposure to personal loans, unsecured loans capped at 4%, probably makes the market higher.
Got it. All right, Mayuresh, I wanted your view on SAIL. That stock is in focus in today's trading session. And SAIL actually has seen a bit of a downtake. That's after Nuvama. They have come out with a downgrade note. They've changed the rating to reduce from hold, and also the target price they've cut to around 106 from 141 earlier. They believe that risk reward has turned unfavorable. So they've gone ahead, they've cut their EBITDA estimates for the next few years because they're factoring in lower steel prices, and though they're penciling in a 3,000 rupee price hike in Q4. So on the back of that, they are expecting pricing to be a little bit weakish in the time to come, not as much, to go up, not as much, but in the Q4, they're expecting some kind of relief. Now, they're bracing for a weak showing in Q3 itself. They believe that the company will report a 30% quarter-on-quarter fall in the absolute EBITDA number. And on an EBITDA per ton basis, it could be down by around 1,400 sequentially to around 3,700 on a year-on-year basis. At current prices, they're saying the stock is not cheap, trading at closer on 7 times EV upon EBITDA. They go on to add that the company shall soon start capex on the 4.5 million ton ISCO expansion, which will only increase debt further from here on. And they point out that the return ratios, the ROEs, are extremely poor at around 3.2 to around 6.5 times odd. Put all this together, Nuvama believes risk reward has turned unfavorable. They're highlighting valuations, weak profitability, weak return ratios. What's your view, Mayuresh, on this particular name? SAIL is actually the metal stock that's underperforming today.
It is, Nigel. And again, I think as we see it at Market Splendor, it's trading 5% below the key pivot levels as we are observing this. But to a large extent, in terms of the points that the report is pointing out, I think two things. One, I think if you probably look at the pricing mechanism at this juncture, whether you're talking about HRC or CRC prices, obviously they have remained a tad bit under the pump for the past few quarters, but they're seeing signs of stability coming through. And therefore, I think how HRC, CRC prices play out in lieu of domestic demand expected to remain strong and stable is something to be watched out for. The second element in terms of the additional capex that will be required in terms of the subsidiary capacity addition that is expected to happen, I think that has already been penciled in terms of not just our estimates. I think a lot of analyst estimates would have penciled that in. And therefore, I think the reported EBITDA per ton should start seeing signs of stability as we head into the second half, in my opinion. Having said that, again, I think it still remains a little bit volatile in terms of global conditions and how pricing will probably play its part. Input costs have largely remained moderate as we speak. And therefore, I think an absolute and reported EBITDA should probably start normalizing as we head into the second half. Having said that, again, I think the view largely remaining neutral because I think there are a lot of conditions that remain beyond the control of the company. And therefore, I think our take is that one really needs to be very, very selective when it comes to the metals bank.
Thank you. Stay on. Need to get into a break. We'll come back and get you more on the markets closer to the wrap of today's trading session. Welcome back. We've got about 7 minutes to go. Looks like it's going to be a flat close, but mid-caps perked up towards the close of trade, though the advance decline ratio is still negative. 2 stocks advancing for 3 in the red. Mayuresh, all eyes on Shriram Finance. Board meet tomorrow. If we do get a deal around the current market price, is there still going to be upside left in this stock?
Afternoon, Rima. So as I just mentioned when you were discussing Sammaan Capital, I think the street is eyeing what is probably expected to happen as far as the deal contours are concerned, and that's largely getting priced in. But to a certain extent, if you probably play out the next few quarters, I think the worst in terms of reported numbers should be behind us. With a declining interest rate, I think the NIMs and spreads should largely start stabilizing for Shriram Finance. And as I said, if you probably look at the book structure itself, around 4.5% in terms of personal stroke credit card stroke unsecured loans, which largely means that it is a well laid out balance sheet as we speak. The borrowing mix is pretty well diversified as well. Capital adequacy for Shriram Finance remains extremely strong and robust. And therefore, I think the expectations in terms of asset quality pressures largely being behind us should largely start playing out in better return ratios as we head into the next few quarters. So our sense is that the rating rankings, the parameters that we see as per CANSLIM at Markets for India, probably Shriram Finance ticks them all. So yeah, remain positive on this.
Positive on that. Give us one interesting mid-cap, small-cap idea.
So I think commercial vehicle makers are expected to do well. I think we've already seen a large part of the price move start playing out, whether it's Tata Motors CV, whether it's Ashok Leyland as an example. I think as an ancillary to the entire ecosystem, I think tire stocks have remained relatively consolidated over the last few weeks. JK Tires on declines, I think, seems to be a very, very interesting proposition as a proxy, not just to the CV play, but also the replacement market. If you probably look at the product mix itself, truck and bus radials are around 51 odd percent, passenger radials are around 31 odd percent, replacement is around 65 odd percent, OEMs is 21 odd percent. They're introducing a lot of ranges, whether it comes to commercial, whether it comes to the EV ecosystem, whether it comes to the passenger premium radial tires as well. And therefore, I think in terms of reported numbers, the expectations of margins being between 12 and 13 odd percent should probably become a consistent norm and improve going forward as well. And balance sheet looks relatively robust and strong. So I think any decline on JK Tire probably becomes a very, very interesting proposition.
What level to enter JK Tire? What's the extent of decline? It's 459 now.
Yeah, so as we see it in Markets for India, I think if it pulls back to the 50 DMA, as we track both fundamentals and technicals, I think 426, 430, I think will be a good level to start getting.
Okay, all right. What about the EMS stocks, Mayuresh? They saw a bit of a pullback after a sharp decline, and now they're consolidating a little bit. Anything you like from there?
So Nigel, again, valuations still remain a concern out there. I think the point is not about volume growth. The volume growth will keep on coming through. They're adding new clients, whether it's Kaynes, whether it's Amber, whether it's Irma SGS. And therefore, I think with capacities that they already have and expectations of sweating of those capacities, volume stroke, product mix stroke, new client additions will keep on happening. I think the point in terms of a valuation re-rating will be how margins and the bottom line numbers probably grow. Margins will grow on 2 fronts. One, I think in terms of ODM, that is original design manufacturing component, actually starting to increase margins. And secondly, I think as operating leverage kicks in with better ODM performances, I think the bottom line growth and free cash flows will be far, far stronger. How and when that transition happens is somebody's guess. But in my opinion, at this point of time, fully pricing in at least the EPS growth that these companies are expected to report on an FY27 exit.
Okay, got it. Mayuresh, I'm not sure whether you mentioned, but on the alcohol companies, anything you like from there? Some of them have seen a sharp correction, the likes of Radico, Allied Blenders, Tilak Nagar, and now we hear that there could be some kind of move out there with regard to Varun Beverages as well. Your take?
So I think we've discussed Radico quite a few times over the last few months. I think we still continue holding that in our local and global portfolios. Our sense is that for the industry as a whole, premiumization is a trend which will continue and which will keep on driving price realizations in a substantial manner. In terms of the input cost itself, both the ENA, the extra neutral alcohol prices, and glass prices remain a little bit stable. And therefore, I think EBITDA margins should probably see a decent performance as well as they explore newer markets. And as export markets also start picking up for a whole host of these players, including the likes of Radico, Allied Blenders, United Spirits, who are introducing newer products in the Indian markets. I think the ecosystem is expected to have the premiumization tag play out on numbers, margins, as well as bottom line. So I think remain optimistic on this space. Disclaimer, Radico is something we continue.
All right, Mayuresh, thanks a lot for joining in and giving us your thoughts. Well, time to wind down the markets. We go home almost unmoved on the Nifty itself. So we went in a broad range of close to around 200 points. But otherwise, the Nifty ends as flat as can be. The Nifty Bank as well, almost unmoved in today's trading session. But it was heartening to see actually the mid-cap index was an outperformer. That went home with gains of around 0.3%. From the Nifty pack itself, Interglobe Aviation did well, was up close to 3%. TCS quantifying the AI exposure that we could possibly have. So that one, in fact, went home with gains. Tech on the whole actually did well. So Tech has been actually started outperforming what the Nasdaq is doing because of talk of that AI bubble. So good to see. The IT index did pretty well. What didn't do well? Sun Pharma was under pressure. Ferrous stocks did come in for selling, whether it was Tata Steel that was down 1.5%, whether it was SAIL with regard to the downgrade that did come in from Nuvama. From the broader markets, a few stocks that moved on very, very large volumes. Favorable news flow coming in on Anthony Base. Stock goes up 20%. You had Walcher Nagar that was up more than 10%. Gabriel India as well at one point of time was up 20%. Goes on with a gain of more than 10%. Misho can't be kept out of the action. That stock as well was up close to around 8% in today's trading session. And the AMC stocks did see a good bounce back. Cantor, Robeco, HDFC, AMC, all of them did pretty well. Well, on that note, we'll wrap up on this edition of Closing Bell. Don't go anywhere. The team of Markets Forward comes up next.
The Indian markets end in the red following a choppy session. Nifty holds 25,800. Mid-cap index outperforms. The market breadth, however, continues to favor declines.
Shares of asset management companies rally after SEBI's mutual fund cost overhaul were less stringent than expected. Brokerage fees also slashed by half. Street does not expect any major hit on profitability of AMCs.
Shares of Crompton, Greaves and Voltas surge after brokerages turn upbeat on the consumer appliances firms, project an upside of anywhere between 13 to 30% on improved earnings estimates. Good evening, you're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day while recapping today's session as well. I'm Mangala Malu, with me Vinny Motiwala. Vinny, we ended flat, but it was a jostle between important levels for the market, right? We bounced back from the lows, we saw supply at the highs, so all in all it was a 150-point sort of trading range that we saw on D Street, at least in the frontline index. The mid-cap index, while it was higher by about 1/3%, that does not tell you the full story. The full story is told by the advanced decline ratio, where for the third day running, over 1,800 stocks were in the red. The only solace that bulls would have is that, towards the end of trade, we had about 1,800 as against 2,000 plus in the last two trading sessions. And come what may, the Nifty is holding on to the 50-day moving average, this time by the skin of its teeth, 25,815. By today's end, we will get the 50-day moving average closer to those levels itself.
Absolutely. Hi, Mangalam. And obviously a day where we ended flat. But when you look at it for the IT sector, that managed to close comfortably in the green. So Nifty IT among the top sectoral gainers. Your realty, that managed to do well, 3/10 to 4/10% of gain as well. While in terms of the losers, we had media, we had energy, auto sector, which were on the red side. Now, obviously, that is what is in terms of the markets that we're seeing coming in. But we have a very exciting lineup for you all on the show as well. First up, we'll start with the top movers and shakers of the day with Urmas Patakia. Then we'll talk about Ola Electric. The share stumbled after CEO Bhavesh Agarwal sold an additional 4.2 crore shares. Also, we'll focus on Crompton Greaves as well as Voltas, which were surging in trade following rating upgrades from leading brokerage firms. Last but not the least, we'll delve into what are the key market events to watch out for in tomorrow's trading session. First up, for the first segment of the day, we'll go to Hormaz, who's at the big wall to tell us about the top movers and shakers. Hormaz.
Well, almost are unchanged today, markets being in snooze mode, but asset management companies were not in snooze mode whatsoever, and not just asset management companies, almost all capital market names did well today. HDFC AMC was up 7%, Nippon Life gained 6%, Motilal Oswal ended a good day as well. So all in all, a very happy day for the asset management companies. There's no bad news, turns out to be good news eventually. Ahead of Accenture's results, IT was the one that ensured that there were no further losses on the market, even though the Nifty ended off the highs of the day. TCS and Infosys contributed to the gains, as did Tech Mahindra and Wipro. So larger IT did well in today's session. Among the newsmakers, Meesho continues to grab headlines, finally ending 8% higher. So now more than 110% higher than its issue price. Ola Electric, another new low, 5% lower on the stock today. Antony Waste, again, order win leading to an 18% jump, and some negative news on Sun Pharma dragging the stock lower today. Among brokerage reactions, Voltas, after a double upgrade at a very choppy session, eventually gave up most of those gains to end 1% higher. Hero MotoCorp recovered from the lows of the day to end 1% lower, and Crompton, where Motilal Oswal had a very positive note, ending with gains of close to 3%. And lastly, stocks at 52-week lows in today's session. Suraj Estates continues to grind lower, as does Ramkrishna Forgings, Liberty Shoes and Poly Medicure, some other names that ended at 52-week lows today.
All right, Hormaz, thanks a lot for that. We also had a bunch of asset management firms. They rallied in trade after market regulators SEBI revised total expense ratios for mutual funds by excluding the statutory norms from the equation, as a result of which we saw a lot of these stocks, the likes of HDFC, AMC, Nuvama Health, and a bunch of them, actually, Nuvama Wealth, rather, all of them spiking. Sonal Bhutra joins in with what the brokerages make of this move and how it impacts the industry. Sonal.
Well, that's right. The final total expense ratio slabs which are announced by SEBI have come in as a relief because the cut is lower than what was proposed in the consultation paper in the month of October. In fact, if we take you through the numbers, excluding brokerage, these slabs are actually 5 basis points higher than what was proposed in the consultation paper. Brokerage expense ratios, they are now cut by 10 basis points. The expectation was that they could be cut by 15 basis points. So this has come in as a relief for the AMC industry and for brokers as well. But what are brokerages making of this move? They say this is largely neutral to positive for AMCs and brokers as well, because the market was fearing there could be a bigger cut in total expense ratio. For instance, Morgan Stanley says there is a relief which has come in terms of GST and commissions, which was estimated at 11 to 12 basis points, but the final number gives a relief of around 1 to 2 basis points. This particular relief offsets the 5 basis points impact from exit load removal, and this would mean a 3 to 3.5 basis points impact on large AMCs. But yes, it will not have a big impact on their profitability. AMCs are expected to pass through 60 to 70% of the impact to distributors, so the net impact could be even lower to around 1 to 1.5 basis points. This will equal to around 4% of their operating profit and around 3.5% of their FY25 profit before tax, but not as big as the industry was fearing earlier. Jeffrey says this is a relief versus what was expected. The 5 basis points exit load cut on equity AUM that remains now, this is a relief as well. Brokerage cap has been reduced to 6 basis points, excluding levies, versus proposed 2 basis points. So that is also something that the street seems to like. But the net impact of changes are expected at around 3 to 5 basis points of equity AUM, and AMCs may partially share it across the ecosystem, something like distributors. So it could be more negative for the distributors than AMCs itself. Overall, their view remains positive for AMCs, brokers, and RTAs as well.
Thank you so much for that, Sonal. But let's move on. Also, shift focus and talk about Ola Electric. The shares hit a fresh low after the founder and CEO, Bhavesh Agarwal, sold an additional 4.2 crore shares. And this is following an earlier sale of around 2.6 crore shares. The management said the transactions were undertaken to repay the 260 crore rupee loan as well. Let's go across to Ria to give us more details on this one.
Well, yes, Ola Electric was down roughly 5% in trade today, and this is after yesterday's fall of 4% as well. And in fact, this was the third consecutive session of losses for the company. And this has happened after the founder of the company, Bhavesh Agarwal, has sold an additional 4.2 crore shares of the company after selling 2.6 crore shares on Tuesday as well, when the stock took a hit of nearly 8%. Now, Ola Electric on Tuesday had said that this transaction was being executed to fully repay a promoter-level loan of 260 crore rupees, and they had also said that this share sale was a one-time limited monetization of the founder's personal stake, and they had also highlighted that with this, all of the previously pledged 3.93% shares will now be released. Now, these two transactions up until now have been cumulatively valued at roughly 234 crore rupees, and some more selling is expected going ahead. The stock is also down roughly 60% since its listing in August of 2024, and a couple of key points to highlight here. The retail shareholding in the company has increased to over 17% in the September 2025 quarter compared to just about 8% last year, whereas the mutual fund stake is now at roughly 5.5% in the September 2025 quarter versus 4.5% in the same quarter last year. And this is after mutual fund holding had touched a low of roughly 2.5% in the June 2025 quarter. Now, going ahead, what will be the triggers for Ola Electric? The Q3 results will be something to watch out for, and remember, the company has already cut its full-year revenue and margin guidance for FY26.
All right, good time to then bring in our guests. Mayuresh Joshi, Head of Equity Research at William O'Neill, and Somil Mehta of Mirae Asset join us now. Somil, let's ask you, there has been this jostling moves in the market where it's range-bound, but it's very frustrating as we move towards the end of this year. The Nifty is managing to hold on to that 25,800 mark, but not breaking out. There are times when, you feel like, okay, it's going to break down. That doesn't happen. And you look at the mid-cap index doing extremely well, but the advanced decline, your portfolio says, the things are not as good. So how should one read it?
Absolutely frustrating. I totally get your point.
It is the same case when it was when we were at 25,000, 25,400, those levels, and it was being consolidating for probably around 2.5 months there. Now this is the same case. We are around 25,500, 26,000 levels for the last 1.5 month almost. It has been a little frustrating, but I'll be focusing on more on the large caps. Small caps and mid caps a little, facing a little bit of selling pressure. But I will be expecting large caps to outperform here. Large caps should be the focus from here. Avoid the mid caps and small caps. For Nifty, support zone would be around 25,600, 25,500 levels, which is a very crucial support zone. And I'm not expecting Nifty to go below that. My targets on the upside would be 26,300, 325, and on the medium side, medium-term outlook, I'll be expecting 26,700, 800 levels. So buy on decline should be the strategy. The medium-term trend still remains positive. Bank Nifty, very similar. But I think Bank Nifty is showing little better charts here. It has been forming a flag pattern, a pennant pattern, just above the 40 daily moving average, which is a very crucial level, 58,590. This is a very crucial level to watch out for Bank Nifty. I'm not expecting Bank Nifty to go below this. My target should be well above 60,500. And if it sustains there, the next level will be 61,500, 61,700 levels.
Okay, and Mayuresh, a quick take on Ola Electric from you?
No, I think we've remained not so positive on this one, Vinny, for a long time. And again, I think the guidance that they've probably given out, not encouraging. I think the street probably is assuming that numbers will still be very, very soft. Whether it's a profitable growth after that, only time will tell. And competition is very intense. If you probably look at their competitors at this juncture, including the larger players, the platform, the dealership network they've got, the distribution, the after sales. I think competition, pricing, intensity, revenue guidance, margin performance, profitable growth. I think a lot needs to come through from Ola. So I think better players in the two-wheeler space to look at.
Right, better players in the two-wheeler space. We'll ask your views on the pharma space as well. But before that, let's go across to Ekta. Because Sun Pharma was under pressure today. The US FDA has actually, given an official action indicated for their critical Bazaar facility. That's a setback for the drug maker. Analysts believe that this limits their ability on new complex generics. What could the financial implications of that be? Ekta joins in.
Well, yes, Sun Pharma is in focus in today's trading session on the back of negative news with regards to their Bazaar facility, which has been classified by the US FDA as an official action indicated status, which basically means that there are compliance issues in that particular facility. Now, the plant was inspected from the 8th to the 19th of September 2025. The company has said that they continue to manufacture and supply approved products from this facility to the US as of now. Now, analysts say that Bazaar facility is probably one of the most important facilities for Sun when it comes to their new complex generics. And hence, the probability to deliver a potential positive surprise in the generic business might be lower for Sun Pharma as of now. But the official action indicated status as of now does not change the forecast, because analysts are not really pegging in a lot of complex generics in their forecast when it comes to approvals and sales from that particular segment. And hence, however, going forward, the approval timelines could change because of the compliance issues at the Bazaar facility. Now, remember that there are other facilities which are under the US FDA scanner, which Sun has. For example, the Halol facility, which has had an import alert since June 2022 and was classified as an official action indicated status post a June 2025 inspection. And they have the Mohali plant, which also has a consent decree or was sent a non-compliance letter in 2023. So yes, negative news for Sun Pharma, but how they basically respond to any kind of compliance issues will be critical to see in terms of what the complex generic pipeline could look like for the company going forward.
Thanks so much for that, Ekta. But let's move on. And Mayuresh, what's your view coming in for Sun Pharma as well? Today, this is a negative news flow. But otherwise, in the pharma pack, is Sun Pharma on the top of the list of the pecking order for you?
So I think Sun, Cipla, Lupin were few of our holdings in our global portfolios, but I think we have offloaded them over a periodicity of time. Our take is that the sector might just go through a consolidation phase. What probably comes through as a trigger for the sector going forward is going to be the key specialty launches that each of these individual companies will probably get through. Sun has a very, very selective specialty pipeline. How are they able to monetize that? How are they able to probably get those phase 3 trials in place and probably launch these drugs are going to be critical. Similarly, in the case of Cipla, their multi-inhaler drug expected to get launched both in the EU and the US region is keenly watched out for. For Dr. Reddy's, it continues to be the biosimilars which are expected to get launched. And therefore, I think the take is this specialty pipeline is going to be extremely critical. We're waiting in terms of how this pipeline probably evolves and therefore take a call accordingly when the appropriate time probably comes. At this juncture, I think equal weight on the sector is.
All right, Mayuresh, thanks a lot for that. In fact, I'll thank you and Somil as well. Somil, may the wealth creation continues. Frustration is a daily thing. Wealth creation is a long-term opportunity. We'll watch how that pans out over the next few, trading sessions and beyond that as well, because we're all here for the long term. But speaking about the long term, there were a couple of brokerage notes that came by. They are positive on the long term for both Crompton Greaves and Voltas. And the stock started to surge in the short term itself. Hormaz.
Initiation, of course, on Crompton first up. The stock gave up most of those gains, ended higher. But initiation from Motilal Oswal with a buy recommendation, price target of 350, implying a 40% upside. Now, what they say is that they are hoping that the 75% stake that they own in Butterfly Gandhimati, they are planning to have some revenue synergies and cost synergies from that. They are also looking to have more ad spends that will help them generate or strengthen their brand strength going forward. They are expecting an EBITDA and PAT CAGR of 17 and 21% over the next 3 years. And as some risk factors they highlight, there will be high competitive intensity, and if there is a dip in demand in case there is an economic slowdown. In a bull case scenario, they see a price target of 460 rupees. That shows up a potential upside of 77% as well. For Voltas, it's a double upgrade for them by BofA. They've double upgraded it to a buy. The earlier rating was an underperform rating. The price target has been raised to 1555 from 1250 earlier. They're saying that it is going to be the biggest beneficiary in case there is a normal monsoon in a normal summer in calendar year of 26, and there will be additional tailwinds as well. This is a low base, there will be cost synergies, and there will be pent-up demand that will boost the stock as well. They are expecting the current quarter to remain a subdued one, but they say that this is in the price already, and they are expecting a very sharp earnings rebound considering a low base. So they are anticipating a 44% CAGR over the next 3 years.
Okay, Hormaz, thank you so much for that. Important stocks to keep an eye out on as well. But on that note, we're going to slip into a very short break. After the break, we'll get you the top corporate voices along with key market events to watch out for in tomorrow's trading session. Welcome back to Markets Forward on CNBC TV18. Now, fresh trouble for Indigo. The airline is now facing a probe from the Competition Commission following the mass cancellation of flights earlier this month. The CCI will probe complaints against the airline after the recent disruptions. Now, Indigo commands 60% market share when it comes to the air traffic. Parikshit is joining us now to give us more details on this one. Parikshit.
Well, we have been seeing a lot of customer complaints against Indigo for the kind of disruptions we've seen over the last few weeks. The Competition Commission of India, which is our antitrust regulator, has taken cognizance of a complaint that it had received in the last few weeks. The complaint was regarding abuse of market dominance under Section 4 of the Competition Commission of India. The reason why this is important is because this is always the first step before a final and proper investigation is launched. At this stage, the Competition Commission will only look at and decide whether an investigation has to take place or not. This process could take place anything between weeks to a few months. Once an investigation is ordered and Indigo is found guilty, first, the investigator will have to decide whether Indigo is guilty or not of market dominance. If it is held guilty, then action will be taken under Section 4 of the Competition Commission of India Act, which means that 10% of the company's total revenues could be the penalty for such an offense. Secondly, there could be structural remedies that could be ordered by Competition Commission of India. The CCI may also seek the removal of certain routes from the Indigo network if the investigation finds the airline guilty of market dominance. But remember, we're at a very initial stage right now. This is only a time when the CCI has taken cognizance of a complaint. They will now decide whether a formal probe has to be ordered against Indigo Airlines or not.
Parikshit, thanks a lot for that. In fact, this development comes on a day when the stock did well and the Indigo CEO told his employees, and this is the reason why the stock did well, he told his employees that the worst is behind the company. Peter Elbers said that the operations had stabilized at around 2,200 daily flights, which have been restored right now.
What we witnessed seems a compounding effect of several factors. Everyone wants answers. Speculations are circulating, but I encourage everyone, please stay calm, focus on your professional responsibilities and avoid engaging in such speculations. We need a full-scale analysis.
Okay, on that note, before we wrap up this edition of Markets Forward, let's go across to Gaurav, who's here to tell us what are the key events to watch out for in tomorrow's trading session. Over to you, Gaurav.
Well, yes, if you look at tomorrow, first is Shriram Finance. Remember, there is a meeting, board meeting, where they will consider fundraise, and it is important because there are speculations going on that Japanese firm MUFG is looking to buy around 20% stake in Shriram Finance for a valuation of as high as $4 billion or even more. If you look at the structure, that is something that a key thing to watch out for. And in fact, if you look at the stock performance, it has ran up today itself. Dr. Lal Path Lab, this is also one stock where we will keep our focus because tomorrow is the record day for bonus issue in the ratio of 1:1. Other than that, we'll be getting listing of ICICI Prudential. The 10,000 crore IPO got oversubscribed almost by 39 times. And if you look at the grey market premium, that suggests around 15% gain from here on the listing day itself. Apart from that, FX reserves data, that is something that we will be getting for Indian markets. This is also important given that a lot of volatility going on in the Indian rupee. From the global markets, Bank of Japan. Now, the decision from interest rates from this segment is a key thing to watch out for. And the reason being that there is a lot of carry trade which happens between Japanese and US currency. And given that there is a speculation that 25 basis point of hike can happen, although it is factored in, any kind of surprise could act negatively for US market as per experts. Other than that, from the US markets itself, we will be getting data for existing home sales and at the same time core PCE price index. So definitely let's keep an eye on that as well and see how market performs and reacts to these levels.
Right, Gaurav, thank you so much for setting us up for trade tomorrow, Friday. A lot of events and cues to watch out for. With that, we're out of time on this edition of Markets Forward. You stay tuned to CNBC TV18. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty end in the red for the fourth day. Mid-caps buck the trend. The rupee regains some lost ground against the dollar but remains above the 90 mark. Shares of asset management companies rally after SEBI's mutual fund cost overhaul were less stringent than expected. Brokerage fee also cut by half. The street does not expect any major hit to profitability of AMCs. The Lok Sabha passes the new legislation to overhaul the Rural Employment Guarantee Scheme and opposition parties protest. The bill increases the number of work days to 125, but states will need to share 40% of the overall cost. The government agrees to refer the Securities Market Code Bill to a parliamentary panel. The bill seeks to rationalize 4 existing legislations governing SEBI, depositories and government securities into one single code. The opposition says the bill is against the principle of separation of powers. The Competition Commission of India launches a probe into Indigo after the mass cancellations of flights earlier this month. This comes on a day when the Indigo CEO told staff that the worst is behind the company. The airline is back to operating 2,200 flights a day. Ola Electric shares hit a record low. The founder and CEO Bhavish Agarwal dilutes his stake worth 234 crore rupees in 2 days. The company called it a planned one-time sale to settle promoter debt worth 260 crore rupees. Mutual funds have been reducing their stake in Ola for more than a year, but the retail investor holding has doubled in the same period. India and Oman sign a free trade agreement. The Prime Minister called it a major step in deepening ties with the Gulf region. India's annual exports to Oman stand at nearly $4 billion. The government's top auditor issues a warning on direct benefit transfer schemes. The CAG says thousands of crores are flowing into beneficiary accounts without mandatory checks, blames weak data integration and government departments working in silos. The air quality in Delhi remains hazardous even as strict pollution control measures take effect. The pollution levels in adjoining cities like Faridabad, Noida and Gurugram worse than Delhi and 30 times above standard levels. President Trump defends his handling of the economy and the tariff onslaught, announces a new warrior dividend for active military personnel and claims it will be paid with revenue from tariffs. Well, let's start with the day's market action. The Sensex and the Nifty declined for the fourth day, but the losses were marginal at close. The mid-caps did, of course, manage to outperform the blue chips with the index ending in the green. So the mid-cap index up 200 points, Nifty flat, the Sensex as flat as it can be, and so similar story playing out for the Nifty Bank. But from the equity market to the currency market, the rupee has regained some lost ground against the dollar, but it remains above the 90 mark. It is the worst performing currency in Asia. Foreign fund outflows and uncertainty over the US trade deal continue to weigh on sentiment. 90.24 is the dollar rupee. In the commodity market, crude oil prices increased after President Trump's blockade of sanctioned tankers coming in and out of Venezuela. Oil prices rose over the $60 barrel mark after nearing 4-year lows in the previous session. Traders are keenly watching for a potential peace agreement in Ukraine, which is expected to bring Russian crude supply back to the market. Bitcoin prices surging surprisingly, in fact, nearly $3,000 in just 1 hour, reclaiming the $90,000 mark before profit booking pulled prices down to $86,900 within minutes. Now, this rapid move triggered $200 million in long liquidations within an hour, shaking the broader crypto market and pushing most major tokens lower. The volatility has revived near-term downside risks for the sector, so extremely sharp moves being seen there in the crypto market. Stocks of asset management companies rallying in trade after the market regulator SEBI revised the total expense ratios for mutual funds by excluding statutory dues from the equation. Sonal is standing by with what brokerages make of the move and how this is likely to impact the industry. Sonal, less severe than what the industry was bracing itself for?
Well, that's right. The final total expense ratio slabs which are announced by SEBI have coming as a relief because the cut is lower than what was proposed in the consultation paper in the month of October. In fact, if we take you through the numbers, excluding brokerage, these slabs are actually 5 basis points higher than what was proposed in the consultation paper. Brokerage expense ratios, they are now cut by 10 basis points. The expectation was that they could be cut by 15 basis points. So this has come in as a relief for the AMC industry and for brokers as well. But what are brokerages making of this move? They say this is largely neutral to positive for AMCs and brokers as well, because the market was fearing there could be a bigger cut in total expense ratio. For instance, Morgan Stanley says there is a relief which has come in terms of GST and commissions, which was estimated at 11 to 12 basis points, but the final number gives a relief of around 1 to 2 basis points. This particular relief offsets the 5 basis points impact from exit load removal, and this would mean a 3 to 3.5 basis points impact on large AMCs. But yes, it will not have a big impact on their profitability. AMCs are expected to pass through 60 to 70% of the impact to distributors, so the net impact could be even lower to around 1 to 1.5 basis points. This will equal to around 4% of their operating profit and around 3.5% of their FY25 profit before tax, but not as big as the industry was fearing earlier. Jeffrey says this is a relief versus what was expected. The 5 basis points exit load cut on equity AUM that remains now, this is a relief as well. Brokerage cap has been reduced to 6 basis points excluding levies versus proposed 2 basis points. So that is also something that the street seems to like. But the net impact of changes are expected at around 3 to 5 basis points of equity AUM, and AMCs may partially share it across the ecosystem, something like distributors. So it could be more negative for the distributors than AMCs itself. Overall, their view remains positive for AMCs, brokers and RTAs as well.
No, I think it will adversely impact both the funds and the brokers as well. And again, you know, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You know, you have people who spend their entire lives just looking at infrastructure or just looking at transport industries. You know, if mutual funds start hiring those kind of specialists, you know, they'd have a research team of 100 people.
Well, the reactions there coming into SEBI's decision. Now all the action from Parliament. The government has agreed to refer the Securities Market Code Bill to a parliamentary panel. The bill seeks to rationalise 4 existing legislations governing SEBI, depositories and government securities into a single code. Opposition parties say the bill is against the principle of separation of powers. The finance minister said the bill will be referred to a standing committee for further vetting.
Gone through in detail the points which the members who are opposing the introduction of the bill. I think instead of going into details of each one of the objections, I would like to highlight the point that at this stage of introduction, we are only making the bill to be sent over to the standing committee to do a complete review of it, of the bill.
Well, that's the finance minister. Now, the government did not relent to the opposition's demands to send the bill to overhaul the Rural Employment Guarantee Scheme to a parliamentary panel. The Lok Sabha passed the bill today amidst opposition protests. Copies of the bill were torn on the floor of the parliament, and the House was adjourned immediately after the bill's passage. The new bill, the Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin, mandates an increase in guaranteed employment days to 125 days from the current 100 days. The legislation also proposes a higher financial burden for most state governments. At present, the centre bears 100% of unskilled labour costs and 75% of material costs. Under the new framework, 40% of the total costs will be borne by all major states. The bill also seeks to alter the process of budget allocation. The central government will provide a fixed allocation and states will lose the flexibility that they currently have to propose budgets based on anticipated demand. Opposition lawmakers have also questioned the decision of the government to rename the bill by dropping Mahatma Gandhi's name. Air quality in Delhi remains hazardous even as the strict pollution control measures come into effect starting today. Petrol pumps will not be able to supply fuel to any vehicles that do not comply with the BS4 standard or above. 50% of government staff are working from home. Primary schools have switched to online classes. The pollution levels in adjoining cities like Faridabad, Noida and Gurugram far worse than Delhi and 30 times above standard levels. The Parliament was scheduled to debate air pollution today, but the Lok Sabha was adjourned after the bill to overhaul the MGNREGA was passed. Now, Indigo is facing a probe from the Competition Commission of India following the mass cancellations of flights earlier this month. The CCI will probe the complaint against the airline after the recent disruptions. Indigo commands an over 60% market share when it comes to air traffic in India. The CCI says its probe will be in accordance with the Competition Act. Now, this comes on a day when the Indigo CEO told employees that the worst is behind the company. Peter Elbers also said that operations had stabilized and that 2,200 daily flights have now been restored.
What we witnessed seems a compounding effect of several factors. Everyone wants answers. Speculations are circulating, but I encourage everyone, please stay calm, focus on your professional responsibilities and avoid engaging in such speculations. We need a full-scale analysis.
Indigo CEO Peter Elbers has reached out to the employees after the airline's recent operational disruptions, saying that the worst is behind them. He has urged staff to avoid speculation, stay focused on professional responsibilities, and said that the leadership team will travel across the network to meet teams on the ground, hear feedback, and assess challenges firsthand. Now, this message comes at a defining moment for the airline. According to DGCA data, Indigo has overtaken the Air India group in terms of international passenger traffic. In the July to September 2025 quarter, Indigo carried around 41.4 lakh international passengers, marginally ahead of Air India Group's 41 lakh passengers. In the January to March quarter, remember, Air India Group was firmly in the lead, flying 45.5 lakh passengers compared to Indigo's 39.3 lakh. That gap narrowed in April to June, and by July to September, Indigo has moved ahead of the Air India Group. This shift also follows the June 12th crash of Air India flight AI-171, after which Air India cut international capacity by around 15%, particularly on long-haul routes, amid safety reviews and a brief dip in passenger confidence. Indigo, meanwhile, maintained capacity and frequencies on key international routes, allowing it to capture a larger share of the traffic. Now, even now, Air India Group operates a wider international network, 48 overseas destinations versus Indigo's 44. But let's see if Indigo is able to sustain the lead.
Shivani, many thanks for joining us. Ola Electric shares hitting a new low after its founder and CEO Bhavish Aggarwal sold shares for 2 straight sessions. Aggarwal diluted stake worth 234 crore rupees with the firm, calling it a planned one-time sale to settle promoter debt. While mutual funds have been reducing stake in Ola for over a year, retail investors' holding has in fact doubled. Hormuz is standing by with the details. Hormuz, the stock hitting a record low.
Another day, another low for Ola Electric, and the price action over the last 3 days would tell you that something was brewing, because the stock was down almost 8% on Monday, fell another 4.5% yesterday, and then another 5% in today's trade as well. Now, what has happened is, now from the IPO price, the stock is down over 55%, and from the post-listing high, which is 157 rupees, the stock is down almost 80% from those levels. Now, what had happened yesterday was the fact that Bhavish Aggarwal's announcement of selling another 4 crore shares. This was in addition to the 2+ crore shares that he had sold on Tuesday as well. So that took the count to around 7 crore shares worth almost 234 crore rupees. What Ola Electric said in its earlier statement, that it was a planned one-time sale to reduce promoter debt, and the overhang of pledged shares would be over after this. And what sources are now saying is that this was intended to be done in tranches and not in one single block. Now, it's been 5 quarters since Ola Electric has been listed, and in those 5 quarters, 5 full quarters at least, the returns have been negative in 4 of them, including the stock almost halving in this very quarter itself. Now, if you take a look at the September 24 shareholding pattern, the number of retail shareholders was around 14 lakh with almost 8% stake. That number as of September this year is 19 lakh shares with almost 17% stake in the company. Now, for mutual funds, they have been reducing their stake over the last 3 quarters, barring this one where they increased their stake from just over 2.5% to over 5.5%. A couple of prominent names being part of this as well. So the next big trigger for Ola Electric now emerges is whether there is any further sale that comes in from Bhavish Aggarwal. The 3rd quarter results will be important to watch, because the company has already cut its revenue and margin guidance for the full year. So it promises to be a bumpy ride ahead for Ola Electric.
Well, many thanks, Hormuz, for joining us. That's Ola Electric. Now, shares of Sun Pharma down in trade after a setback from the U.S. drug regulator. The U.S. FDA has classified the company's plant in Gujarat as official action indicated. U.S. officials had inspected the plant in September, and it is one of the most important facilities for Sun Pharma to manufacture complex generics. The Ministry of Corporate Affairs has ordered a serious fraud investigation of its probe into IndusInd Bank. Sources say the investigation follows concerns flagged by the bank's auditors and the RBI, and it's linked to a derivatives reporting matter. The SFIO order was issued on the 12th of December with no details yet on the scope or the timeline. The CEO of IT major TCS says the company expects $1.5 billion in revenue through artificial intelligence this year. Kriti Vasan also said that AI projects accounted for nearly 5% of overall revenues. This is the first time TCS has reported its AI revenue, so that's a new one coming in. Remember, HCL Tech was the first to give a breakup of AI revenue. A week after a bumper debut, and Meesho's market cap has already crossed the 1 lakh crore rupee mark. Now, this makes the e-commerce giant more valuable than companies like Jindal Steel, Indian Hotels and United Spirits. The stock did see some profit booking today after touching fresh highs. The stock has more than doubled from its IPO price and is 45% higher from its listing price. Manglam joins us now. Manglam, take us through the key reasons for this kind of a runaway performance there for Meesho.
Well, it's a big move that we've seen on Meesho. In fact, just as we speak, the stock is up nearly 10%. 6 continuous days of a big move that we've seen on Meesho. There are multiple reasons why the stock saw a rally as well. The first part, obviously, post-listing, there were a lot of institutions that did not get allocation in the anchor book. The issue was fairly well subscribed. So those guys went ahead and bought. Secondly, there were a couple of brokerage notes that came by as well. And third, most important, there was very limited float available for the counter. So as a result of which, the impact price or impact cost was a lot more. Just to put things into perspective, and these numbers change as we speak. The stock from its issue price has rallied a whopping 115%. And, we look at it post-listing as well. It listed at around 162, 162.5. If you look at it from there as well, the stock has seen a rally of nearly 45%. It's just 5 or 6 trading sessions. At IPO, the valuations were close to 5 times sales. Now it's moved all the way up to 11.5 times sales. The management has been speaking about generating and growing their free cash flow while improving contribution margins. But at some point, valuations will come to the fore because at the current market cap, upwards of 1 lakh crore, it's well above names like Jindal Steel, Indian Hotels, United Spirits, some companies like Havells and Dabur as well. For perspective, Meesho is a company that was founded just about 10 years ago and now has a market cap much above all these big listed companies too.
Manglam, many thanks. The government's top auditor issues a warning on the direct benefit transfer schemes. The CAG says thousands of crores are flowing into beneficiary accounts without the mandatory checks. That and more when we return. The government's top auditor has issued a warning on direct benefit transfer schemes. Speaking at an event in Nagpur, the Controller and Auditor General said thousands of crores are flowing into beneficiary accounts without the mandatory checks. He blamed weak data integration and government departments working in silos for the reason. Let's take a look.
There is a huge gap. We are saying that they're all Aadhaar-based linked beneficiary transfers. But the amount of deduplication or the amount of cross-database verifications that are mandated by the regular regulations of the DPT mission are still wanting. And there are thousands of crores going around into the system without these basic checks.
Well, that is the CAG on DBT accounts. The big news coming in from FTAs. India and Oman have signed a free trade agreement. Prime Minister Modi and the Sultan of Oman signed the deal in Muscat today. Prime Minister Modi, terming the deal as historic, said it will deepen the relationship with the Gulf region. India's annual exports to Oman stand at nearly $4 billion. The deal hopes to increase the export by 50% in the next 3 years. Government sources say this pact would act as a template for FTA talks with other Gulf countries. The prices of petrochemicals, dates, decorative marble and frankincense are set to get cheaper. However, gold, silver, bullion along with petroleum products and non-ferrous metals have been kept out of the FTA. Here's the Prime Minister.
आज हम एक ऐसा ऐतिहासिक निर्णय ले रहे हैं जिसकी गूंज आने वाले कई दशकों तक सुनाई देगी। कॉम्प्रिहेंसिव इकोनॉमिक पार्टनरशिप एग्रीमेंट यानी सीपा हमारी पार्टनरशिप को 21st सेंचुरी में नया विश्वास, नई ऊर्जा से भर देगा। ये हमारे साझा भविष्य का ब्लूप्रिंट है।
Well, that is the Prime Minister on the India-Oman FTA. And before we wrap, after a whirlwind India tour of 4 cities in 3 days, football legend Lionel Messi and his Inter-Miami teammates Suarez and DePaul visited Vantara in Gujarat's Jamnagar. We leave you with images of Messi and his teammates spending their time at the Anant Ambani-led Wildlife Rescue Rehabilitation and Conservation Centre. From all of us here for now, many thanks for watching.
Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with News 18 Network.
Hello and welcome to Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with the News 18 Network. I'm Surabhi Upadhyay. Now, over the last decade, India's mutual fund industry has seen an extraordinary transformation. The industry's assets under management have grown nearly eightfold, from about 10 lakh crore rupees in 2014 to over 80 lakh crore rupees now, the latest data. This growth has been driven by rising retail participation, the SIP movement, and increasing financial awareness across the country. In this inaugural episode of Season 3, we decode how India's mutual fund industry has become a powerful force in nation building, from capital formation to the massive retail participation wave that is reshaping our equity markets. Joining me today are two leaders who have been at the center of this transformation, Mr. Sandeep Sikka, Chairman of the Association of Mutual Funds of India, and Mr. Venkat N. Chalasani, CEO, Association of Mutual Funds in India. Thank you so much, gentlemen, for joining in. It's an honor to host you here, because while we have conversations about mutual funds and their role in India, I don't think it has been ever more pertinent. This is a year when the market tested us, when foreign investors tested us, when the US administration tested us, and mutual funds came to the forefront. And what a performance. Opening thoughts, Sandeep?
No, I think it's really satisfying to see. I mean, I think you rightly said, I think this has been a testing year. Yeah. And this year we saw highest amount of outflow from the foreign investors. Almost $18 billion money has gone out. And I think the only thing what's been working for us is the domestic savings. But what's even more gratifying and satisfying for all of us is, I think mutual funds are helping the common man to be a part of the India growth story. Now, it's not just about the AUM, it's not about, when we talk of Viksit Bharat, I think today it's about the financial independence. And mutual funds are helping investors in small cities and towns to participate in the mutual fund India growth story. So let me give you a very interesting trend. Today I think it's a proud moment for the country that 100% districts of India, 99.99% of pin codes of India have mutual fund investors. I mean, this is something we could have never thought of. Yeah. And the outcome of that, what you said, we have the foreign, holding, I mean, in the Nifty companies is an all-time low. Yeah. The domestic institutional holding all-time high. Yeah. And the gap between the foreign and the domestic is at, again, all-time low. Yeah. Now, this is basically what is the changing India. And I think we feel so proud, all of us have been a part of the journey where mutual funds are changing India and also changing the financial wealth in small cities and towns.
Yeah. Mr. Chalasani, I mean, how do you look at the transformation and where are we in that learning curve?
First of all, thank you, Surabhi, for inviting us for this program. It's always nice to interact with you on this any particular show. There is a structural change in the way in which people are investing. People were savers. India has got a habit of saving. Their household savings were one of the largest in the world with more than 35%. But while the savings are there, most of the savings of the household savings would go into non-financial assets. Approximately around 66% would go into non-financial assets. Within the financial assets also, people would tend to invest almost 45 to 50% in the banking deposits. So the savings are distributed majorly into non-financial assets and to the banking assets. And if you look at the remaining 50% of this 33% that was going towards some amount of it is going towards a mutual fund, some portion, small portion towards equities and all. But what has happened today as we speak now, there is a structural change, as I mentioned earlier. People were moving from the banking deposits towards the investing into equities and into the mutual funds. And this has helped majorly because of the way in which under the SEBI's guidance, the industry has done the mutual fund Sahi Hai program, where financial awareness is spread across the length and breadth of the country. Yeah. And that financial awareness has slowly getting translated into what Sandeep had rightly talked about, the financial well-being and financial empowerment of the people.
Absolutely. But Sandeep, and you've been observing investors in the investing landscape for so long. What has changed? Because in the past, every time the market would fall, and we've been reporting on markets, I've done it for so many years, right? We would all say whether, people are rushing out of their funds, are redemptions very high? Now, in the last 12, 15 months, every time we asked that question to fund managers, and the answers were largely no. It's business as usual. So what has changed?
So this would be, I think it's very interesting. I think this change is evident, you know, and I think one of the key things, you know, investment behavior, people have it over generations, and it takes a lot of education. And I'll give credit to media, you, all the participants of media, and AMFI and SEBI. You know, this education that has been done over the years, that is what is showing results. So let me give you an example. You know, I mean, about 5 years back, if the markets would fall, you know, let's take 500 points, 1,000 points, I think we would, you know, all mutual funds in the call centers would get calls. What happens, you know, what do I do and not do, you know. Today you're at a stage where people don't react, now, which is a sign of maturity. So I think, but the key is education. So the other thing that what we have seen is also, once, you know, now earlier people used to, I think you rightly said, the savers have become investors. So in this journey, when they were started investing in mutual funds, because they were traditionally FD investors, any loss of capital would scare them. Now I think what they realize, they're understanding the longer they stay, the longer they invest, I think the more wealth they make. So it's a very interesting change, you know, that's happening. And I think I can tell you one thing, never before we could have expected, in spite of all the market volatility, the SIPs continue, the numbers continue to increase. The investors from small cities and towns continue to increase. But what is the most interesting point is, the big change that has happened, you know, earlier when the markets used to fall, the question is to, should I stop my SIP? Right now, if you go on ground, the question is, should I add another SIP? You know,
and that's a phenomenal change in just the investor psyche, right? In the mindset.
So for me, I think the one credit is the investor education. I mean, that has changed. And again, give credit to SEBI. You know, it has never happened in any industry before when SEBI allocated 2 basis points for investor education. And I can tell you, we've been a part of industry for long. When it came, we thought it's like a tax. You know, when it's 2 basis points going on. Today, I can tell you, all the 50 mutual fund CEOs will tell you the best thing that has happened to the mutual fund industry was when SEBI introduced this 2 basis points.
Let's talk a little bit about the maturing and evolving investor. What will be, you know, what will be some of these diversification trends as we look into the next couple of years?
So it's, if you step back about 10, 12 years back, I think that's where the mutual fund change started taking place. So at that time, the first diversification was basically moving away from fixed deposit into mutual fund. That's the first diversification. Then you go to the next level within mutual funds, you know, I think it was only equities. We also saw investors moving to fixed income. Then within equities, we saw investors maturing. I think A was basically then people started understanding there's something called mid cap, large cap. And then they also understood there's certain things they don't understand. For that, there's a flexi cap. You know, so that's the best thing to be in. Indians have loved gold. Physically, we've been buying gold. I think we have always been saying, I think, and somehow markets have proved investors right. You know, I think there was nothing wrong. But the biggest change that has gone unnoticed in India and the Indian mutual fund industry is the change of investors moving away from physical gold to ETFs.
Financial form of gold.
So I'll give you a number that will many of the viewers will not be aware of it. The biggest change that's been happening is, you know, let's look at every Diwali. For last 5 Diwalis, earlier, you know, we used to have Dhanteras, we buy gold or silver physically. 5 years back, the total volume of stock on the stock exchange for gold ETFs was about 50 crore rupees. Next year it went to 100. 150, this year it was 600. Now imagine when for religious reason you start buying electronic gold. That's the biggest change that is taking place.
Absolutely, complete change in...
Passives have also evolved a lot, you know, and I think I give credit to the mutual fund industry. I think from our point of view, what we feel, we will offer all the best high quality products and let the investor and the advisor decide where he wants to go. So we have seen the change of gold ETFs and passives. These are 2 things which you see the investors are maturing. They have their own views. I think from our point of view, we want to give the best products to them and let them decide, and them and their advisors advise what is best.
What is best for them. I want to, you know, sort of get you to wear your, you know, magician's hat and try and look in the future, as they say, because there are so many offerings. Mr. Chalsani, what do you think will be the most interesting product to watch from the mutual fund arena? And let's not forget, mutual funds are also offering PMSs. There is SIF, there are the plain funds, I mean equity or fixed income funds, there are passives, the whole gamut. So what would you watch for?
Again, for the credit to the SEBI again, there are 2 things they have done. One, during this particular year, one, they said that, okay, you have investors who are investing up to 10 lakh rupees. And there are people who have got product above 50 lakhs, PMS is there, and above 1 crore you have AIF is available. But there is a gap between 10 to 50 lakhs who can understand the risk, they are investing, they look for a better returns, and they understand the risk. So because of that, they introduced this what we call as a SIF, the new product that has been introduced. where new strategies have been brought in.
Yeah.
And that's a space which you're looking at to grow as we speak now significantly, because we are trying to bring in more and more distributors, because the manufacturers are looking to introduce these products, produce them. That distributors are the one who are going to distribute them, and there are the investors who are looking to invest.
Absolutely.
So we're going to bring all three together. That's what our AMFI, our objective is, to see to it that bring all three together.
It all comes together. This is very important, and Sandeep, come in on this, because SIFs are more sophisticated in nature. Yes. These are going to be more complex strategies, long, short, etc. on the fixed income side, on the equity side. So what will you look to do as the industry body to ensure that the investor experience remains fairly good? I mean, it's not soured because it's a new product. It needs to be understood very well.
So it's a very valid point, because anything new, what happens many times, a lot of investors just rush into it.
Yeah.
And this is a little more, I won't use the word riskier, but it's a little more complex product. I think one needs to understand. So one good thing, the safeguards that have already been put by SEBI, that the minimum amount has to be 10. Then also, I think the fund management experience that you require for it. And there are certain other things, from a risk management point of view, which are there. But from an AMFI point of view, I think, like you said, I think we are very clear. I think the idea is to keep educating people. There is, across the world, even if you feel US is today a very matured market, even now, I think they are educating the investors, because there are always going to be a new set of investors who don't have an idea, or there are going to be newer products. So investors will never know everything. So from our point of view, I mean, but it's not that the industry has gone and launched, the mega
like hundreds of
this.
On the street,
I take this as a very big maturity of the industry. Had it been 10 years back, you would have said, everybody wants to say, I am the first one, I have this, I have that. You're saying, let's take it easy, let it mature, let investors, let's get distributors ready. So I think that's something, I feel it's going to be critical. To your earlier point, looking into the next year, which product?
Yes, which product is going to be the most interesting
I saw that, this thing, let me get. So I think very difficult to pinpoint, what is that one product, from, rather I would put it exact opposite, and I think investors should never look at the one product for that year, because investment decisions are made over a longer period of time. So another thing, what we have seen, there are times the small cap, mid cap, large cap and all, everything, I think it has to be right asset allocation. So that is one. B, if there's one thing that I think I want investors to look at, it is basically, I think over the period, especially last 10 years, because of the equity returns being so good, people have started assuming or believing it's about equities, mutual fund is about equities, and equities will always give positive returns. And we started the journey from fixed deposits, and people have forgotten fixed income in mutual funds. So today we have less than 10% of the investors, individual investors, who are investing in fixed income. So if you have to ask me, it is good for the markets, it's good for the investors, it's good for the economy. I think you need to see more money coming into the fixed income, which is going to be a very, very important thing. I do not know whether it's going to happen next year or not, but if you ask me, over the next 5 years or 10 years, you'll see a big shift happening. Investors which have, due to whatever reason, have left fixed income, or never adopted fixed income, or adopted mutual funds only for equity, they'll come into fixed income.
Well, we have to take a quick break on that note, but when we come back, we have to discuss regulation, how that is evolving, and as investors, what do we need to watch out for? And digital adoption. So much of mutual fund buying and selling is now happening through our mobile phones. What does that mean for the entire ecosystem? We'll chat about it after the break.
Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with News 18 Network. Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with News 18 Network.
Welcome back. You're watching Nivesh Ka Sahi Kadam, and I'm in conversation with AMFI Chairman Sandeep Sikka and CEO Venkat Chalsani. Now, just before we went into that break, Sandeep made an interesting point about diversification into debt. Because let's face it, mutual fund investing in India has almost become synonymous with equities, maybe to some extent now, commodities as well. Which also brings me to the point of regulation. And, weighing on this, Mr. Chalsani. Now, a couple of years back, debt funds enjoyed great taxation. That's why it made a lot more sense to, park my 3-year money in a debt mutual fund instead of a fixed deposit. Then that was taken away. So if the objective that Sandeep, described, if that has to be achieved, then how will it happen? I mean, can the industry do anything? Do you need some regulatory changes for it? How does it happen?
So two things. One, of course, we have made a request, as always. This time also we made request to the Government of India, asking for the bring back the taxation benefits, and indexation benefit as well. The advantage of it, as you're speaking, is that the retail investors, retail investors are investing into the fixed income as we speak now as well. But then retail investors are going to get the advantage of the fund managers' research and investing into these corporate bonds if they are allowed to do it through the mutual fund. And the tax benefits is something that's going to attract. And what other important point I would like to bring to your notice, Surabhi, is if you look at it 2019, 2020, both equity and debt markets, fixed income mutual fund, both were at the same levels.
In terms of size?
In terms of size. In fact, fixed income was slightly more than the equities mutual fund. Today, as we speak now, 70% of it is coming from the equity and 30%. It remains stagnant. Debt mutual fund has remained stagnant. We need that to improve, and if you want retail participation to happen in the corporate bond space, mutual funds should be made more attractive.
So just 2 minutes at Sunny's point. It's very interesting. A couple of years back, he talked about the AUM. Now, let me give you the number of investors in mutual fund industry. So I may be off by 1 or 2% here or there. So about in 2018-19, at that time, 25% of retail investors in the mutual fund industry were fixed income. 2023, when this taxation was taken away, at that time it was 18%. Today it is 9%. And today fixed income is the only asset class which does not have long-term capital gains. There is no other asset class in the country where there's no this thing. So to your point, if there's one thing that I think we're looking at as AMFI, we have also made a representation to the ministry. I think it will help not only the mutual fund industry, but it helps the country for the deepening of the bond markets.
One thing that I must admit is probably a little daunting now for the investor is just the sheer amount of choice. There are more and more funds, and there are NFOs, and then you have your traditional advisors / distributors. You have a lot of apps on the phone these days, apps telling you whether this fund is good or not, whether you need to, eradicate it or keep it. So how does an investor navigate all this complexity? Because with more choice, typically, you do get more complexity. Sandeep?
Well, I think it's a very valid thing, today, and I'm just thinking how to answer it, because what happens is the number of mutual fund schemes are increasing, the number of mutual funds are increasing, we're at an all-time high, and I think with the SEBI categorization, every mutual fund will have those number of schemes, so it's just going to continue increasing, it's not going to reduce. I think the only thing the advice, I think, for the investors will be, I think you will have to, over a period of look at funds which have a long-term track record. I'm not trying to say there will be new fund houses which will be coming, which will build up a track record. But broadly, if there's one parameter that you have to look at, don't get carried away with the thematic things, don't get carried away with the seasonal flavor. I think you need to stick, to the long-term track record. And that's the only thing that matters, I think. Because over a period of time, let me tell you, I think if you were to see, most of the funds will mimic the performance of the markets. So there's no need to get extra excited. I mean, there's a new theme that is, looks very exciting, so you need to jump into it. The other thing with what we feel is, with the number of schemes increasing and also the basically markets becoming more complex and the new asset classes, you talked about SIF. A lot of investors may not understand SIF. The role of the advisor is increasing even more. And since you talked about the digital thing, it's a very interesting. while I think we are seeing the role of digital, I mean, we are using the mobile for every small thing, the mutual fund also people have started investing like the same way.
Yeah.
But that may not be right approach. For mutual funds, you need to have a little more planned. It's being very, very, impulsive and investing is not the right strategy. That may be good for shopping, but not for mutual funds, And I think the digital part is helping investors in two ways. They're getting more educated, they're doing more research through that. I think while we are thinking everything is happening through digital penetration is increasing, but what we have also seen is research online, purchase offline still continues. That could be the reason last year India saw highest number of bank branches being opened. We kept talking of, it's a digital banking, but last year India saw highest number of bank branches, so which means investors still want both.
They want a touch point, a physical touch point as well.
So I'm saying both will play a very, very important role, and we are in very interesting times ahead over the next decade or so, where both will play a role. There will be people who want only digital, there will be people who want only physical, and there will be people like us, many of us, who will say, I'll research a lot of things online, but I may still want to go, physical.
Okay. Mr. Chalsani, your thoughts on the role of fintechs and the increasing DIY approach?
See, as Mr. Sandeep rightly talked about the way in which investors are looking at it, it's fintechs are going to help us. They need to be a part of the entire ecosystem. DIY is something where the more and more transactions are happening to that. But the fact remains that there is a need for us to have a channel, because today as we speak now, we are looking to grow on B30, that is beyond these top 30 cities. And for that, we need an important channel, that is what we have, a distributor channel. And that's where we are entire focus upon, so that people will understand what the goals are, what the risks that are there, and then ultimately invest. So it's a parallel run, both DIY and the physical communication of the products that are there.
So as we're coming down to the
DIY thing, I'll only say, Surabhi, I think it's very critical, for investors to understand. I think whether it's fintech, whether it's distributor, whether I think there's a direct websites of mutual funds, I mean, all these are expressways, how you reach the capital markets. But I think all of us have a day job. I think DIY, do it yourself looks very fancy. But I think when you go back to your day job, I think you have to focus there. And investing is a full-time thing.
Absolutely.
So it cannot be done thinking, and to see something on the screen and think this looks exciting, then do it and forget it. So do it yourself is very good concept, but it's for a person who's very matured, who does not have a day job and whose day job is only investing in markets.
I couldn't agree more. I feel better about myself because while I talk about investing all the time, doing it is, I think it's a separate sort of...
so I hope so. All your allocations are in mutual funds.
Absolutely, absolutely. So final thoughts, Sandeep, 2026, what is your message to investors? And as the chairman of AMFI, what is going to be your main objective or your main goal for the year ahead?
I'll take the second question first. I think as AMFI chair, I think for us, I think one of the things that continues, in spite of the market doing well, industry doing well, I think we have to keep it simple for the investors. Whatever we do, the investors will be the center of our every strategy. The fact that I think we have the Nivesh Ka Sahi Kadam, in spite of the fact it's the mutual fund industry is at all-time high, the education will continue. That is one. And the advice to investors will be whether markets go up or markets go down, don't get carried away, keep your biases away. Investment, long-term wealth creation can happen with discipline, not by getting very emotional. And irrespective, whichever way the markets move in 26 or 27, 28, we don't know. We all sitting here, in spite of the best of portfolio managers, we don't know which way it will go. But direction is more important than speed.
Oh, absolutely. And the direction has been the right direction. That's what the last couple of years have really told us. Thank you so much, both of you. Mr. Chalasani, Sandeep, thank you for a great conversation. And we look forward to more such enlightening sessions as investors keep moving ahead on that super highway of investment and wealth creation. Thank you for joining us today.
Thank you. Thank you, Sabhi. Thank you.
Well, that's it on this episode. Thank you so much for being with us on this special conversation. Mutual funds continue to play a pivotal role in deepening financial participation. Thanks to our guests for this insightful conversation, and thanks to our viewers for watching.
Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with News 18 Network.
Hello and welcome to News Center. I'm Parikshit Luthra. Prime Minister Narendra Modi is on the final leg of his three-nation visit. He is in Oman to sign a free trade agreement, which is a part of a comprehensive economic partnership agreement, a broader pact covering the entire gamut of business relations, including tariffs on goods, services, regulatory changes, standards, intellectual property, and investment. The deal is expected to boost bilateral trade, create jobs, and deepen the India-Oman strategic partnership across sectors, including trade, investment, energy, defense, technology, and people-to-people ties. Bilateral trade between the two countries stands at around $9 billion, with strong two-way investment flows. There are over 6,000 India-Oman joint ventures in Oman, with investments exceeding $7.5 billion. FDI inflows from Oman to India between April to June 2024, that is in the last 24 years, stand at nearly $600 million. This will be Oman's second FTA within individual country and its first in over 2 decades. For India, it will be the second trade agreement signed this year. Prime Minister Modi called this trade deal historic. He added, this will boost trade and give a new confidence to investments and open new doors to opportunities in every sector.
आज हम एक ऐसा ऐतिहासिक निर्णय ले रहे हैं जिसकी गूंज आने वाले कई दशकों तक सुनाई देगी। कॉम्प्रिहेंसिव इकोनॉमिक पार्टनरशिप एग्रीमेंट यानी सीपा हमारी पार्टनरशिप को 21st सेंचुरी में नया विश्वास, नई ऊर्जा से भर देगा। ये हमारे साझा भविष्य का ब्लूप्रिंट है।
All right, joining us right now is Abhimanyu Sharma, who has been tracking this FTA, speaking to officials on why this is important. Abhimanyu, tell us which export sectors get the benefit of this deal, and what about services?
India is looking to implement the trade pact with Oman by the first quarter of the next fiscal and is aiming for a 50% export rise in merchandise in the next 3 years. Government sources indicated that the CEPA will act as a template for FTA negotiations with the Gulf Cooperation Council. This is India's second FTA with a GCC member after the UAE, courtesy which downstream petrochemicals, dates and decorative marble would get cheaper in the Indian market, as more access would be given to Oman's exporters into the Indian market. Even as India is aiming to increase its exports of not just goods but even services into Oman's market, government sources also said that India had held on to its stand to exclude gold and silver bullion, petroleum products and non-ferrous metals out of the FTA to protect several local sensitivities, and India has placed 2,789 tariff lines in the exclusion list to protect interests of farmers, manufacturing competitiveness, and excluded goods like alcohol, tobacco, plantains and pork in view of social sensitivities on the other side. Also, Oman's Omanization policy to provide employment to local workers will not be changed to the detriment of Indian workers. That is what government sources indicated, that the FTA will mandate equal opportunities for workers from all SAARC countries, and regulatory fast-tracking for pharma exports will also provide an opportunity for growth in pharma exports as well as agri products as well as textiles. Oman's proximity to India has also been cited by government sources as one of the opportunity for co-location of industries and workers into several parts of Oman due to availability of land, which will allow for more industrialization and better ties between both the countries.
All right, to understand the significance of this deal and India's diversification strategy, we're joined by Cyient Dasgupta, former Indian ambassador to the WTO, and international trade expert Abhijit Das. He's also the former head of Center for WTO Studies. Thank you very much for being with us on the show today. Cyient Dasgupta, if I were to ask you, 99% of India's exports to enter Oman duty-free. Currently, the overall trade between the two countries is $10 billion US. It's in favor of Oman. How do you think India stands to benefit? This FTA will be operationalized fairly soon.
The goods trade, of course, is not very high. I think, as you showed in your figures, it is just around $10 billion or so. Oman exported about $6 billion, of which the three main products were petroleum and gas and fertilizers. And as far as India is concerned, it was basically naphtha, petroleum, refined petroleum that is, and machinery items, iron and steel, etc. So I think for the labor intensive sector like textiles and clothing, like leather footwear and leather garments and other leather products, I think there is going to be a very good scope for increasing our exports to Oman. And more importantly, the flow of FDI has been rather limited, just around 600 million, over $600 million from India to Oman, and a similar figure for Oman to India in 24 years. So with the signing of the comprehensive agreement, hopefully India will see a lot more of Omani's investments in India. Already there are about 6,000 joint ventures which are working India-Oman joint ventures. But I think there would be a lot of capital infusion which is expected because of the SEPA.
All right. I'm going to come back to you, Mr. Dasgupta. Let me get in Abhijit Das as well. Abhijit Das, on the services commitments front, this is the first of its kind in any agreement with Oman. 127 subsectors will stand to benefit. Enhanced mobility for high-quality temporary workers. Stay commitments for intra-corporate transferees have been increased. Contractual service suppliers, even for them, the opportunities are going to increase under the new SEPA as well. How do you think this helps our services exports to Oman?
First and foremost, we need to realize that Indian service providers have already been fairly active in Oman. So to that extent, the incremental benefit will not be very significant. But having said that, with the Omanese economy set to expand quite significantly in the coming few years, India would become well positioned to meet the demand for services as and when the Omanese economy starts to grow. So that is what will really provide the opportunity. To cut a long story short, our services export growth will really be determined by the rate at which the Oman economy expands.
Right. The SEPA also opens up opportunities for 100% FDI investments in Oman by Indian companies. Mr. Dasgupta, how do you think this will help the Indian businesses looking to diversify, enter the Omani market, and why is this important?
There are several factors, I think, which would enable Indian investors to, reap the benefits of this SEPA. One of them is that Oman is a place where there is plentiful sunshine. So I think there are already companies which are into green hydrogen, which are exploring the possibility of joint ventures in Oman. And there are, I think, a few already which have been signed. So that is one aspect. The second thing is that Oman can be, because land is plentifully available, and Oman is looking for industrial production on a larger scale. So I think it could act as a springboard for accessing other countries in the GCC, the other 5 countries. Of course, India has already signed an FTA with the UAE. So Saudi Arabia and the other 3 countries, it could act as a springboard and benefit Indian investors in Oman.
All right. Now, in terms of setting the ground for FTAs with other GCC countries and a larger GCC agreement as well, how does this trade agreement really help us, Abhijit Das?
In 2 contrasting ways, in 2 opposing directions. One, of course, is on the positive side, our aspiration that with Oman already having given us FTA concessions, Oman will find it less difficult to give similar concessions in the FTA negotiations with GCC. So that is one aspect. But the second aspect is a much more practical dimension, and this is a problem. which India encountered in the FTA negotiations with ASEAN. Just to recall, in ASEAN, we already had a free trade agreement, SECA, with Singapore. Our expectation was that Singapore would support us in the FTA negotiations with ASEAN. That didn't happen for the very simple reason that Singapore would have partly lost the Indian market if the FTA with ASEAN were to be implemented. So I do apprehend something similar with Oman as well. Once the FTA with the GCC starts getting concluded, there could be an apprehension in Oman that the edge that Oman products enjoy in the Indian market because of the FTA with Oman, that edge could get a bit curtailed because of the FTA with GCC. And let's also remember that the production patterns in Oman and some of the other GCC countries might be very similar. So the adverse impact on Oman of the larger FTA with India under GCC umbrella could cause some apprehensions in Oman. So that's
all right, Mr. Das. Okay, Mr. Dasgupta. Now, in the last few years, we've seen India signing an FTA with United Kingdom, which is yet to come into effect. You've got the EFTA, which has come into effect this year. The Australia trade agreement is already in place, and we're now looking to make it a bigger agreement. You've got a CEPA with UAE. You've got a trade agreement with Mauritius. We're now restarting talks with Canada. Israel, talks with the US, talks with the European Union are on as well. How does Oman help us in increasing overall exports? If it's $10 billion currently, with this trade agreement in place, how do you expect rationally, practically, trade to increase on a year-to-year basis with Oman?
Well, Oman, the population is only about 50 lakhs. And the GDP is about $118 billion. So we can't expect, a very high growth rate from the $10 billion that we are already having by way of international trade, but two-way trade. So one of the major things about this CEPA is to have, stronger relationship, stronger bonds with Oman, and also have use it as a stepping stone to the GCC, which is a much larger market. Because Oman is, I think, one of the smaller markets of the, or if not the smallest, of the GCC. So that is the main thing. And, there are many benefits of co-production. If we are strategically, we make a choice of setting up certain industries for which we have the technology, we could have the labor, and the services agreement could also include, of course, skilled professionals would have much better access, but even for semi-skilled professionals, if that could take place, then it could act as an offshore destination for our exporters to co-produce and export from there. So that is a possibility which needs to be explored fully, because the contours of what will happen with the India-EU FTA and the India-US FTA, those things are not really known yet. So once those things fall into place, we can reap the benefits.
All right, I'll put my final question to Mr. Abhijit Das. Abhijit Das, do you believe this will allow for greater FDI into India as well? We've seen about $600 million flow in the last 25 years.
Honestly, I do not envisage any significant surge of FDI from Oman. Overall, my take on the agreement is that it might give some boost to our exports and investment, but not very significant. But the larger story is on the political front. The FTA will certainly deepen ties in other areas apart from trade, and that is the real significance of this agreement. And it's less about trade and investment.
All right, so when you say that it gives a bigger political message, if you had to amplify that, help us understand how it brings us closer to Oman, strategically and in terms of our relations with Gulf on a larger scale?
Yes. Oman has been viewed in the Gulf region as a country which really hasn't taken sides in the political turmoil, and it's viewed as an honest broker. So on some of the contentious issues, Oman has provided the venue, the platform for talks between contesting parties in the Gulf region. And once the FTA starts getting implemented, and given Oman's the evolving and increasing strategic significance in the Gulf region, that gives us some leverage.
All right. Thank you very much, Abhijit Das and Jayant Das Gupta for joining us on the program. We're taking a short break here on News Center. Lots more when we return. Now to all the action from Parliament. The government has agreed to refer the Securities Market Code Bill to a parliamentary panel. The bill seeks to rationalise 4 existing legislations governing SEBI, depositories and government securities into one single code. Opposition says the bill is against the principle of separation of powers. Finance Minister Nirmala Sitharaman said the bill will be referred to a standing committee for further vetting.
Gone through in detail the points which the members who are opposing the introduction of the bill. I think instead of going into details of each one of the objections, I would like to highlight the point that at this stage of introduction, we are only making the bill to be sent over to the standing committee to do a complete review of the bill.
And Sapna Das is standing by with more on the Securities Markets Code bill. Sapna, what does this bill entail and how will it change the landscape for the securities market?
Well, of course, it's important from many aspects, but a couple of issues that I think we should be able to highlight. One, of course, the first one deals with the fact that this new code also proposes transferring a substantial share of the SEBI's annual surplus to the central exchequer. That is basically the Consolidated Fund of India. So what the code is now proposing is, telling SEBI they have a general fund under which all the collections happen, like, money coming in from grants, fees, and we are also given to understand that this general fund of SEBI, it also earns interest, and via that a lot of other overhead expenses are taken care of. So in essence, SEBI does not have to really depend on the central government for seeking funds. Now what's going to happen is that the bill proposes to for SEBI to set up a separate reserve fund in which 25% of its annual surplus, which comes in the general reserve, in the general fund that they have, that will be transferred. The remaining 75% of the annual surplus that SEBI will have under its general fund, that will be apportioned to the Government of India. Basically, it will come into this Consolidated Fund of India. So that's, that's a bit of a red flag if you talk about it or think about it from the point of autonomy of the regulator. That's one aspect. Second, even in terms of investigation powers, if you look at the fine print of the code, it says very clearly that the investigation officers of SEBI will have to close a case within 180 days, which is basically 6 months. That was not the case so far. And in case they are not able to do that, or they don't have their investigation report ready, then they'll have to explain to the board the reasons for the delay and any kind of extension that they would like to seek. That's second. Third, the code also proposes that once a particular default or a contravention is over 8 years, well, the SEBI will not be able to investigate it. I mean, this is a bit surprising because you look at the fact that there are so many Ponzi schemes around, and for instance, you put money in a Ponzi scheme, so to say, and it matures in 7 to 8 odd years, and there is a requirement of an investigation. That will be difficult on the part of the market regulator. However, there is a small proviso here, provided an investigation agency refers the matter to SEBI, or if the regulator so decides that this could have a systemic impact on the securities market. Only then the investigation can be opened after 8 years, otherwise not.
All right. Thank you very much, Sapna, for those very important details. That bill was taken up in Parliament earlier today, and Sapna there outlining the important highlights. Let's move on. The air quality in Delhi remains hazardous, even as strict pollution control measures take effect starting today. Petrol pumps will not supply fuel to any vehicles that do not comply with the BS4 standard or above. 50% of government staff are working from home. Primary schools have switched to online classes. The pollution levels in adjoining cities like Faridabad, Noida and Gurugram is worse than Delhi and 30 times above standard levels. The Parliament was scheduled to debate air pollution today, but the Lok Sabha was adjourned after the bill to overhaul Manrega was passed. Let's move on. Indigo is facing a probe now from the Competition Commission of India following the mass cancellation of flights earlier this month. The CCI will probe complaints against the airline after the recent disruptions. Indigo commands a 60% market share when it comes to air traffic. The CCI says its probe will be in accordance with the Competition Act. This comes on a day when the Indigo CEO told his employees that the worst is behind the company. Peter Elbers also said that operations have stabilized and 2,200 daily flights have been restored.
What we witnessed seems a compounding effect of several factors. Everyone wants answers. Speculations are circulating, but I encourage everyone, please stay calm, focus on your professional responsibilities and avoid engaging in such speculations. We need a full-scale analysis.
Indigo CEO Peter Elbers has reached out to the employees after the airline's recent operational disruptions, saying that the worst is behind them. He has urged staff to avoid speculation, stay focused on professional responsibilities, and said that the leadership team will travel across the network to meet teams on the ground, hear feedback and assess challenges firsthand. Now, this message comes at a defining moment for the airline. According to DGCA data, Indigo has overtaken the Air India group in terms of international passenger traffic. In the July to September 2025 quarter, Indigo carried around 41.4 lakh international passengers, marginally ahead of Air India Group's 41 lakh passengers. In the January to March quarter, remember, Air India Group was firmly in the lead, flying 45.5 lakh passengers compared to Indigo's 39.3 lakh. That gap narrowed in April to June, and by July to September, Indigo has moved ahead of the Air India Group. This shift also follows the June 12th crash of Air India flight AI-171, after which Air India cut international capacity by around 15%, particularly on long-haul routes, amid safety reviews and a brief dip in passenger confidence. Indigo, meanwhile, maintained capacity and frequencies on key international routes, allowing it to capture a larger share of the traffic. Now, even now, Air India Group operates a wider international network, 48 overseas destinations versus Indigo's 44. But let's see if Indigo is able to sustain the lead.
Thanks, Shivani, for joining us with that update. With that, it's a wrap on this edition of News Center. More news updates continue right here.
Welcome to our series Outlook 2026. India had a Goldilocks 2025 with growth likely to be at 7.5% and inflation at 2%. And yet the rupee struggled and Indian stock indexes were underperformers compared to the US and to North Asia in particular. How will 2026 pan out? Joining me now is Neelkant Mishra, the Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkant, good morning and thank you very much indeed for joining us.
Thank you, Lata, for having me.
Well, for starters, the bright number that shines from your report is your forecast of 7.5% GDP growth for FY27. Now, I'm doing a poll of economists, and my poll is throwing up a number, likely number, it's still work in progress, between 6.9 and 7. That's where everyone is averaging. And the fears is that the fisc cannot stimulate as much. The incremental fiscal support will be less, and the GST cuts and income tax cuts are over. Incremental support won't come from them, and therefore you can't repeat a 7.5. That's the impression I got. Your thoughts, why 7.5?
Yeah, so I will start with what I've been repeating, and I'm quite surprised and shocked that economists can still see a stimulus in FY26. This is this fiscal year. See, the way I see the Indian economy is that in FY25 you had simultaneous fiscal and monetary tightening. The fiscal tightening was explicit 80 basis points, and on top of that, there was another 50 basis points where the government collected GST compensation cess, but was retiring some off-balance sheet debt. There was 130 basis points of fiscal consolidation in FY25, the last fiscal year. And on top of that, because of the letters sent to some of the large private banks, credit growth slowed very sharply. And that itself was equivalent to more than 2% of GDP worth of monetary tightening. So if credit growth slows, obviously GDP growth will slow as well. So the economy delivered 6.5% despite significant fiscal and monetary tightening. In FY26, I think, again, I'll reiterate, I've been saying this from budget day, that the tax cuts were not a fiscal stimulus. The government was still bringing down its fiscal deficit. That is simple macroeconomics, that 4.8 going to 4.4 means that the government is a drag on incremental demand, on aggregate demand. And therefore, the economy this year, till the time that the GST cuts happened, which actually kind of neutralized some of this tightening, the economy was still facing headwinds on the fiscal side. On the monetary side, at least, the incremental headwinds faded. So it's almost like, if it's like a maybe class 3 maths, that if an aircraft is on the ground speed is 700 kilometers an hour, and there are headwinds of 250 kilometers an hour, if the headwinds fade to 100 kilometers an hour, what will the aircraft fly at and on the ground? And that's exactly what has happened this year. So the growth surprise for many people was not something that was a surprise to us. We expected that as the headwinds ease, the trend growth will start showing up. FY27, the fiscal becomes even less of a drag. So this whole narrative that, the government doesn't have fiscal space has been true for the last 5 years. In fact, the pace of fiscal consolidation is now slowing. So now you have, we are forecasting 4.2, but let's see what the government throws up in the budget. So only 20 basis points versus the 40 basis points that happened in FY26. And the monetary, all the easing of conditions, the fact that there is now a firm vision or message from the central bank, I think credit growth is starting to revive. That can become a tailwind. So we can run the economy above trend for a while, and that is why we are at 7.5%.
Okay. Well, fair enough. Let me come to earnings. Time permitting, I'll get back to the macros of inflation, etc. later. But earnings has been our bugbear. Do you think we are going to get to high single digits or double digits? And what gives you that confidence?
So both macro and micro. So you have the 12-month forward earnings, which frankly is what matters. So you had a very nicely upward sloping curve, and then the last 12 months it has flatlined. Because whatever you gained from the roll forward, you gave up by the pace of cuts. So you're seeing like 3% plus cuts every quarter in index EPS. Our expectation is that as GDP growth stops disappointing, because many of these trend indicators were below what was expected in terms of momentum earlier, especially on large sectors like autos and financials. And so once this starts to revive, the pace of cuts will start to slow. And therefore, the 12-month forward earnings then resumes its upward climb. And our forecast published in the report is that the 12-month forward is likely to rise by about 14% in the calendar year, CY26. The second approach to that is to look at assumptions sector by sector. So there are 4 sectors which account for nearly 2/3 of index EPS, which is financials, IT, industrials, and energy. And in all these 4, the assumptions look reasonable. I don't want to bore you with all the details, but the gist is that the CY26, and therefore, and you're absolutely right, if the 12-month forward earnings start to climb, our weights in passive indices start to go up, our market either becomes cheaper or starts to climb, and then FII flows start coming back, and a lot of other factors then start to stabilize.
Okay, well, that's exactly what I was coming to. The other, a problem for the market has been this shunning of FIIs for 2 years in a row. We had a minus $15 billion, an outflow in 24, calendar 24. Calendar 25 is almost $17 billion to date. Do you see them returning? Will the earnings growth be strong enough to attract them? Or, will they still look for AI plays?
Yeah, so that's uncertain. So whether, the AI winners, China, Taiwan, Korea, there will be disappointment. There are now questions being raised on some of the viability of some of the largest AI firms in the US. The viability meaning competitiveness of the largest AI firms. So there will be, I think, questions. There is a lot of competition coming in. Will that affect profitability? So that decision is clearly we'll have to take as data comes in. But in terms of FII flows, remember that there are 2 aspects to it, not just one. The first and the more important one is that the financial plumbing in global markets is such that a lot of FII flows come through EM funds and Asia funds into India. And that neighborhood is not that good. So while China and Korea and Taiwan have done well, there are Indonesia, Philippines, Argentina, Russia, South Africa, Turkey, Mexico even. So there are many of these markets which don't have really great prospects or have had political turbulence. And therefore, EMs as an asset class has not attracted as much flows, same with Asia. So that is a very important part of the puzzle. When those flows resume is a very important factor, a contributor to how quickly FII flows come to India. The second aspect to this is, of course, the relative weighting. And here again, there are 2 aspects, two contributors. The first is because India's 12-month forward earnings were the worst performing among all major markets, we had the Indian weight or the weight of India in most benchmarks coming down by 15-20%. And that meant that all the passive funds had to take money out. As the weight starts to climb, those passive funds will bring, that's almost algorithmic. The AI winner versus AI loser trade, and I think most investors had kind of forgotten that India was going through significant amount of monetary and fiscal tightening at the same time. But I think that realization as it dawns that the economy is actually, the underlying trend growth is much better, at least on the relative weight perspective, at least the pace of outflows should start to slow. But strong inflows may only emerge once the EM and Asia asset classes start attracting flows.
No, I agree. While the stock market may find its rally getting postponed because of the lack of FPI flows, it still has domestic flows. For the rupee, it's a problem because the current account deficit in India has always been plugged by the capital flows and largely FPI, FDI capital flows. So the rupee can become self-fulfilling. If it keeps falling, people stay away, FPIs stay away because they may get it cheaper. Do you see this? How do you see the rupee in 2026?
Yeah, so I expect that the pressures of the central bank having to sell or actually taking delivery on all the forward shorts they have will be a lot lower next year. So the balance of payments should be supported by, say, for example, the inclusion in the global bonds index, the Bloomberg Aggregate Bonds Index, $18 to $25 billion. The likelihood is reasonably strong. I mean, how quickly those flows come in, time will tell, but that should improve expectations. The fact that services growth continue to be quite strong, so contrary to all the fears around the visa fiasco and all of that, we are starting to see quite a bit of FDI happen. So the global tech majors are so even before the trade deal is signed, they are showing how the winds are moving. So we have seen three of the largest tech majors collectively announce $70 billion of investment with a timeline, 4 to 5 years. We are also seeing a complete beeline for Indian financial assets. So as the regulator has shown its comfort in having more foreign participants, or at least partly foreign ownership of the Indian financial system, you are seeing strategic investors. So none of them are, herd behavior, momentum chasers. So they're coming in for the long haul. So if that is how the strategic investors are viewing India, I think it is a matter of time before the portfolio investors also come in.
Thanks much, Neelkant. I hope it pans out that way. Well, we need to take a break on that, and thereafter we will hear out Citi India's outlook on 2026 from their economist, Samiran Chakrabarti. Welcome back to Outlook 2026. Joining me now is Citi India's chief economist, Samiran Chakrabarti. Samiran, thank you very much for your time. Let me start with the growth inflation question. India had a Goldilocks scenario in 2025 with growth coming above 7%, inflation way below 4%. Will this be the scenario in 2026 as well?
This particular two numbers that you have said about the 7% and 4% higher growth being higher than 7% and inflation being lower than 4%, both things can continue in 2026 as well. However, just incrementally, it looks to us that the next year's growth will be a tad weaker than the current year's growth, and next year's inflation would be slightly higher than this year's inflation. On growth, the main argument is that the most of the stimulus, both from the fiscal and monetary side, has been done this year itself. So next year, with the space of stimulus coming off, even if the global headwinds recede a bit, it might be difficult to repeat the same performance as in 2025. On inflation, the primary argument is mean reversion of some of the inflation momentum, as well as the base effect kicking in next year. These two things would imply that we'll probably be inching up on inflation, but I don't see next year inflation being such a concern which will prompt any sort of policy tightening pressures.
Okay. But you know, the Reserve Bank has started on the note of being higher and then lowering, which is what they did for a better part of this year. They started the FY26 number with 3.7, then came down to 3.1, then 2.6, and now standing at 2. It was a serious revision down, and they have begun that process for the next year. For April, May, June, their first forecast was 4.9. It came down to 4.5, and now they are at 3.9. So can we see that revision lower as well? At the moment, they are averaging a little below 4. If the trend continues, it should be way below 4, isn't it?
So if you decompose this forecast revision for the current year, we started off with 3.8 and we are now at 2%. So this 180 basis points of inflation forecast revision that we have done, about 100 basis point is because of vegetable prices, 40 basis point is because of non-vegetable other food prices, and 40 basis point is because of core inflation, which is primarily due to the GST cut. So it's not that the fundamental trend inflation forecast has gone very different through the course of the year. It has been these idiosyncratic factors which has caused this massive revision in inflation this year. And next year's we are seeing is partly this momentum just being passed on for the first couple of quarters. But I suspect that we might not be as lucky to get all stars aligning the way it aligned this year for next year's as well. We'll have to be very lucky for that. We have to have another year of such benign vegetable price inflation. We have to have another year of China deflation impacting us positively on the inflation side, and another year of maybe another rate of GST cut. Can all of this happen together to have inflation to be even lower than what we are projecting now? I think that probability is a much smaller one right now.
You kind of answered my next question, which is that are you seeing a structural fall in inflation? Are we not anymore even a 4% inflation country? We are probably a 3.5 or 3 to 3.5% economy.
That's a fair question to ask and debate and do more research on, because clearly now, almost 2.5 years, we have got extremely benign core inflation numbers, closer to 3% or so. So at least on the core inflation side, there's comfort that this is not just a 2025 phenomenon. It has been continuing for a while now. But clearly, we always see food prices creating sort of a volatility around this core inflation number. And we've been lucky that this year the food inflation has been significantly lower than core inflation, which has dragged down the overall headline inflation number. But even on core inflation, I think the question that we are all grappling with is that to what extent this is because of improved supply versus lack of demand.
That's the point.
I think that's the debate that we'll have to settle as we move into next year. We're going to have a new CPI series, maybe that throws up a better set of quality of inflation numbers as well, which will give us some clarity on this very important question that how much of this decline in core inflation is supply side versus demand side.
Okay, no, for the GDP picture also we need the inflation numbers right, because while we may have grown well this year, a large part of the extraordinary surprise in GDP has come because the deflator is low. So, that's why I was dwelling so much on the inflation number. Time permitting, I'll come back to GDP. Let me first get the rupee issue out of the way. The shock of this year, despite a strong GDP growth, has been the fall of the rupee. Do we repeat an average 3% fall next year?
So What has happened is that the current rupee level is very difficult to explain from the standard valuation matrix that we have tracked in the past, like the 40-country RER and all. So rupee is significantly undervalued on those metrics. Now, typically, the economists start of the year thinking of rupee depreciation vis-a-vis the inflation differential. This year, the rupee has not moved at all in line with the inflation differential because India's inflation was significantly lower than global inflation. So by that logic, rupee should have appreciated rather than depreciated. So this is a very peculiar year where the rupee has followed more the BOP than the inflation differential. And this is an unprecedented thing that after 1991, for the first time, India is likely to witness 2 consecutive years of BOP deficit. And that has put pressure on rupee. So our view is that as we move into 2026, in the first quarter, the Jan-March quarter itself, there's a possibility that the BOP turns into surplus, partly because current accounts is seasonally stronger in that quarter, and partly because we expect some capital flows to also come back. Now, if that works out according to our expectations, then there's a possibility that the RBI can put some floor on this rupee depreciation, and we could see some even appreciation bias coming in at that point of time. If that holds up, then possibly next year, when we are again expecting BOP surplus, then the inflation differential comes back into play. And because rupee has depreciated much more than inflation differential in 2025, we could see even a catch-up next year where rupee does not depreciate as much as other countries that year. So we are looking at a 9 to 12 month target of around 91 on the currency, knowing fully well that this is not to say that rupee will never breach 91. It's more to say that where a more stable equilibrium would be reached is around that level. This is now a much more volatile currency, so there is always, this path could be a very choppy one too.
Yeah. You know, your Outlook 26 also includes the stock market guesses in your last part of the report, and you're guessing that the foreign investor is going to return, but I'll reserve that for your equity team. Let me get to bonds. You have a very interesting chart of, you know, how much of bond issuances you are expecting, state government and central government in the in FY27, and then you're comparing it to FY26 and pre-COVID. If you look at the level of pre-COVID bond issuance, it is about 10 lakh crore. And next year, you're saying that state and center will issue over 30 lakh crore. I mean, is there not going to be, whether or whatever the Reserve Bank does to interest rates, it looks like there is going to be an upward pressure on the 10-year.
Yeah, so this is the sort of macro challenge for India, that while growth inflation balance, as we started off this discussion with, that it's a Goldilocks situation for India. The challenge is that the fiscal and the BOP, the two balances, they are more difficult going forward. We have been getting enough demand to sustain this supply in the last few years with some help from the RBI OMO demand. But as we move forward, the redemption pressure is also increasing quite substantially. So the need for RBI to support this bond market will be even more, especially because we are now coming very close to the end of the rate cutting cycle. So obviously for different actors, their appetite to hold on to these bonds is, or buy new bonds, is going to be that much lesser as we come closer to this. So some widening of the term premium at the end of the rate cutting cycle is just but natural. The only question is that at what level of widening of that term premium RBI would think that the relatively easier monetary policy to support growth is getting challenged. And to that extent, they will have to do OMO to support this. Last year, we've also done almost a 6 trillion rupees of OMO. That's while we are comparing the 10 trillion supply with the 30 trillion supply, we have to also say that we have never seen a 6 trillion a year OMO from RBI. So that trend, I suspect, would have to continue if this bond market has to be supported.
Okay. Well, this year the RBI supported liquidity by buying dollars till their face was blue. Next year, probably they will buy government bonds, in huge quantities, probably in unprecedented quantities, to keep the liquidity going. Out of time, Samiran, thank you very much. With the news that we may continue with our Goldilocks scenario. Higher than expected growth, lower than average inflation. Wrap up on this Outlook 2026 series.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the Sensex and the Nifty end in the red for the fourth day. Mid-caps buck the trend. The rupee regains some lost ground against the dollar but remains above the 90 mark. Shares of asset management companies rally after SEBI's mutual fund cost overhaul were less stringent than expected. Brokerage fee also cut by half. The street does not expect any major hit to profitability of AMCs. The Lok Sabha passes the new legislation to overhaul the Rural Employment Guarantee Scheme and opposition parties protest. The bill increases the number of work days to 125, but states will need to share 40% of the overall cost. The government agrees to refer the Securities Market Code Bill to a parliamentary panel. The bill seeks to rationalize 4 existing legislations governing SEBI, depositories and government securities into one single code. The opposition says the bill is against the principle of separation of powers. The Competition Commission of India launches a probe into Indigo after the mass cancellations of flights earlier this month. This comes on a day when the Indigo CEO told staff that the worst is behind the company. The airline is back to operating 2,200 flights a day. Ola Electric shares hit a record low. The founder and CEO Bhavish Agarwal dilutes his stake worth 234 crore rupees in 2 days. The company calls it a planned one-time sale to settle promoter debt worth 260 crore rupees. Mutual funds have been reducing their stake in Ola for more than a year, but the retail investor holding has doubled in the same period. India and Oman sign a free trade agreement. The Prime Minister calls it a major step in deepening ties with the Gulf region. India's annual exports to Oman stand at nearly $4 billion. The government's top auditor issues a warning on direct benefit transfer schemes. The CAG says thousands of crores are flowing into beneficiary accounts without mandatory checks, blames weak data integration and government departments working in silos. The air quality in Delhi remains hazardous even as strict pollution control measures take effect. The pollution levels in adjoining cities like Faridabad, Noida and Gurugram worse than Delhi and 30 times above standard levels. President Trump defends his handling of the economy and the tariff onslaught, announces a new warrior dividend for active military personnel and claims it will be paid with revenue from tariffs. Well, let's start with the day's market action. The Sensex and the Nifty declined for the 4th day, but the losses were marginal at close. The mid-caps did, of course, manage to outperform the blue chips with the index ending in the green. So the mid-cap index up 200 points, Nifty flat, the Sensex as flat as it can be, and so similar story playing out for the Nifty Bank. But from the equity market to the currency market, the rupee has regained some lost ground against the dollar, but it remains above the 90 mark. It is the worst performing currency in Asia. Foreign fund outflows and uncertainty over the US trade deal continue to weigh on sentiment. 90.24 is the dollar rupee. In the commodity market, crude oil prices increased after President Trump's blockade of sanctioned tankers coming in and out of Venezuela. Oil prices rose over the $60 barrel mark after nearing 4-year lows in the previous session. Traders are keenly watching for a potential peace agreement in Ukraine, which is expected to bring Russian crude supply back to the market. Bitcoin prices surging surprisingly, in fact, nearly $3,000 in just 1 hour, reclaiming the $90,000 mark before profit booking pulled prices down to $86,900 within minutes. Now, this rapid move triggered $200 million in long liquidations within an hour, shaking the broader crypto market and pushing most major tokens lower. The volatility has revived near-term downside risks for the sector, so extremely sharp moves being seen there in the crypto market. Stocks of asset management companies rallying in trade after the market regulator SEBI revised the total expense ratios for mutual funds by excluding statutory dues from the equation. Sonal is standing by with what brokerages make of the move and how this is likely to impact the industry. Sonal, less severe than what the industry was bracing itself for?
Well, that's right. The final total expense ratio slabs which are announced by SEBI have come in as a relief because the cut is lower than what was proposed in the consultation paper in the month of October. In fact, if we take you through the numbers, excluding brokerage, these slabs are actually 5 basis points higher than what was proposed in the consultation paper. Brokerage expense ratios, they are now cut by 10 basis points. The expectation was that they could be cut by 15 basis points. So this has come in as a relief for the AMC industry and for brokers as well. But what are brokerages making of this move? They say this is largely neutral to positive for AMCs and brokers as well, because the market was fearing there could be a bigger cut in total expense ratio. For instance, Morgan Stanley says there is a relief which has come in terms of GST and commissions, which was estimated at 11 to 12 basis points, but the final number gives a relief of around 1 to 2 basis points. This particular relief offsets the 5 basis points impact from exit load removal, and this would mean a 3 to 3.5 basis points impact impact on large AMCs. But yes, it will not have a big impact on their profitability. AMCs are expected to pass through 60 to 70% of the impact to distributors, so the net impact could be even lower to around 1 to 1.5 basis points. This will equal to around 4% of their operating profit and around 3.5% of their FY25 profit before tax, but not as big as the industry was fearing earlier. Jeffrey says this is a relief versus what was expected. The 5 basis points exit load cut on equity AUM that remains now, this is a relief as well. Brokerage cap has been reduced to 6 basis points, excluding levies, versus proposed 2 basis points. So that is also something that the street seems to like. But the net impact of changes are expected at around 3 to 5 basis points of equity AUM, and AMCs may partially share it across the ecosystem, something like distributors. So it could be more negative for the distributors than AMCs itself. Overall, their view remains positive for AMCs, brokers, and RTAs as well.
No, I think it will adversely impact both the funds and the brokers as well. And again, obviously mutual funds can't, even the large mutual funds can't hire the kind of analysts which many of the brokers have. You have people who spend their entire lives just looking at infrastructure or just looking at transport industries. If mutual funds start hiring those kind of specialists, they'll have a research team of 100 people.
Well, the reactions there coming into SEBI's decision. Now all the action from Parliament. The government has agreed to refer the Securities Market Code Bill to a parliamentary panel. The bill seeks to rationalise 4 existing legislations governing SEBI, depositories and government securities into a single code. Opposition parties say the bill is against the principle of separation of powers. The Finance Minister said the bill will be referred to a standing committee for further vetting.
Gone through in detail the points which the members who are opposing the introduction of the bill. I think instead of going into details of each one of the objections, I would like to highlight the point that at this stage of introduction, we are only making the bill to be sent over to the standing committee to do a complete review of it, the bill.
Well, that's the Finance Minister. Now, the government did not relent to the opposition's demands to send the bill to overhaul the Rural Employment Guarantee Scheme to a parliamentary panel. The Lok Sabha passed the bill today amidst opposition protests. Copies of the bill were torn on the floor of the parliament, and the House was adjourned immediately after the bill's passage. The new bill, the Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin, mandates an increase in guaranteed employment days to 125 days from the current 100 days. The legislation also proposes a higher financial burden for most state governments. At present, the centre bears 100% of unskilled labour costs and 75% of material costs. Under the new framework, 40% of the total costs will be borne by all major states. The bill also seeks to alter the process of budget allocation. The central government will provide a fixed allocation and states will lose the flexibility that they currently have to propose budgets based on anticipated demand. Opposition lawmakers have also questioned the decision of the government to rename the bill by dropping Mahatma Gandhi's name. Air quality in Delhi remains hazardous even as the strict pollution control measures come into effect starting today. Petrol pumps will not be able to supply fuel to any vehicles that do not comply with the BS4 standard or above. 50% of government staff are working from home. Primary schools have switched to online classes. The pollution levels in adjoining cities like Faridabad, Noida and Gurugram far worse than Delhi and 30 times above standard levels. The Parliament was scheduled to debate air pollution today, but the Lok Sabha was adjourned after the bill to overhaul the MGNREGA was passed. Now, Indigo is facing a probe from the Competition Commission of India following the mass cancellations of flights earlier this month. The CCI will probe the complaint against the airline after the recent disruptions. Indigo commands an over 60% market share when it comes to air traffic in India. The CCI says its probe will be in accordance with the Competition Act. Now, this comes on a day when the Indigo CEO told employees that the worst is behind the company. Peter Elbers also said that operations had stabilized and that 2,200 daily flights have now been restored.
What we witnessed seems a compounding effect of several factors. Everyone wants answers. Speculations are circulating, but I encourage everyone, please stay calm, focus on your professional responsibilities and avoid engaging in such speculations. We need a full-scale analysis
Indigo CEO Peter Elbers has reached out to the employees after the airline's recent operational disruptions, saying that the worst is behind them. He has urged staff to avoid speculation, stay focused on professional responsibilities, and said that the leadership team will travel across the network to meet teams on the ground, hear feedback, and assess challenges firsthand. Now, this message comes at a defining moment for the airline. According to DGCA data, Indigo has overtaken the Air India group in terms of international passenger traffic. In the July to September 2025 quarter, Indigo carried around 41.4 lakh international passengers, marginally ahead of Air India Group's 41 lakh passengers. In the January to March quarter, remember, Air India Group was firmly in the lead, flying 45.5 lakh passengers compared to Indigo's 39.3 lakh. That gap narrowed in April to June, and by July to September, Indigo has moved ahead of the Air India Group. This shift also follows the June 12th crash of Air India flight AI-171, after which Air India cut international capacity by around 15%, particularly on long-haul routes, amid safety reviews and a brief dip in passenger confidence. Indigo, meanwhile, maintained capacity and frequencies on key international routes, allowing it to capture a larger share of the traffic. Now, even now, Air India Group operates a wider international network, 48 overseas destinations versus Indigo's 44. But let's see if Indigo is able to sustain the lead.
Shivani, many thanks for joining us. Ola Electric shares hitting a new low after its founder and CEO Bhavish Aggarwal sold shares for 2 straight sessions. Aggarwal diluted stake worth 234 crore rupees with the firm, calling it a planned one-time sale to settle promoter debt. While mutual funds have been reducing stake in Ola for over a year, retail investors' holding has in fact doubled. Hormuz is standing by with the details. Hormuz, the stock hitting a record low.
Another day, another low for Ola Electric, and the price action over the last 3 days would tell you that something was brewing, because the stock was down almost 8% on Monday, fell another 4.5% yesterday, and then another 5% in today's trade as well. Now, what has happened is, now from the IPO price, the stock is down over 55%, and from the post-listing high, which is 157 rupees, the stock is down almost 80% from those levels. Now, what had happened yesterday was the fact that Bhavish Aggarwal's announcement of selling another 4 crore shares. This was in addition to the 2+ crore shares that he had sold on Tuesday as well. So that took the count to around 7 crore shares worth almost 234 crore rupees. What Ola Electric said in its earlier statement, that it was a planned one-time sale to reduce promoter debt, and the overhang of pledged shares would be over after this. And what sources are now saying is that this was intended to be done in tranches and not in one single block. Now, it's been 5 quarters since Ola Electric has been listed, and in those 5 quarters, 5 full quarters at least, the returns have been negative in 4 of them, including the stock almost halving in this very quarter itself. Now, if you take a look at the September 24 shareholding pattern, the number of retail shareholders was around 14 lakh with almost 8% stake. That number as of September this year is 19 lakh shares with almost 17% stake in the company. Now, for mutual funds, they have been reducing their stake over the last 3 quarters, barring this one where they increased their stake from just over 2.5% to over 5.5%. A couple of prominent names being part of this as well. So the next big trigger for Ola Electric now emerges is whether there is any further sale that comes in from Bhavish Aggarwal. The 3rd quarter results will be important to watch, because the company has already cut its revenue and margin guidance for the full year. So it promises to be a bumpy ride ahead for Ola Electric.
Well, many thanks, Hormuz, for joining us. That's Ola Electric. Now, shares of Sun Pharma down in trade after a setback from the U.S. drug regulator. The U.S. FDA has classified the company's plant in Gujarat as official action indicated. U.S. officials had inspected the plant in September, and it is one of the most important facilities for Sun Pharma to manufacture complex generics. The Ministry of Corporate Affairs has ordered a serious fraud investigation of its probe into IndusInd Bank. Sources say the investigation follows concerns flagged by the bank's auditors and the RBI, and it's linked to a derivatives reporting matter. The SFIO order was issued on the 12th of December with no details yet on the scope or the timeline. The CEO of IT major TCS says the company expects $1.5 billion in revenue through artificial intelligence this year. Kriti Vasan also said that AI projects accounted for nearly 5% of overall revenues. This is the first time TCS has reported its AI revenue, so that's a new one coming in. Remember, HCL Tech was the first to give a breakup of AI revenue. A week after a bumper debut, and Meesho's market cap has already crossed the 1 lakh crore rupee mark. Now, this makes the e-commerce giant more valuable than companies like Jindal Steel, Indian Hotels and United Spirits. The stock did see some profit booking today after touching fresh highs. The stock has more than doubled from its IPO price and is 45% higher from its listing price. Manglam joins us now. Manglam, take us through the key reasons for this kind of a runaway performance there for Meesho.
Well, it's a big move that we've seen on Meesho. In fact, just as we speak, the stock is up nearly 10%. 6 continuous days of a big move that we've seen on Meesho. There are multiple reasons why the stock saw a rally as well. The first part, obviously, post-listing, there were a lot of institutions that did not get allocation in the anchor book. The issue was fairly well subscribed. So those guys went ahead and bought. Secondly, there were a couple of brokerage notes that came by as well. And third, most important, there was very limited float available for the counter. So as a result of which the impact price or impact cost was a lot more. Just to put things into perspective, and these numbers change as we speak. The stock from its issue price has rallied a whopping 115%. And, we look at it post-listing as well. It listed at around 162, 162.5. If you look at it from there as well, the stock has seen a rally of nearly 45%. It's just 5 or 6 trading sessions. At IPO, the valuations were close to 5 times sales. Now it's moved all the way up to 11.5 times sales. The management has been speaking about generating and growing their free cash flow while improving contribution margins. But at some point, valuations will come to the fore because at the current market cap, upwards of 1 lakh crore, it's well above names like Jindal Steel, Indian Hotels, United Spirits, some companies like Havells and Dabur as well. For perspective, Meesho is a company that was founded just about 10 years ago and now has a market cap much above all these big listed companies too.
Manglam, many thanks. The government's top auditor issues a warning on the direct benefit transfer schemes. The CAG says thousands of crores are flowing into beneficiary accounts without the mandatory checks. That and more when we return. The government's top auditor has issued a warning on direct benefit transfer schemes. Speaking at an event in Nagpur, the Controller and Auditor General said thousands of crores are flowing into beneficiary accounts without the mandatory checks. He blamed weak data integration and government departments working in silos for the reason. Let's take a look.
There is a huge gap. We are saying that they're all Aadhaar-based linked beneficiary transfers. But the amount of deduplication or the amount of cross-database verifications that are mandated by the regular regulations of the DPT mission are still wanting. And there are thousands of crores going around into the system without these basic checks.
Well, that is the CAG on DBT accounts. The big news coming in from FTAs. India and Oman have signed a free trade agreement. Prime Minister Modi and the Sultan of Oman signed the deal in Muscat today. Prime Minister Modi, terming the deal as historic, said it will deepen the relationship with the Gulf region. India's annual exports to Oman stand at nearly $4 billion. The deal hopes to increase the export by 50% in the next 3 years. Government sources say this pact would act as a template for FTA talks with other Gulf countries. The prices of petrochemicals, dates, decorative marble and frankincense are set to get cheaper. However, gold, silver, bullion, along with petroleum products and non-ferrous metals have been kept out of the FTA. Here's the Prime Minister.
आज हम एक ऐसा ऐतिहासिक निर्णय ले रहे हैं जिसकी गूंज आने वाले कई दशकों तक सुनाई देगी। कॉम्प्रिहेंसिव इकोनॉमिक पार्टनरशिप एग्रीमेंट यानी सीपा हमारी पार्टनरशिप को 21st सेंचुरी में नया विश्वास, नई ऊर्जा से भर देगा। ये हमारे साझा भविष्य का ब्लूप्रिंट है।
Well, that is the Prime Minister on the India-Oman FTA. And before we wrap, after a whirlwind India tour of 4 cities in 3 days, football legend Lionel Messi and his Inter-Miami teammates Suarez and DePaul visited Vantara in Gujarat's Jamnagar. We leave you with images of Messi and his teammates spending their time at the Anant Ambani-led Wildlife Rescue Rehabilitation and Conservation Centre. From all of us here for now, many thanks for watching. say game on?
Yes, absolutely. Let's start playing.
When you talk about wanting to be India's Tencent, what does it mean exactly?
Our vision is to be India's Nazara, not India's Tencent. Nazara started, there was a dream that can a global gaming company come out of India, right?
Yeah.
This was 25 years back in 98, 99. I feel we are much closer to that today.
20 plus deals in the last few years?
Yeah, we can go out there, acquire companies that are potentially as large as what we are today. We are now looking at deals in the $100 million to $500 million range. From a global perspective, clearly AI is making waves everywhere. But I think the bigger change with AI is how consumers or players experience the games. There can't be a better time to start up in India, right? I'm talking to so many gaming companies globally who are listed on European markets, US markets, etc. And they would give a leg and an arm to come and list in India. Parents who are too strict, they're overdoing it. You don't need to spoon feed children. Today are very smart. In the early years, my mentor used to be Shammi Kapoor, the actor. He was one of the early internet pioneers in India.
Exactly, and not many people know that he was an avid gamer as well.
He was an avid gamer, avid, technologist on the internet.
Your de-stress mechanism is not gaming, right?
I like to play games, but I also like to play my saxophone.
He's built India's only publicly listed gaming company, not from a trend, but from a conviction that he held when he was all of 19. He founded Nazara Technologies in 1999, survived the dot-com bust with 3 crore rupees in debt, and spent the next 2 decades stitching together a global gaming and esports network that today spans 50-plus countries, with 80% of the revenues coming from international markets. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. From Kidopia in EdTech gaming to Nodwin in esports to global publishing and interactive entertainment, Nazara today spans the entire gaming value chain. It has delivered record growth, 175 times oversubscribed IPO, strong operating metrics across FY25 and FY26. And even after a 914 crore rupee impairment linked to real money gaming, the company has stayed resilient, expanding its global footprint and doubling down on IP creation, esports and AI-led content production. Now, with a refreshed brand identity and aggressive global publishing push, major investments in AI, Web3, VR and blockchain, and an ambitious target of 300 crore rupees in EBITDA by FY27, Nitesh Mithisen wants to build what he calls India's Tencent, a diversified gaming powerhouse creating games for the world. Nitesh, thanks very much for being back here on Young Turks. And can I say game on?
Yes, absolutely. Let's start playing.
So let's start playing. You know, Nitesh, 25 years of building this company. As I pointed out, the ambition and the aspiration that you've always had is of being India's Tencent. But let's look at the numbers. You know, about 10,000 crore rupees in market cap, 5.5 lakh crores for Tencent in terms of market cap, almost 750 million. I mean, there's no comparison in terms of revenue. So when you talk about wanting to be India's Tencent, what does it mean exactly?
Yes. To be honest, our vision is to be India's Nazara. Not India's Tencent per se. But you're right. I think it's taken, the market has evolved over many years, right? And while 25 years sounds like a very long period, the reality is when we started off, there weren't really mobile phones. The internet really didn't exist. Digital payments didn't exist. So it was a very immature ecosystem, I would say. It's taken a decade or more to get to a place where we can start growing. I think we're at a fantastic inflection point today. Nazara has a global brand presence in the gaming world. You know, companies all over the world, gaming companies all over the world recognize us, reach out to us, want to partner with us. So I think we have that foundation laid where we can start from here to much faster growth, much faster scale up. And I think that's what we have in our vision. What we did in the last 25 years, we are hoping to do in the next 3 years and then keep multiplying from there.
Okay, so what you did in the last 25 years, you're hoping to do in the next 3 years.
Yeah.
And I understand that,
Yeah.
you know, the ecosystem wasn't developed when you
Yes.
started, you know, mobile phones and so on and so forth. But what gives you the confidence that you're going to be able to replicate what you did in 25 years in the next 3 years?
Yeah, I think one is Nazara's brand establishment within the gaming industry globally. I think in the last 3-4 years especially after our IPO, I think that has happened very successfully. And what that does is opens up a lot of opportunities for us, especially our acquisition playbook that has also kind of matured over the last 7-8 years. Plus this brand establishment recognition globally allows us to kind of put both these things together and potentially acquire much larger companies going forward.
So acquisitions will continue to be the mainstay for you. You've done, what, 20 plus deals in the last few years?
Yeah, I'm not counting right now, but I think you will see acquisitions much larger than what we have done in the past.
Okay.
Start coming out pretty soon.
How soon is pretty soon?
26 for sure.
26 for sure. And when you say much larger acquisitions, what is the hope with these acquisitions? What is going to be driving M&A for you?
Yeah, I think our M&A thesis today globally is, especially with artificial intelligence really coming into our industry in a big way, is that you need to own high quality IP, gaming IP. This could be original IP, like we have already Animal Jam, Kidopia, or it could be licensed IP, like we have Big Brother, Traitors, Big Boss, etc. Right? IP is going to be a big differentiator.
Okay.
And products that have already kind of passed the consumer test. The 0 to 1 is already done. Consumers have showed love. Players really enjoy playing those games or those IPs. I think investing in them, acquiring them, and then scaling them up is where the large opportunity exists. That's a playbook Nazara has been following for many years.
Yes.
On a smaller scale, we've done transactions of 200 crores, 300 crores, learned our way around that. In the last year or so, last 2 years, we've also created these centers of excellence. Center of excellence in user acquisition, in data analytics, in AI, in monetization. So now we have this this platform on which we can buy much larger assets, much larger IPs, plug them into this Nazara platform and globally scale them. So I think that gives us a confidence that we can go out there, acquire companies that are potentially as large as what we are today.
Okay.
And you know, grow much faster.
If the acquisition appetite is going to be a lot more aggressive than we have previously seen, you talked about 200, 300 crore rupee deals. You're saying the size of the deals, the value is going to be much larger. You know, what kind of war chest are we talking about? How do you intend to fund these? And are these going to be gaming companies per se, or are they going to be in the allied spaces of AR, you know, AI and so on and so forth?
For now, our core focus is game studios that own IP, have reasonable scale, are profitable, generating good cash flow, right? Strong teams, of course. I think we are now looking at deals in the anywhere from, let's say, $100 million to $500 million range.
Okay. This has been a space that has captured headlines, especially in 2025, and for all the wrong reasons. There was a protracted court battle. The court battle, of course, is likely to continue, but there is a very clear signal from the government that real money gaming is over and done with, and that's seen companies having to close, companies having to pivot, whoever has possibly been able to pivot. Now, you weren't directly involved. You had picked up a 46% stake in Moonshine, which was pokerbazi essentially, and you've taken an impairment on account of that. Not a small impairment, over a 900 crore rupee impairment. But how do you see the dynamics of the industry changing now with real money gaming out of the window?
Yeah, there are multiple aspects here. I think specifically from a Nazara perspective, the whole idea for us is to build a diversified platform that generates cash, is profitable, and provides a lot of stability. On top of that, we are always open to taking moonshots. In this case, moonshine, right?
It was not quite the moonshot that we were hoping for.
Yeah, but moonshots are always come with some element of risk, right? And we obviously were, we calculated for that. And, you know, it didn't work out in the way it should. But the overall Nazara platform remains very stable. What that does is allows us in a disruptive market. Gaming usually is disruptive because of many reasons. Technology is changing continuously, right? consumer preferences keep changing with changing in technology, access of devices, new mediums, new formats. And regulatory uncertainty also tends to exist. So we build this diversified platform that is stable, cash-generating platform. And on top of it, we keep taking moonshots, which will allow us to get to the next orbit. Some will work, some will not.
Yeah.
We are ready for that, right? And that's why this is been taken into the denominator. We are moving forward, and we are very excited about 2026 and the way ahead. I think from a governmental perspective or the Indian gaming market, clearly over the last few years, last decade, I would say, what has monetized in a big way in India has been the real money gaming. Consumers loved it, or the consumers had an incentive to play it, but that's what really monetized. I think what has been required is clarity. What can be done, what can't be done, and for the overall gaming industry, not just the real money gaming part of it, right? I think there's some clear-cut clarity that has come, even if it's not in the favor of the real money gaming companies, etc., right? And I think similarly, if we can get more clarity on video gaming, on esports, and I think the new...
What clarity do you specifically need on video gaming as well as esports?
I think there are a lot of ways how do you monetize these games, how do you market these games, age gating, responsible gaming, right? There are a lot of aspects around gaming. We were discussing earlier, right? About privacy issues, protection of kids, because games have become really like social platforms where they can connect to a lot of people. So I think as this becomes larger and larger, these issues will emanate.
Is there a fear, because while we've now seen real money gaming, in a sense, a full stop being put there as far as real money gaming is concerned, but on some of the other issues, the government's approach was, let the industry self-regulate, let the industry kind of monitor, be vigilant and so on and so forth, whether it was responsible time spent on gaming apps and so on and so forth. Do you now feel that given the environment, it's likely to be not light touch, but much more kind of mandated what you are and what you're not allowed to do?
I think that is the direction that it is going towards, clearly, with the new law that has come in. And I think it's a good thing, to be honest, because it's better to upfront brainstorm with the industry and the government and all other stakeholders and come out with something that really works for the industry. I think for investors, because the Indian gaming industry has the opportunity over the next decade to make a global impact. For that, you're going to need to raise a lot of capital. Gaming companies should get funded. I think one thing investors really want is clarity. And especially after this whole real money gaming fiasco, people are very scared, right? Investors are very scared. So I think if clarity emerges, because otherwise what happens...
But for now, are you saying it's game over as far as investors are concerned for the gaming industry?
I think at this very particular point, there's obviously a lot of negative perception, right? A lot of global investors have burnt their fingers, rightly or wrongly, so I'm not commenting on that. But that's a fact, right? So I think people sitting outside don't really understand the nuances of the overall industry, what's happening. So I think there is a lot of negativity. That said, I think people also realize that India with 500 million plus gamers will eventually become a large market. And that's what Nazara is really trying to push globally as well. So I think investors will come, clarity will help. Otherwise, this self-regulation keeps happening and then suddenly there's a heavy-handed, decision. Then everything gets washed away. I would think much better everybody comes together, forms clear-cut regulations, and then the industry grows
complies with
grows on top of a solid foundation. I think that's what should happen.
I want to understand from you, what are the mega trends that you're seeing today in the market?
Yeah.
What are the trends that you're seeing in terms of demographics? What are the trends you're seeing in terms of time being spent on these gaming apps?
Yeah.
Social is a big aspect. AI in the user experience is a big aspect.
Yeah.
What will be the mega trends that will shape the gaming industry 2026 and beyond?
One thing that's really exciting about being in the gaming industry is that it's always exciting. Things are changing always, right? And it's very dynamic. I think today, as we stand at this vantage point, end of 2025, from a global perspective, clearly AI is making waves everywhere. And it's not leaving our industry untouched, right? How do you make games is transforming significantly through vibe coding, through how you generate graphics, creatives, game design, etc. But I think the bigger change with AI is how consumers or players experience the games.
Okay.
Now the games can really personalize themselves on the fly for each individual player, right? If there are 500 million players, a game can actually personalize for each individual. So it's a far more personalized one-on-one experience that can be built.
And how far are we from that being an eventuality?
I think a few months away.
A few months away.
I mean,
of that level of personalization.
There's a lot of work happening, but AI in itself is moving so fast, right? That what happens in a year really happens in a month now. The second mega trend is gaming as a social platform. You've already seen global breakouts like Fortnite or Roblox, where games are not really just games, but they're really your new social platforms, right? What a Facebook was is now happening on Fortnite. The third thing which a lot of people remain very pessimistic about, but I think with all new technologies, it goes through that curve of optimism, hype, pessimism, is virtual reality. Once you get into gaming in that virtual reality metaverse world, it's a 10x experience from what you think of gaming today. And I think that's coming.
But it's been a slow burner, right?
I mean,
the last few years we've all been talking about what the metaverse is going to do, and it really hasn't done very much.
Yeah. It's like any new technology. It's like electric vehicles, right? They've been around for 20 years, but now it hit an inflection point where it's all over, right? I think same way you will see with these technologies as these headsets compress or come into your eyewear or eyeglasses. It'll transform.
You started the company when you were 19, so it's been a long journey for you as well. As you look at what's happening in the startup ecosystem today, I mean, it's a very different world. But founders are also getting younger and younger. So, when you look at the 19-year-olds today who are starting up, how do you see how their lives are versus what your life used to be?
Yeah, I think it's a fantastic place to be today as a 19-year-old founder, right? Because the ecosystem has really developed. You have a large consumer base. You have digital payments in India, which are so great. You have a completely evolved investor ecosystem, right from angel funding all the way to IPO. So I think there can't be a better time to start up in India, right? As a 19-year-old or 45-year-old, it doesn't matter. So I think it's a great time. Of course, when I started, that ecosystem didn't exist. Probably too early even from a gaming industry perspective.
It wasn't even considered a sunrise sector when you started.
Exactly.
So who did you go to at in those moments of doubt and despair? Because there were moments where you could have gone belly up. The dot-com bust was one of those periods. Who did you go to? Who did you turn to for advice, for counsel, for just hand-holding?
I've always been lucky in my journey to have the right mentors at the right time, I would say. I think in those years, in the early years, my mentor used to be Shammi Kapoor, the actor. He was one of the early internet pioneers in India.
Exactly, and not many people know that he was an avid gamer as well.
He was an avid gamer, avid, technologist on the internet.
So how did you meet Shammi Kapoor?
I had invited him. I had invited him to my college to inaugurate a computer center. I still joke. I was 16 and he was 60, and we just struck this strange friendship. And he had these 5 or 6 Macintoshes in his home. And as a 16-year-old hobbyist, where would I get access to these PCs or these machines? So I would just bunk college and go to his home a couple of times a week and spend time with him. But he had a lot of ideas and thoughts on what the internet could do to entertainment, technology. I think he was one of the people that I really went to.
And way ahead of his time, and nobody really knows so much about this side of him. I mean, how did he get started on this tech journey?
I think what he really told me is he was a lot into smoking, and he kind of kicked the cigarette to pick up the mouse.
That's perhaps a good idea for many who are trying to kick the butt. That's a good strategy perhaps to put in place. So Shami Kapoor being one, who were some of the others that you turned to?
I think my own grandfather was a very eminent cardiologist, one of the few doctors who got the Padma Shri, Bhushan and Vibhushan. He used to be a go-to person for me. My parents, of course, were very supportive, always. Then I remember Sandeep Singhal of Westbridge, who invested in 2005. And he was with us all the way till I think 2018, 2019 when Westbridge finally did a full exit. So I think Sandeep was always around, very patient and very helpful with us. So yeah, I remember him. And then at the right, why I was saying at the right time, because when we were thinking of the IPO in 2018, that's when Mr. Jhunjhunwala came in, right?
Yeah.
And he was also surprisingly very fascinated by gaming. He would call me once a month directly on my phone, ask me to come and meet him, and spend many hours actually. He had young kids in his house and he was seeing that mega trend, right, take off. And in recent times, we've had Nikhil Kamath support us. We've had Arpit from Plutus support us. Mithun Sacheti actually joined us as a co-promoter.
Yeah. I want to talk about the debate that's going on perhaps within your household.
Yeah.
You have 2 kids.
Yes.
This is a debate that's going on in many households across the world. How much time do you give your kids on a gaming console, on an app?
Yeah, I think the way I have explained to my kids is that as long as certain fundamental things, their school activities, how they are faring in their exams or summatives, etc., their sporting activities, their music activities, their time with friend, their time with parents, if all of that is in a good place, then I'm not conditioning it by only 30 minutes or 1 hour or 2 hours. That's what I think should be the right place.
Your wife clearly doesn't agree with you.
My wife doesn't agree at all. And we debate on this every day, right? About the screen time. So I think every parent has to find the right time. I think definitely gaming has the ability to be addictive for these kids, right? And there has to be a line drawn, because if it's not, then what you can see is negative symptoms start to showing up. The child is losing interest in physical activity, in school, in being irritable, etc., right? So I think the parent has to be sensitive to that and make sure that it's a well-rounded development. But I also think that parents who are too strict or saying you can only play on weekends, I think they're overdoing it. You don't need to spoon feed children. Today are very smart.
What we're seeing, for instance, in Australia, mandating that nobody under the age of 16 should be on social media, and we've just started at being executed. Do you fear that we might see these mandatory restrictions coming in, which could include perhaps gaming as well?
Yeah, I think some of it is appropriate, right? And I think at least we as a business and we as Nazara always want to do what is the right thing for our audience, including the kids. I don't think we are into it for monetizing, irrespective of the potential harm it may cause. The problem is a lot of this gets lost in translation. It gets lost in implementation, and that's where the challenge really is. Knee-jerk implementation, etc. So I think the first port of call is the parents themselves to understand what is responsible gaming. I surely think the industry should come together to put out what is responsible gaming. And
is industry doing that?
I don't think so at this point of time. I think we're starting to talk to the government, talk to a variety of stakeholders around this topic, and we will do more so going forward.
Your new brand identity, you have a magic wand, so to speak. If only businesses could be run like that with the help of a magic wand. But if you did have a magic wand at your disposal.
We do have now.
A real one. What would you use it for?
I would say to provide delight to a consumer base. That's the official line we have. Enter magic now with Nazara. But I think I would use it to obviously delight our shareholders also going forward. But build a strong business. I think, how do we get to that dream of building this global giant out of India? How do we build India's Nazara, really, not India's Tencent? That's
By when?
I think.
Do you think that this will look like a completely different company in the next 5 years?
Yeah, definitely. Much sooner, I would say.
Much sooner?
Yeah, 3 years.
Your de-stress mechanism is not gaming, right?
Yeah. I mean, I like to play games, but I also like to play my saxophone.
So should we bring out the saxophone and actually get you to, and I don't know how many people know this, but Nitesh actually used to play in a band and for many years.
That's right.
For quite a while, right?
We had in Mumbai Jazz by the Bay, I think a fixed slot every month for a decade or so.
Huh.
Yeah.
And so we're going to get him to relive some of that magic and bring out the sax. What is your favorite song? Shami Kapoor. We should do Shami Kapoor.
I'll also see which one I practiced to play.
And I think to myself, what a wonderful world. Clouds are white. And I think to myself, what a wonderful world. I see friends shaking hands. And I think to myself, what a wonderful world. Woo!
Okay. That was a bit impromptu without the music and all.
Impromptu but fabulous. Ritesh, it's an absolute pleasure. Thank you so much. May you continue to create magic for Nazara and may you continue to create magic on the sax as well. Thanks so much for joining us again on Young Turks Reloaded. It's been fun talking to you.
Thank you.
So with that, it is time for us to wrap up this edition of Young Turks Reloaded. If you enjoyed watching our conversation, send us your feedback. We always like to hear from you. But now, from all of us here on the team, goodbye and many thanks for watching.
Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Passive mutual funds are becoming a very important part of the Indian investing landscape. These funds now comprise almost 17% of the mutual fund industry's total assets under management. Now, just to remind you, passives, as these funds are called in short, now they are funds which do not rely on a human being to pick stocks or bonds or any security that this fund is investing in. These funds instead simply mirror an underlying index for portfolio construction. So how can we investors make best use of these low-cost funds to boost our portfolio performance? What's the right way of incorporating these passives in our portfolio, and why should we do it in the first place? Well, joining me on this very interesting discussion are Pratik Oswal, who is Chief of the Passives Business at Motilal Oswal AMC, and Aditya Agrawal, co-founder at Wealthy.in. And of course, Aditya works with a whole host of mutual fund manufacturers and companies within the wealth and investing landscape. Gentlemen, thank you so much for joining in. I'll tell you at the outset that on this show, we have done a conversation on passives in the past as well. So I think investors will quickly do a refresher. But I think the fact that these funds are simple, they only mirror an index, I think that part has been understood. What we now need to really understand is the way this industry is growing. There are so many different kind of passive funds coming in. So how do we start our fund selection process? Let me get some opening thoughts though. Pratik, you come in, and you're in the business. You've seen the plethora of NFOs all through this year. What is your take on where we are in the so-called passive revolution?
Thanks, Surabhi, for having me. So, obviously, so passives, as we know, are pretty large in more developed markets like the US and Europe. Out there we are seeing more than 50 to 55% of the mutual fund industry is purely passive, and the rest is active. So it is a pretty large part of people's portfolios in most of the world, at least the developed world. And now we're seeing that it's getting some sort of mainstream sort of acceptance in India as well. If you look at passives, 10 years back, it was less than 1% of the entire mutual fund AUM. Today, it's close to 18 to 19% of India's mutual fund AUM. So it's grown significantly. And we're also seeing that, it used to be mostly, institutional participation that was there in passive funds. But since COVID, we're seeing increasingly, adoption of passive funds towards retail and also HNI investors. So overall, we used to see a very narrow acceptance of passive funds, but as of today, I think it's happening from all over. So I think there's a growing awareness of passive funds coming in, and we believe that today, most investors, are probably, looking at having one or two passive funds in their portfolio, at least the equity part of the portfolio.
Oh, absolutely, and the numbers are staggering, right? The rise of passives has also been nothing short of extraordinary, because some of those numbers, and they're on the screen as well. Over 6x of an increase, 6 times of an increase from just before COVID to now. So the adoption is also, really on the rise. Aditya, let me ask you, I mean, what do you feel when you see things around? A bulk of this passive AUM is still in the very simple funds, right? The funds which are mirroring the Nifty 50 or the Sensex. But what are the trends that you've observed over the last couple of years?
No, I think rise of passives is actually a great news for our industry. It just shows that Indian investors maturing. But I would say that last at least 12 months, the hero has been the gold inflows into gold ETFs and gold-rated index funds. And passives by nature is meant to be a simple product. So it's great that the products that are getting adopted for their simplicity. So, for example, Nifty 50, we all know, but gold also, if you look at it, essentially it's tracking commodity prices. So an index fund or a passive low-cost fund is the best way to sort of invest in it. So I think I'm really encouraged by the fact that gold, which is the second largest asset class after real estate in India, is actually finding its way into financial products through the way of the simplest financial product that is, an ETF or a fund of fund that holds ETF. So I think that's something that definitely is very encouraging. Obviously, as you mentioned, there have been a ton of new launches on index side, especially in 2025. And, where there are various strategies that we have seen, thematic, multi-factor, single factor. But yeah, I mean, those are, I would say wait and watch, because I think in my mind, simplicity is the single biggest feature of index funds. And that is what, customers are adopting right now for.
Yeah, absolutely. In fact, let's pull up the data. Just the flows coming into passive funds, again, illustrates the point that the investor is getting far more nuanced. and wants to look at products which are low in cost and offer perhaps similar returns as the index. So this year alone, if you look at the monthly data, in May, the average flows were around 5,500 crores. It picked up in July to about 8,000 crores. August, the number crossed about 11,000 crores, 19,000, 16,000. And November, the total flow, that's index funds, that's specifically index funds. But if you look at the overall flows coming into passives, then the latest numbers are reading closer to 15,000. So very steady flows coming in at a time when the equity market has been, fairly volatile and range bound, one would say. Now, Prateek, we all know that cost is a huge advantage, right? Passives typically, also tell us, I mean, you're on the manufacturing side of it, so you'd know, you'd have the numbers at the back of your hand. But typically for ETFs or index funds, costs are in a few basis points here and there compared to what, 2.5% average expense ratio for actively managed funds?
Yeah, so I think a big draw towards, I would say, passive funds is cost. That's one of the draws, though. It's not the only one. I think the biggest draw, I would say, is simplicity. What Aditya said, I think today, because of the plethora of funds out there, there are, if someone wants to buy a mid-cap fund, they don't have to choose between, 5, 10, 15, 20, 50 mid-cap fund. They can just buy the mid-cap index and, invest it. So I think growing awareness and also low cost and also I think simplicity is, pretty much a good reason. Also, what we're seeing is that, if you look at Indian markets today, they're a lot more efficient than it was, say, 10, 15 years back. So the sort of outperformance that we've seen, especially in the large cap side, has been quite muted, especially in mutual funds. So, for example, in the last 5 years, there has been more money that's come into passive large cap schemes than active large cap schemes. Which shows that people are looking at performance a lot more strongly. People believe that low cost will probably lead to a situation where they might end up making higher returns. It's also a simpler strategy. When I talk to investors, when someone wants to invest for say 15, 20, 25 years, it's very hard for you to really select one particular product. I think if you go passive, it's pretty much going to be there. If you look at the US, the S&P 500 index, which is the world's most popular passive fund, has been around for half a century, 50 years. And, I think whoever's invested in that has done pretty well. So I think the growing awareness, also obviously low cost is a big add-on. Although I would say that, low cost is probably not the main reason. It's probably returns, and people are seeing that the returns between active and passive are fairly comparable today than they were, say, 5-10 years back, and I think that's where the demand is.
So it's the returns mix and the cost mix.
Yeah.
On returns, actually, let's pull up some data, and this is always extremely interesting. Now, viewers, is something called the SPIVA report card. It's S&P indices versus active. Now, this is basically an industry study that's put out twice in a year, where the provider of the study compares the performance of actively managed funds, where there's a human being involved, so there's a higher cost involved, versus simple passive funds that are only mirroring the index. Year after year, this study has been indicating that the underperformance of active funds is diminishing, or rather is increasing, and the outperformance is diminishing. And the numbers are on your screen as well. This is the 2025 mid-year report card. According to the SPIVA report, 65.6% of large cap funds underperformed over a 6-month period. But let's look at longer term. We typically invest in mutual funds for 3 years, 5 years, right? So on a 3 or 5 year basis, the underperformance of large caps is 66% in 3 years, 89.7% over a 5-year period. So that is what I guess Prateek was alluding to, that this underperformance is something that people are beginning to question. But Aditya, weigh in on this performance debate. The active fund managers typically argue back, saying that at least in the mid-cap and small-cap market, there is a lot of merit in going with an active fund over a passive fund. However, there are passive mid-cap funds, small-cap funds galore. And that's where I sometimes wonder what's the right approach. What would you say?
No, I would go for active fund. So by the way, just a word on the SPIVA, right? Because, in India, as we know, SEBI rationalized indexes, only a few years back. Whereas SPIVA uses a mix of indexes, so I wouldn't really go by the long-term benchmarks comparison with SPIVA. But yeah, it's still a very good heuristic to use. I think active, because, Prateek, I think mentioned it, that we are still, as a country, we are a developing economy. There are still inefficiencies in the market. And that inefficiencies allow a fund manager to actually show his or her mettle by doing the right kind of research, doing the bottom-up research and finding gems which will get lost in an index fund just because, they can only sort of mirror what their actual weight in the index is like. So I would say that, for mid cap, small cap, even thematic, I still am a firm believer that active fund managers can really create that alpha. And whatever extra we are paying in terms of expenses, that they more than justify by creating that 3 to 5% alpha sometimes. And, I think if you look at even that SPIVA report, even the 1 year, 2 year data that you have, 70% mid and small cap funds end up outperforming the index. So I'm personally a firm believer. And that's what, by the way, investors also, when we have that conversation with investors, they also kind of buy that pretty reasonably. That I understand that, if a fund manager is convinced about a mid cap stock potentially becoming a large cap tomorrow, they can take a much larger bet on that stock versus where an index where everybody is treated equal. So active and small and thematic, I think these three areas is where I personally would bet my own money also on active fund managers.
Okay, so there you go. You're hearing divergent views, and that's what a lot of industry experts have been telling me through the years. It's not active versus passive. It's active and passive. You have to have a great blend to have a smart portfolio that's cost efficient and yet delivers the desired returns. Now, how to build this perfect mix, this perfect cocktail? This is exactly what we'll discuss with our experts after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are talking passives, how to have the right passive portfolio in place for 2026. And remember, when it comes to passive funds, there are so many categories. Equity is just one of them. Then you can buy gold and silver through passive funds. You can get into foreign equity through passive funds as well. So there's a wide variety of choices. We just need to know how to pick and choose. So I'm going to ask both Prateek and Aditya to now don advisors' hats, as if you're advising people in your friends and family circle, and help us make that portfolio. And it's a complete open canvas. It can be an all-passive portfolio. It can be a blend of active, passive. But let's hear out our experts' views. So Prateek, why don't you go first? For 2026 and beyond, if you have to devise a medium risk portfolio for someone in their late 30s, early 40s, how would you go about it?
Yeah, so if you look at portfolios today, almost for most investors, most investors would have close to a 0% allocation to passives. And I've always believed that in a country like India, like Aditya said, you should have a balance of active and passive funds. In fact, I'm almost on his side, where I believe more of your portfolio should be in active because there is a lot of opportunity for outperformance in actives, especially in mid and small caps, which is where I think companies are growing at a much higher pace, and the scope for stock selection tends to be much higher. So if I had to build a portfolio, and this is obviously very generic advice, I would probably do 50% active, 50% passive.
Okay.
In passive, I would keep it super simple. I would do a Nifty 500 product, which is
Nifty 500 broad.
Yeah, it's my favorite product, to be honest. It's
okay.
if you ask anyone at MO also, they'll say it's the best product.
And why
it actually follows the. So if you look at the philosophy of passive, if you look at guys like Vanguard or Jack Bogle, who sort of created this indexing as a philosophy, the philosophy says buy the market, and I think the best representation of the market today is Nifty 500. Unfortunately, Nifty 50 is not a very good option. In fact, it's the worst option because it does not represent the market anymore. So even you guys, when you talk about indexes, you guys say Nifty, but you also talk about small and mid cap indices. So both have very different. So I think if you are able to buy a broad-based index that covers the entire market, I think that is good enough for your passive portfolio. So Nifty 500, say if you're, I'm a big believer of international diversification. So there's something as simple as an S&P 500 would be adequate for international diversification needs.
Okay.
And maybe a 5 to 10% holding in gold and silver. So combination of gold and silver. And maybe 15 can be active, mostly mid and small cap, I would say. So that's a good mix when it comes to portfolio construction.
So a broad market index to play India, passive. Broad market index to play one of the biggest global markets, that's the US, S&P 500. And passives to play gold and silver.
Yes.
That's Prateek's recipe. Very interesting and quite convincing, I must say. Got that. Aditya, your turn.
Actually, this is exactly what I was going to say as well.
Wow. So, our panelists agree.
If you're a DIY investor, it makes sense to maybe go 60% passive, right? And 50% in a broad market index. It could be a mix of Nifty 100 and Nifty 500. And 10% gold or silver, which whatever is your sort of preference. Because, especially I would say gold is, more like cash. So it's like holding currency in your portfolio. And the remaining 40% can be a mix of actives, where largely mid and small. And if there is an opportunity to diversify in the passives, then probably 10% towards internationals, because I think internationals as a space will keep growing. I hope that AMC's also launch more products where we go beyond just US, because there are several markets where there are growth opportunities and which are underpriced. So yeah, I would say I would broadly agree with Prateek on that construction of that portfolio.
How lovely. We have, unanimity of views on the table over here. But, okay, let me, drill a little deeper then. Aditya, both of you, like investing in international markets through passives. But help us out here. And lots of viewers write in because hardly any funds are open because of that, industry-wide $7 billion cap. So if someone wants to take global equity exposure, which are the passive funds that are taking money?
Off the top of my head, I think there are. Prateek, is your AMC taking money in international funds?
No, not really. Unfortunately, not.
Yeah, that's the problem, right?
It's
a hard one to keep track of.
Yeah,
it's a hard one because some AMCs stop, then they start again. And I think there were a couple of NASDAQ 100 ETFs which were open for subscription. But as I said, it's a very dynamic environment. It's very hard to pinpoint right now exactly. Top of my head, I don't remember which one.
Okay, no worries, no worries. We'll come back and revisit that topic. It's one of the most often asked questions to me as well personally, and people writing in saying, how do we invest in global markets? Very few routes available here in India, at least through the mutual fund route. But gentlemen, we haven't touched upon the so-called smart beta or the multi-factor products. Now, again, for viewers, quick crash course, how human fund managers decide on certain filters and then they select stocks. It could be a fast-growing company. It could be a stock with a lot of momentum. Or it could be a value stock where the valuations are extremely low and extremely cheap at this point in time. Similarly, these factors or filters decide how a factor-based passive fund, rules-based fund selects stocks. So Prateek, help us understand this because there are a lot of these factor-based funds that have come up in the last 2-3 years. What do you think of them? Are they suitable in the Indian context? Do they get too complicated? Because neither of you, singled out factor-based funds in your perfect passive portfolio.
Yeah, so, personally and also as a as an AMC, we are very positive on factor investing. I think it's we've invested a lot of research, R&D, and a lot of effort in sort of educating people on the benefits of factor investing. In fact, if you look at global markets, the biggest category of investing is your broad-based indexes like S&P 500 and Nasdaq. The second biggest category is actually factor investing. Active funds come after that. So it's a very massive space globally. We're seeing in India also, if you look at factor funds, I think if you're looking at close to 40 to 50 times 50x growth in AUM in the last 5 years, 4 to 5 years time, and we're expecting this category to grow at the same pace going forward. So there's a lot of interest coming in factor investing. We believe that factor investing comes in between active and passive investing. Even though the construct is passive, the expectation that an investor should have is to outperform a broad-based benchmark like a Nifty 100, Nifty 500, which it has. If you look at performances of most of these factor funds, there are four. There are many factors, but the four most popular factors are momentum, value, quality, and low vol. All of them have really outperformed over the long run. However, having said that, there are, just like most active funds, there are also periods of underperformance. So, we would definitely suggest a portfolio of factor funds to any investor who's able to put in the time and effort to understand.
Because then you have single factor funds, and some of them combine factor. There's low volatility, and then there's momentum, and a lot of things coming together. So at times it gets a bit much. But from your perspective, what kind of factor-based funds make sense?
I think the ones, the multi-factor ones tend to be the least volatile in terms of performance. So I would say any strategy which combines factors, investors tend to have a slightly better experience. But we believe that, factors can be added to the portfolio as a single factor. So if your portfolio, for example, very few portfolios have a momentum exposure. They tend to have a very high exposure towards quality and maybe growth and maybe value. Momentum is sort of missing, so maybe a momentum factor can come in. Or if some portfolios don't have a value strategy, it makes sense to have a value factor. So you can either combine it as a standalone strategy, or you can add it as a complementary fund to your existing portfolio. So both ways work.
Yeah, but it sounds like something you'd want to discuss with your advisor very clearly. See what complements your portfolio. There are no straight answers here that kind of fit the bill. It's very portfolio specific in terms of what you already have and what is it that you're seeking in terms of returns. Aditya, coming to you now. Final thoughts, throw in a word on these factor-based funds, if you will. And then the most important question, 3, I was going to go with 5, but I'm going to say 3 passive funds that everyone should consider in the new year.
Oh, that's a tough one. So anyway, so on factor, I think, idea of index funds is to simplify. Index funds are ideal for DIY investors or large portfolio investors. So by looking into factors, you are again introducing sort of a variable where you have to look into your portfolios on a regular basis, because every factor goes through its cycle, right? So it just adds that extra bit of complexity, and the whole purpose was to keep things simple, to earn market returns, and certainly introduce a variable where you have to spend that much more time on rebalancing your portfolios, every once in a while. So that's why I'm not a big fan of factor strategies. It's better to sort of trust active fund managers for stock picking. In terms of funds that you could pick for 2026, I would say that MOSL has a pretty good basket of index funds. So while mid cap and small cap, I personally prefer active funds, but I do have personal allocation towards mid cap 150 as an index. And definitely Nifty 500 is something that could be a part of your portfolio. And I think gold and silver continue to remain as index funds, which can be considered. So it could be Axis Gold Fund of Fund that can be considered as an index fund in your portfolio. So I would say those are my 3 picks for 2026.
Okay, all right. Very interesting conversation and a very helpful one as well. I think it gives everybody a lot of food for thought as we look at our portfolios fresh after the New Year party and then decide how to start incorporating passives bit by bit. Thank you very much, Prateek and Aditya, for joining in, and wish you both seasons greetings and a fabulous 2026 ahead. Thank you for joining.
Thank you so much.
Thank you so much. Well, that's it on this week's edition of Let's Talk Money. Keep sending us your feedback, comments, and queries. And we're not done yet. We will be meeting again before the new year. So see you again next week.
Let's Talk Money